Hello and welcome guys, and welcome to part 1 of this audit marathon. And yes, in this marathon we are going to cover all the major topics of CMA Inter paper number 12 of audit. Guys, one very important thing which you need to take care of is that the extent to which the syllabus is there for audit as compared to other professional courses is very different in CMA. So you cannot afford to refer to any book of any other professional course like CA or CS for studying for audit of CMA. So in some other professional courses, the extent of coverage is too vast as compared to CMA, and some other courses, the coverage is too less. You have to study perfectly as per the syllabus prescribed by the Institute of Cost Accountants of India. Therefore, my earnest endeavor and request to you is please study the Institute's study material. What I have done is I have, based on the institute study material, I have developed this study material in which I have catered to the specific requirements of CMA Inter students, and you will find this study material exactly based on the module of the Institute of Cost Accountants of India for CMA Inter audit. So let's start the first chapter, auditing concepts and types of audit. So first of all, what was evolution of audit, what was need of audit? And you must be aware that audit means checking, it means verification, it means scrutiny, it means to verify certain facts and to make a report. That is a broad framework which is audit. So a very simple example if I give you, then your mom asks you to fetch some groceries from the nearby shop, and your mom gives you 500 rupees, and she gives you a list of the groceries, whatever is required to be fetched from the supermarket. You bring those groceries to your mom, and your mom asks you for the balance change. You give your mom 200 rupees back, which means 300 rupees have been spent. Now your mom asks you for an invoice, and the invoice is only for 250 rupees. So your mom asks you, the invoice is only for 250 rupees, whatever the balance change which you have given back to me is 200 rupees. Mom asks you, where is the balance 50 rupees gone? You tell your mom that, mom, on my way to home I found a good ice cream parlor, and I went to the ice cream parlor and ate an ice cream for 50 rupees. Your mom asks you, please give me the invoice for that ice cream of 50 rupees. You pull out that invoice from your pocket very hesitantly and hand it over to your mom. And then your mom is satisfied that yes, the expenses are incurred appropriately. This entire process is nothing but audit. This is what auditor does in any company. Auditor will ask you, what kind of expenses have you incurred? What revenues have you earned? What debtors and creditors are there in your balance sheet? And auditor is going to verify from documentary evidence, because verbal evidence is no evidence. So documentary evidence, he will be verifying your claims, whatever claim you've done, and that is audit. So audit is nothing but a verification, a checking, a scrutiny, investigation into the books of accounts of a company, be it financial books or cost books or secretarial books or GST books, any books, and that is known as audit. So in earlier days, there was no concept of auditing, because in earlier days, the businesses were very small. In a small business, you don't need audit, because the owner of the business is directly supervising your work, and he is directly looking at each and every expenditure which has happened or incurred in an organization. So there's no need of audit. In earlier organization where there are small organizations, so the need of audit was not felt because of the two following reasons. Number one, nature of businesses were small, they were very small businesses. Secondly, day-to-day operations were personally controlled by the proprietor itself. When control was done by the proprietor itself, then there was no need of audit. Audit evolved after industrial revolution in 18th century due to the following reason. What was the reasons for evolution of audit? Due to, number one, large scale of business organizations. When there are large businesses which are catering to different needs of the consumers, then there is requirement of an audit, because the proprietor cannot go into each and every element of the organization and personally supervise each and every activity. Then dilution in control of proprietor. Dilutes its controls, and proprietor cannot be present everywhere. So there was a need of audit. Then there was a divorce of management and ownership. So in a company setup, the shareholders are different people and the people who are managing are different. Solomon versus Solomon is a classic case where it was held that the identity of your shareholders are different and that of your board of directors are different, and board of directors are entrusted with the activity of only and only supervising the day-to-day activities, and the ownership is in the hands of the shareholders. Shareholders cannot interfere with the workings of the board of directors. So when divorce happened between the shareholders and the board of directors, then there was a dire need for the shareholders to have a grip over the entire financial statements, and that grip could not come unless and until a person from the shareholder, appointed by the shareholder, could come inside the company and supervise and overview the entire functioning of the organization. So this was one of the reasons for evolution of audit. Then transactions being recorded by staff or representatives of owners. The transactions were not recorded by the owners itself, it was recorded by their representatives. So there was a need to supervise them, because chances of errors, chances of mistake was quite high. Then need was felt for audit of public accounts. Public accounts means government organizations where public money is involved. The need was felt for those accounts. In India, auditing has evolved step by step, and it was not a one-day affair that one fine day Institute of Chartered Accountants of India evolved and they gave you the standards of auditing. No, that it was not a one-day affair. The evolution dated back to 1857 when Joint Stock Companies Act introduced audit. Then it was enhanced by Companies Act 1913. Then it was replaced by 1956 and 2013 Act, which have introduced statutory audit, which is to be mandatorily done by a chartered accountant. Then came our role, yes, cost accountant's role. Cost audit was introduced in 1965, which was mandatorily to be done by a cost accountant in practice, and yes, cost audit was evolved. Then tax audit happened. Income Tax Act was amended, and need was felt for an audit which was specifically testing the income tax activities. Only the transactions which are related to income tax are tested in this particular audit. So the focus of every audit is different. So for example, your mom, when your mom is testing your expenses, then her focus is on the money which has come back to her, and whether you have spent the money and calculated everything properly or not. In the evening, your father comes home and he asks you, what did you do during the entire day, and you tell the entire story. His focus might not be on money. His focus might be on, why did you have ice cream? Because your ice cream is bad for your throat and you would fall ill. So focus of your father might be slightly different from focus of your mother. So your father will audit in a different manner and mother will audit in a different manner. Similarly, Companies Act focus is on Companies Act compliance. So statutory audit will happen in a different manner, and income tax audit happens in a different manner, because the focus is on income tax avoiding transactions. So that is why different kind of audits evolved in India over time. Then there was sales tax audit, cooperative society audit, trust tax audit, valuation audit, section 14A of central excise. Although central excise has been curtailed to a very large extent. Valuation and SENVAT. Then CAG audit, which is Government of India audit. If any organization is held by Government of India or its representatives, then CAG would come into picture, and this was the CAG audit. Then GST audit, section 35(5). GST audit also came into play in India, and this is how the history of audit evolved in India. And trust me, in any other country, in any other part of the world, audit has evolved in a similar fashion. It generated, or it was, the need was felt in early 1800. And it evolved since then, and since then audit has become stronger and stronger, and every area is now impacted by audit, and audit is done for every area. You cannot even imagine what kind of areas are covered under audit these days. So right from electricity audit, efficiency audit, energy audit, social audit, whether you are performing your corporate social responsibility appropriately or not, any and every kind of audit with a different perspective has been evolved. Now comes the moot point. What is the definition of audit? So guys, audit has been derived from a Latin word audire. Audire means to listen. So in earlier days, there was no concept of documentation. So an auditor used to give his opinion only on the basis of what he used to hear from the peasants or the court marshals or the people who were present in the court. And in the ancient days, the persons appointed to check accounts used to hear the explanations required from responsible officers, and that's why the person who heard the explanation was called the auditor. Now you have to remember certain essays because they are important essays, and essay 200 is very very important. So what do you mean by an essay? Essay means standard on auditing. So instead of Chartered Accountants of India, yes, CA Institute have developed certain auditing standards whereby certain rules and regulations have been drafted on how to conduct an audit, and they are drafted under standards of auditing. Guys, we don't have standards of auditing in depth in our syllabus for CMA Inter audit, so please do not study them in depth. I will refer to certain essays, and I've given a list of essays in my book which I'll share with you guys also, and only those essays names should be remembered. That's it. No details are required for those essays, only names are required to be mentioned in the answers. We do not have detailed description of essays in our syllabus for CMA Inter. Please do not study essays in great detail, only names are required to be studied. Alright guys, so basic principles governing an audit. Essay 200 tells us what are the principles which are governing an audit, and audit may be defined as, now the technical definition of audit. Please remember the bold highlighted words very very carefully. It is an independent examination. What do you mean by word independent? Independent means free from influence or bias. So it is an independent examination, which means your opinion should not be, your examination should not be influenced or pressurized by someone else, especially the management of the company. It is an independent examination of what? Of the financial statements. Of course, in case of cost audit, it is the examination of cost records. In case of income tax audit, it is the examination of income tax records. In case of GST audit, it is the independent examination of GST records, so on and so forth. Of any entity. Now it is very very important that any and every entity can come into perspective of audit. So be it profit making or non-profit making. Sir, but non-profit organization are not making profit. What is the need of getting them audited? Of course there's a dire need to get them audited, because we want to know where are they employing their funds, because their funds come from donations. Their funds come from trusts, and public money is involved over there. So we need to know whether their money is being deployed in the correct manner or not, expenditure are being incurred in the correct manner or not. Whether large or small, even small organization would need audit. So for any entity with an objective to express an opinion. Now the objective of audit is to express an opinion. My responsibility is to give an opinion whether my financial statements of the company are absolutely correct, whether they are following the law, the relevant law, whether the compliance of law is taking place or not. So I need to really study and do audit from a perspective of giving an opinion. I am just a person who's giving an opinion. That is the purpose of audit. So let's highlight and let's recapitulate the important words. It is an independent examination. Number 2, of financial statements. Number 3, of any entity, whether it is large or small, profit generating, non-profit generating, with an objective of expressing an opinion. So 4 important things: independent examination, of financial statements, of any entity, to express an opinion. These are the 4 words, keywords, which you need to remember. Rest you can create yourself and you can use your language, but these 4 words are to be mentioned in your examination for audit definition. All right, sir, got it. So what are the ingredients of audit? What do you involve in audit, and how do you do audit, and what are the key elements which you need to remember while doing audit? Number 1, it has to be an intelligent examination. Intelligent means you have to apply your brain. It cannot be a routine exercise. It cannot be just a monotonous exercise which is just done for formality's sake. No, it has to be intelligent examination, which means a person of intelligence of level of a cost accountant or chartered accountant should apply his mind while doing audit. That is the prime requirement of an audit. It is an intelligent, that is application of logical rationale and reasoning. And it is a critical examination. Critical means in depth. You cannot check everything upar say and just give a broad view. You cannot do that. You have to be very very critical. You have to analyze the entire financial statements in depth. You have to go in depth of each and every point. You have to really study the transactions very carefully, and you have to bring out the deficiencies in the transactions. It is done by an independent person. Now, very important thing, guys, auditor cannot be dependent. Auditor's mind has to be free from bias. So auditor, while giving his opinion, should not have taken loan from the company. We'll be studying it in company audit, but I'm just giving an example. During preparing an audit statement, the auditor should not have a loan from the company. It should not be so that auditor has some loan from the company, because if auditor has some loan from the company, then he has some obligation to pay. And if he has some obligation to pay, he would not be free from stress. He would not be free from mental bias. He would be mentally biased towards the company, and he might not be able to express his opinion, be it adverse or be it normal, comfortably. So to be in a comfortable position, auditor has to be free from biases. Auditor has to be free from any dependence or free from any influence that management might exercise. So independence. Number two, qualified. He has to be qualified. Any Tom, Dick and Harry cannot conduct an audit. There are statutory provisions that you have to be a professional to conduct an audit. You have to be a qualified professional containing a certificate of practice to conduct an audit. So qualification is the key importance. Audit is done through documentation like vouchers, information, explanation. So you have to do an audit using documents. You cannot just be in your ancient time and just listen to what management has to say and just do audit on that basis. No, you have to do it on the basis of documents. You have to have substantiating evidence. Your mom would ask you for invoices. She would not believe you whatever you are saying. No, she wants invoices. Similarly, auditors wants invoices. Auditors wants vouchers. So what is this voucher? We'll discuss the voucher in our subsequent chapters. But this is a kind of document which is given to the auditor as a proof for a particular transaction. So auditor requires proof. Auditor requires information. Auditor requires explanation. Then auditors satisfies himself with authenticity of the financial accounts. Auditor has to satisfy himself. To give an opinion, he has to satisfy himself that the accounts are prepared well and the accounts are prepared in the best possible manner, following the legal regulations which are there. Legal regulations means Ind AS might be there applicable for the company. Companies Act suggests a lot of things. Instead of chartered accountants have given guidance notes on how to prepare accounts. All those should be followed and auditor should take care of it. Then balance sheet should give a true and fair view. Profit and loss account should give a true and fair view. Accounts are in conformity with concerned law. These are the ingredients of audit. And if auditor is not satisfied, he means auditors, if he is not satisfied, then he will report that he is not satisfied. Whatever element he is not satisfied with, he has to tell that he is not satisfied with this particular element. So for example, in your case, if your mom asks you where is the 50 rupees gone, then you will say, sir, mom, I ate ice cream from that 50 rupees. You pull out invoice and give it to your mom, and that invoice contains only 40 rupees of ice cream. Then where are the 10 rupees gone? So mom will express an opinion over there that okay, 40 rupees is perfect, but where is those 10 rupees gone? What did you do of those 10 rupees? I am unable to comprehend. So mom will threaten you. Mom will say, I will report loss of this 10 rupees to your father. If you do not want me to report loss of 10 rupees to your father, please give me an explanation and documentation for rupees 10 also. This is how auditor expresses an opinion if he is not satisfied with particular thing which has not happened in the correct way, or if he is not able to get the right explanation for a particular transaction. Then what are the features of auditing? Features of auditing, very important feature of auditing is that the evidence which is collected should be relevant, reliable and adequate. These are the three words used for evidence. Audit is based on evidence. Number one, audit, the foremost feature of audit is evidence. Audit is not based on hearsay. Audit is not based on what you think, what you feel. No, it's based on evidence. Emotions are useless in audit. Words, commitments are useless in audit. What is useful in audit is evidence. You need evidence for everything. You need documentation for everything. And evidence should contain three important ingredients. Number one, relevance. It has to be relevant. Your mom is asking you for receipts of 300 rupees which you have spent, and you are showing her receipts of 300 rupees which you have sent 2 weeks back. Not relevant. The period is not relevant. Your mom is asking for 300 rupees expenditure which has done today, and you are giving her invoices of expenditure which has happened 2 weeks back. Not relevant. So your evidence, the documentary proof, number one, should be relevant. Number two, should be reliable. So do you understand the difference between kacha invoice and pakka invoice? Kacha invoice is an invoice which is given on a paper where there's no invoice number written, there's no name of the store written, it's just written cash, 200 rupees spend. That is kacha invoice. Another one is pakka invoice, concrete invoice, which is a valid invoice. Now if you give a kacha invoice to your mom, then your mom will say, I don't trust in this invoice. This invoice might have been generated by you because there's no name of the vendor, shop, etc. You went to a proper mart, I mean Big Apple or some regulated place. You should have given you should have gotten the invoice of a proper format. The format of invoice which you are giving to me is not correct. So your mom might say that I am not relying on your evidence. So second feature of your evidence is reliability. Your evidence should be reliable. It should not be just any piece of paper or document which you are just giving for formality's sake. No, your invoice should be reliable. Number three, your invoice should be adequate. So for example, you spent 300 rupees and you gave invoices for 290 rupees. Your invoices were not adequate. They were not sufficient. Your invoices should be sufficient. So auditor has to see these three things in an invoice or a document or a evidence, that it should be, number one, relevant. It should be relevant to the expenditure which has been incurred. Number two, reliable. Number three, adequate or sufficient. So RRA, relevant, reliable, adequate. Please remember these three words. They are very, very important from a evidence standpoint. Evidence has got these three elements. Evidence should be relevant, reliable, adequate. Relevant, reliable, adequate. Every evidence which you give during audit, which you as an auditor receive during audit and as a client you give during audit, that evidence should be relevant, reliable, adequate. Adequate means sufficient, which means one and the same thing. So these are the three important aspects of auditing. Your evidence should be reliable, relevant and adequate. Then it is analytical, critical, investigative, review of systems of accounting and internal controls. Now you have to be very, very sharp and very, very critical, very, very diligent while conducting an audit. Audit is not just a random affair. It is a very serious affair and you have to do it very, very thoughtfully. So your review should be analytical, which means you have to analyze all the aspects of the transactions. You cannot just so I'll give you an example, a very simple example. Suppose a company has given 50,000 rupees to a consultant for a consultation fees. You ask the company, please give me the invoice. They hand over the invoice of 50,000 to you. You have a look at the invoice and say, yes, this invoice looks okay because it's a consultant, it's a legal consultant, and you have incurred 50,000 rupees which you have debited to your profit and loss account. Perfect. Your invoice is perfect. Three elements are there in your invoice. Number one, it is relevant, it is reliable, and it is adequate. But as an auditor, I have to be doubly sure of every transaction. So I'll employ one more check. I'll go to the TDS return of that particular client and check whether TDS has been deducted for this particular consultant or not. If TDS has been deducted under section 194J, which is for professional services, if TDS has been deducted for that particular consultant and the line item entry is there in TDS as well, I'll be sure, I have doubly checked it. Only invoice is not sufficient. You have to doubly check every transaction in a way that it establishes your belief that yes, transaction is okay. So the examination is analytical, critical and investigative. You have to really analyze the transaction in all round effect. You cannot just analyze the transaction from one respect and leave the other respect. So these three elements of auditing are there. Audit should be analytical, critical and investigative. Then the information audited may be financial or non-financial. Information can be financial, information can be non-financial information. So guys, many informations are analyzed by the auditor which are non-financial. You would say, sir, why would we analyze non-financial information? Guys, we would analyze non-financial information to analyze whether, for example, whether the company is facing a going concern problem or not. So going concern problem means if the company has filed a petition to the High Court that we are going to wind up in next 2 years, then it is a non-financial information. It might not impact your financial statements a lot at this point in time, but in future they are going to impact your financial statements, and you as an auditor should give this information about going concern of a company to your shareholders. From a shareholder standpoint, current year's profit is not as relevant as a qualification for going concern, because shareholders will then be jittery about their investment. So any kind of information, be it financial or non-financial, can be audited during audit. Evaluation of information should be systematic and in scientific manner. The information should be given in a systematic and a scientific manner. It should not be haphazard. You should audit all the account heads properly in a scientific and a systematic manner, one by one, one by one. Then the auditor should be. Now one feature of audit is that auditor, the focus is auditor, because auditor cannot be any Tom, Dick and Harry. Auditor has to be a competent person, independent person, qualified person, having the necessary qualification and certificate of practice. We've already discussed these features of an auditor. He has to be competent, which means he should have qualification, skill. Number two, he should have certificate of practice. He should have a recognized degree. These are important elements of an auditor. Then it ensures reliability of information, authenticity of information. You have to ensure reliability and authenticity of the financial information which is given in the statements, financial statements which an auditor is auditing. So these are the features of auditing. Very, very important words, guys. I emphasize on words for all theory subjects. Why? Because in theory you cannot remember the entire sentence for sure, but you can remember the words. So for example, evidence is directly connected with three words. Evidence has to be relevant, it has to be reliable, and it has to be adequate. Similarly, audit has to be analytical, critical, and investigative. So these words are to be remembered with respect to features of auditing. Okay, sir, got it. Next, what is the nature and scope of audit? So first of all, audit is not restricted to only financials and accounting records. Simple. Audit can be of anything and everything. For example, cost audit, managerial performance, which is known as management audit, internal audit, energy audit, GST audit, tax audit, etc. So whatever focus an act has, so GST Act has GST indirect taxes focus, income tax has direct taxes focus. Whatever focus an act has, that act will evolve an audit with respect to that focus. So there are various type of audit. It is not restricted to only financial statements. Then number two will be, there are standards for doing audit, how to do audit, how to cull out information, pull out the necessary information, how to prepare a documentation file for yourself. All these things are governed by standards, and in our case the standards are given by Institute of Chartered Accountants of India as well as Institute of Cost and Management Accountants of India. Standards have been given by both of these organizations. In our course, standards are not there. You just have to remember the names. I am repeating this thing again and again in Inter. But in final, when you will study cost audit, we will study all these standards in in-depth detail. All right, sir. So the auditor should be a competent person. He has to be well qualified and he has to be independent of the client. Then auditor is expected to exercise due diligence and professional care. So obviously auditor has to be diligent in his work. He has to be careful in his work while performing any audit. Scope limitations. Auditor is not expected to perform duties which are beyond his scope. So whatever scope is there, beyond his scope, he is not expected to perform his duty. For example, an auditor is not supposed to verify whether an engineering good is properly prepared by the company or not. If work in progress is there, what percentage of work in progress is there? Auditor is not technically an expert in gauging what is the percentage of completion of work in progress. Work in progress completion percentage has to come from an engineer, has to come from a subject matter expert. Auditor cannot verify what is the percentage of completion of work in progress. It has to be done by a competent person. Auditor cannot value a building. So if it's a matter of valuation, there has to be a valuer. Auditor cannot value a building. So auditor cannot be expected to do things which are beyond his scope. Number two, auditor is not supposed to prepare financial statements. Now this is a very tricky one, that while conducting audit and cost audit as well as financial audit, you are being paid for auditing, which means verification. You cannot prepare cost accounts or prepare financial accounts. So as a teacher, when I give you test, You are supposed to write the test and I am supposed to check the test. Suppose if I write the test, if you write the test and I ask you to check it yourself, then how many marks will you score out of 10? Sir, I think we'll score 12 out of 10, because we'll give 2 marks for our writing also. Sir, our writing is mashallah, and that writing is superb. So sir, we'll give 2 marks for writing and 10 marks for whatever correct answer we have written. We'll give us 12 out of 10. Absolutely right. So an auditor cannot write his cost accounts, cannot write cost accounts of the company or financial accounts of the company, because if he writes them himself, if he makes books of accounts himself and then audits it himself, then he will not be able to find out the mistakes in the cost accounts and cost records. This is known as self-review threat. So auditor cannot be asked to self-review his own things. So auditor is not supposed to prepare financial statements. Number 3, auditor can only draw a reasonable conclusion. Auditor is not supposed to give absolute or certain assurance. So what is absolute assurance? Absolute assurance is 100% assurance. And what is reasonable conclusion? Reasonable conclusion is high but not 100%. High but not 100%. So an auditor has to draw a reasonable conclusion, which means he is not supposed to audit the entire 100% of the transaction of an organization, because it is not practically possible given the timeline. There are strict timelines for audit. It is not practically possible for an auditor to review the entire 100% of the transaction. So sir, what will auditor do? Auditor will pick samples from the entire transaction. So if there are 1000 transactions in a company, then auditor will pick say 100 or 200 transaction, top 100 200 transaction, and he will audit only those transactions. So auditor will give you a reasonable certainty, reasonable conclusion. Reasonable means it is high but not 100%. Sir, what is high? High means 70% or 80%. So auditor will give you 70%, 80% of assurance, but he will not give you absolute assurance 100% that the accounts are 100% correct. No auditor in the world can give you this kind of an assurance. Then SA 200A on objectives and scope of audit of financial statement enumerates the scope of an audit of financial statements if the terms of engagement. So what are the scope of audit? They are given by SA 200A. If the terms of engagement restrict the prescribed scope of an audit, auditor should mention it in the report. So if management comes up and they tell the auditor that, see auditor, you are not supposed to audit these account heads. Why? Auditor will ask, why should I not? Because these are forming part of financial statements. Why should I not? Management is saying, because it's our call. We are instructing you not to audit these account heads. What should auditor do? Should auditor fight with the management with a punching box, with a punching bag and a hand, gloves, those punching gloves, big thick punching gloves, and punch the CFO of the company? Should auditor do this? Answer is a big no. Auditor has to follow instructions of the management and just write this aspect in the auditor's report. He will start his report by saying, at the very outset, I am culling out the scope limitations which has been imposed on me by the management, and management has restricted me from doing audit of repair and maintenance account, legal and professional account, and employee wages account. So I have not audited these 3 accounts. Apart from these 3 accounts, I have audited the entire financial statements. Auditor should write these limitations. If management has imposed these restrictions or limitations, auditor should write them in its auditor's report. Then there's a case study which I'm sure you are going to do yourself. I'm not harping upon case studies because we need to finish the concepts first. All right, now comes the relationship and distinction between accounting and auditing. Guys, accounting is to be done by the management. Please have this thing clear in your mind. You are not supposed to write accounts of a particular of any company. Although in practical world, practically chart accountants, cost accountants sometimes create accounts of those companies and then audit them. However, this is a bad practice. Whenever you become a cost accountant, and if you choose to have certificate of practice, please do not prepare cost accounts of a particular client. You just have to do cost audit. And if you become a chartered accountant, then please don't make books of accounts of clients. No, we need not give this service to the client free of cost. This is a valuable service which should be given by some other cost accountant, and it should be paid for adequately by the company. This is not a free service, construction of accounts. Accounts is management's responsibility. It should be done by management. Auditor's responsibility is just to check the accounts. That's it. So what are the distinctions? It is analyze and record the events, and auditing means review those events. Then management function, it is responsibility of management, and it is responsibility of auditor to conduct audit. Of course, audit cannot be done by management, and of course accounting cannot be done by auditor. This goes hand in hand. Then record and summarize data. Accounting records and summarizes data. Evaluate the evidence which are there. Evidence again contain 3 parts, you know that. Prepare financial statements. Financial statements is responsibility of management. And prepare audit report. Audit report should be prepared by the auditor. Make financial statements assertions. Claim on correctness of financial statements. So assertion means, it's a very important technical term which you need to understand. Assertion means dawa. Dawa means claim. So management is claiming that we have fixed assets worth rupees 3000 crores and the same have been disclosed in our balance sheet. This is the claim or the dawa which management is asserting in the financial statements. As an auditor, you have to test that this dawa or this assertion is does it hold water or not? Is it on a firm ground or not, or is it just hawabazi? You have to, as an auditor, ascertain it. So management's responsibility is to create a dawa, create a claim that we have got debtors worth rupees 100 crores. We have got income worth rupees 10,000 crores. An auditor has to audit or review whether this claim made by the management is correct or not in the financial statements. So management's accounting means to create assertions in the financial statements, and auditing means determine fairness of these assertions, whether these assertions are correct or not, whether the management has accounts worth rupees fixed assets worth rupees 100 crores or not, income worth rupees 10,000 crores or not. Auditor's responsibility is to verify whether these claims are valid or not. Then distribute financial statements to the shareholders. Accounting it's management's responsibility to distribute the auditor's report to shareholders. Auditor has the responsibility of just delivering one audit report to the client or 2 audit report to the client. Client should then facilitate distribution of audit report. Then one very important difference is that accounting precedes auditing. So auditing starts where accounting ends. So auditing starts where accounting ends. Then accountant work for and under the management. An accountant is a person employed by the management. Salaries is paid by the management. So accountant is dependent on management. However, auditor is an independent person. Although auditor's salary is also given by the management, but auditor is not under an employment or under influence of the management. So the auditor is an independent person, answerable, liable to the owners and shareholders, and not just to the management. So management cannot exercise influence over the auditor. Owners exercise the influence over the auditors. Accounting is done as per the principles set by Indian accounting standards, and auditing is done as per the principles set by standards in auditing. That is the difference. One common statement: auditing and accounting are interrelated. Obviously they are related to each other. Auditing begins where accounting ends, but they are distinct from each other. So in a way we can say that they are relative as well as they are distinct from each other, because accounting is incomplete without auditing, and auditing cannot happen without accounting. So both of them are related to each other, but again their scope, their emphasis, their area of operation is absolutely different. Now the question arises, who can be the auditor? Can a graduate be an auditor? Or can a person who has done BBA, Bachelor of Business Administration, be an auditor? Can a person who's done BCom Honors be an auditor? Can a person who's done Chartered Accountancy be an auditor? Can a person who's done Company Secretaryship, can he be an auditor? Can a person who's done a CMA be an auditor? Who can be an auditor? Answer is, the person conducting an audit is known as the auditor. This is the primary definition of audit, that whoever conducts an audit is an auditor. Now, to be an auditor, the person should be professionally qualified, number one. For example, for conducting cost audit, a person should be a CMA. For conducting secretarial audit, person should be a CS. For conducting statutory audit, person should be a chartered accountant. For conducting income tax audit, person should be a chartered accountant. For conducting GST audit, person can be a chartered accountant as well as a cost accountant. So first and foremost requirement of becoming an auditor, you should be professionally qualified. Second, he should be appointed by the board. Appointment is necessary for calling yourself as an auditor. If I have certificate of practice and if I am a chartered accountant or a cost accountant, I don't naturally become a auditor. I will become an auditor only when some company appoints me as an auditor. Then I can say, yes, I am an auditor of this particular company. So second prerequisite of becoming an auditor is that you should be appointed as an auditor by the board of directors. Yes, sir. Then what are the qualities of an auditor? What are the things which are necessary for an auditor to become an auditor and to be an auditor? What are the ingredients of a good auditor? Number one, he should be knowledgeable, of course, and of various discipline, not only accounting, but he should be good at economics, he should be good at life sciences, he should be good at science because there are certain clients which deal with science related products. He should be good at insurance, business, banking, regulation which you are studying in your accounts. He should be good at partnership. He should be aware about partnership law. He should be aware about companies law, income tax law, anything and everything, whatever is connected to his field, he should be good at it. So number one is knowledge. Number two, integrity, honesty and objectivity. Now, as a human being, my behavior and nature matters the most in an audit. If as a human being I have always been a person who lies a lot, who tries to trick people, who tries to be over smart and over clever and trick people and extract benefit out of them, if I am that kind of a person, as a human being, then even if I'm a chartered accountant, I'm a cost accountant, I will not be a good auditor. Because good auditor has to possess honesty, integrity and objectivity. Integrity means he should be person of value, person of beliefs. He cannot be driven away by any lalach, any kind of money, any kind of bribe should not be able to drive him. His driving factor should be his values, his ethics. That is known as integrity. Second is honesty. He has to be honest. He has to be bold. He has to be confident enough to raise voice against if anything is going wrong. He has to be honest. Number three, he has to be objective. Objective means he should understand and able to comprehend what is wrong and right, and he should be able to communicate in as many words what is wrong and right. He should not be mincing in his words. Mincing words is the worst thing that auditor can do to himself. He should be straightforward, point blank towards his goals. If anything is right, he should tell that it's right, and if anything is wrong, he should tell that it's wrong. So he has to be he should have integrity, honesty and objectivity. Auditor has to have these three aspects apart from obviously the knowledge. Number third, he should be aware about general principles of law. Of course, the law which are governing that particular country or that particular company. He should be aware about those laws like Companies Act in India, Income Tax Act in India, GST in India. An auditor should be able to understand the law and apply it for the client. Then he should be understanding the special features of a particular company. So for example, if you are going to do audit of an insurance company, as an auditor you should be aware about IRDA, Insurance Regulatory Development Authority law, because that law is prime law for regulating insurance companies. So you should be aware about that law. So he should be able to comprehend the special features of particular laws. Then he should have basic human qualities like politeness, courtesy, professionalism. You have to be polite. Again, behavior related factors. You have to be polite, you have to be courteous and you have to be professional if you want to be a good auditor. So the next topic is distinguish between audit and investigation. So guys, many a times we use these two words interchangeably, audit and investigation. Sometimes we say that audit is an investigation and sometimes we say that investigation is audit. However, there is a thin line of difference between these two words, and these two words are not absolutely same or even similar. There is a different scope to investigation, there is a different scope to audit. Audit is done by auditor, and auditor is not supposed to do investigation. That is a very critical scope limitation of an auditor, that auditor should not do investigation. Investigation is to be done by forensics teams or investigators or some expert team which is qualified in doing investigation. Auditor should not do investigation. Now, to explain the difference between audit and investigation, let me give you a very simple example. Your mom asks you to get Maggie from the nearby store. The store dealer gives you top ramen instead of Maggie. You wanted a Nestle Maggie, yellow color pack and Maggie written over it, and you wanted those noodles only, and the storekeeper gave you top ramen noodles. He tells you it is the similar thing, please take this, I don't have Maggie. You come back home and your mom says, no, this is not Maggie, this is top ramen, please go and change it. So while you are doing verification of whether it is a top ramen thing or a Maggie, what do you see? You see their texture, you see their difference in their colors, you see their manufacturers, you see their prices, you see all those things which prima facie tells you that this is top ramen and this is not Maggie. And that is how you are verifying whether that particular packet is Maggie or top ramen. Now, next day your mom again asks you to get Maggie. You go on in the same store and you ask for Maggie, and you tell the store manager that I need Maggie, and the store manager tells you I don't have Maggie, you please take top ramen. You again are perplexed because your mom has asked for Maggie only. You tell the shopkeeper, no sir, this is not Maggie, I want only Maggie, I don't want top ramen. Please exchange this, please take it back and give me Maggie. He gives you a packet of Maggie. Now, when you are coming back from that particular shop, you observe that the Maggie packet is looking a little weird. It is not the normal yellow color which is there in Maggie. It is a different yellow color. The font in which it is written is different. So you suspect whether it is original Maggie or some duplicate Maggie. You come back home and your mom again fears the same thing, because even mom feels that this Maggie there's something weird in this Maggie. There's something weird in this Maggie, and your mom thinks that no, this is not the original Maggie which we eat normally. This is a duplicate version of Maggie. Now when you go back to the store and tell the store manager that this is a duplicate Maggie, he would claim no, it is not a duplicate Maggie. If you want to verify whether it is original Maggie or duplicate Maggie, please go to the factory and see whether the Nestle factory is producing this Maggie or not, where we are procuring it from. Can you do that? Answer is no, no one will allow you inside Nestle Maggie factory. You have to take assistance of police in this case. You have to take assistance of expert in this case. So while the earlier confusion which you had between top ramen and Maggie was a prima facie audit, the next confusion, whether it is original Maggie or duplicate Maggie, it is not audit, it is investigation. So investigation is not done by auditors, it is done by specialist people like police. Police is authorized to do investigation. You will report this matter to nearest police station, or you will report this matter to ISI or some food authority of India, and you will complain against the Maggie manufacturers to them. And then they will initiate an investigation based on the sample given by you. So investigation is with a mindset that something is wrong. Auditing is with a mindset that nothing is wrong, everything is right. It's just that you need the right thing. That's it. You have taken a wrong thing, you need a right thing. That's it. There's nothing hanky-panky in audit. However, investigation, there is something weird. There's something hanky-panky. There's something else going on. Some malified activity is going on. So this is the broad difference between investigation and audit. Audit is prima facie checking whether the transaction is right or wrong. Investigation is in-depth checking whether the transaction is correct or not. It is detailed examination of the transaction, whether it's right or wrong. And it involves forensics activities also. It would not be done by any layman, any person, any professional. It has to be done by specialist professionals who are expert in forensics audit. That is known as investigation. Now let's see what is the difference. Now the objective of audit is to express an opinion. However, investigation is not to express an opinion, but to ascertain a fact. We need to know whether the Maggie is original or not. That is investigation. However, audit is to express an opinion whether this Maggie is right or wrong, whether top ramen is good or bad. Express an opinion. Number two, audit has a wide scope. audit includes a lot of things, and audit generally includes all the accounts statements of financial statements, all the account heads of financial statements. However, investigation is sometimes limited to a particular period or area. We need to investigate only with respect to the fraud which happened in, say, Adidas in, say, 2017. So you are referring to a particular event, you are referring to a particular year. That is investigation. Investigation might not happen for the entire year, or it might not happen for each year subsequently. Then audit is to verify the truth and fairness, and investigation is for a special purpose, that is investigating on behalf of incoming partner or ascertaining some fact. A special purpose is there in investigation. However, in audit, it is only concerned with truth and fairness of the financial statements. Audit is done as per generally accepted auditing principles. However, the investigation procedures are much wider, much larger than audit procedures, because investigation includes forensic also. So you must have seen CID, where investigation happens. There's Inspector Pradyuman, there is Daya, and they investigate in depth. That is investigation of financial statements. An auditor will evaluate the accounting records predominantly based on persuasive evidence, and in investigation the evidence which are looked at are conclusive evidence. So in case of audit, you are morely relying on the look and feel of a particular transaction. You see their packet, top ramen, color, font, size, etc. So you are just gathering persuasive evidence. And in case of investigation, when you have to ascertain whether the Maggie is manufactured by right person or not, in that case you need conclusive evidence. You have to go to the factory and see whether the right factory is producing a Maggie or not. So conclusive evidence versus persuasive evidence. Persuasive means 80% assurity. Conclusive means 100% assurity. Auditor is skeptical but not suspicious. So there's no suspicious element in auditor, means he's coming from a positive mindset. He's not coming in a negative mindset. However, an investigator has got a negative mindset and he has suspicion in his mind. He feels that something wrong has happened, and that's why investigation is taking place. And usually investigation is not a normal affair. It happens only when something suspective happens or something bad happens. So investigation is with respect to suspicion. It has negative mindset. Auditing is a routine exercise that it happens annually, and investigation might spread over a gap period. I mean, it might happen after 2 years, after 5 years, or after 10 years, or never in a company's history. That is also possible. So it happens longer than 1 year. Next, aspects to be covered in audit. This is very simple, guys. I'm skipping those topics which are simple, which are easy to understand. Please, you have to do those topics yourself, and significance also is easy. Now we come on to the very important aspect, advantages of audit of financial statements. What are the advantages? What benefits would a person derive from auditing of financial statements? And related topic, what are the limitations of audit? What are the things which an auditor does not see, or which an auditor lacks? Those things are to be kept in mind while reading an audit report. So first of all, what are the advantages of audit? It protects interest of various stakeholders. So various stakeholders who have stake in company, like shareholders, like creditors, like bank, loan, income tax department, because income tax department has to collect revenue from the company, GST department, all those are stakeholders in the company. So to protect the interest of various stakeholders, we need audit of financial statements. Then moral check on the employees. Employees will do things in a better way if they know that at the year end there will be auditors which will be coming in the office. So moral check on the employees. Employees will do things properly. Then employees will remain alert and vigilant, because employees will know that someone will check their work, so they will be more vigilant, they will be more alert. Then audit is considered to be more reliable by different cadres of government. Audited accounts. If you furnish audited accounts to government organization, they are much more relieved, they are much more satisfied. Then wastage and losses are discovered, and audited accounts are more reliable, useful under corporate restructuring exercises. Bank, financial institution and government require audited financial statement before granting any financial assistance. Any loan is required. If your company needs a loan, audited financial statements are required. Audited accounts taken more helpful for settlement of accounts. If you have to settle someone's account, I mean you have to you are three partners and one partner is outgoing, then to settle the outgoing partner's account, audited financial statements will be used and not the unaudited one. So these are the advantages of financial audit of financial statement. Now guys, there are certain inherent limitations of audit. Please don't think that audit is a foolproof method of ensuring that whatever is there in the financial statement is absolutely correct. It is not foolproof, because as we have studied earlier, it is not 100% scrutiny of accounts. It is just a 70% or 80% scrutiny of accounts. 20% scope of error still remains in audit. So what are the limitations of audit? Audit is not an assurance as to future viability of an organization. If an audited financial statement is audited by, say, a big four, the most reliable or the most big auditors of the country, and they have got very stringent procedures, very strong, powerful procedures. Of course, barring the ignoring the events which happened in past, I'm just ignoring them for a second, but they are the most strong audit policies and audit standards developers in India, and they have got very stringent softwares, very technical softwares which they employ. So if you see a balance sheet which is signed by a partner of say KPMG or a Deloitte, do you think that that company it is an assurance that that company is a superb company and it will be a very, very financially viable company? Answer is a no. Remember, audit is done for past and not for future. So if they have audited the financial statements for past, then that means that that past year has been recorded properly in the financial statements. It is not a guarantee to future. Audit is not a guarantee that company will do well in future as well, because audit is post-mortem. Then next, it does not guarantee that all material misstatements will be detected. There is no surety that all the material misstatement will be detected because of sample testing. We only test samples in an audit. We do not do audit of the complete transactions. So you only test samples. So it is not a guarantee that all the material misstatement will be detected. There might be some misstatements which are not detected. There is a possibility because of test nature, because the evidence are persuasive and not conclusive. Remember, we had a discussion whereby difference between investigation and audit revealed that audit is persuasive, investigation is conclusive. Persuasive means 70% assurance, conclusive means 100% assurance. Then inherent limitations of internal controls. Internal controls are controls that are imbibed by the management in the organization to ensure that management is working fine, organization is working fine. Auditors sometimes rely on these internal controls and do not do in-depth checking. And if these internal controls are not doing well, then auditor's report which is based on these internal controls will be faulty. So inherent limitations of internal control indirectly impacts the audit opinion also, because audit opinion will be faulty if internal controls are weak. Then professional skepticism. Sometimes the auditor is not able to keep utmost vigilant behavior, utmost professional behavior, utmost due diligence behavior, because at the end of the day he is also a human being. So risk of fraud or error or reliability of management representation are certain things which jeopardizes the opinion of the auditor. So professional skepticism might be less sometimes because of human element. Then materiality. Auditor only reports on material transaction. Material means most important. Now the less important transactions are generally not looked at by the auditor. What if those less important transactions have got the error? Then we stand a risk of having a wrong audit opinion. So these are the inherent limitations of audit. So the next topic is fundamental concepts of auditing, true and fair view, materiality and accounting policies. So guys, this word has been recurring in our conversations a lot, which is true and fair view. So the objective of an auditor is to express his opinion on the truthfulness and fairness of the financial statements. Now what do you mean by truthfulness and fairness? Let me give you another word. True and correct. Now what is the difference between true and fair and true and correct? And why in auditing we are using the word true and fair and not true and correct? What is the difference? Let me tell you the difference in brief. Correctness means that you are evidencing or vouching for the 100% correctness of financial statements. And true and fairness means that you are giving a reasonable assurance, which is 70% assurance on the correctness of a particular thing. So when you give an absolute assurance, means I've checked 100% of the transactions and 100% of the transactions are correct. Then you say you have given a true and correct view. And when you say that you've not checked 100% and you've picked a set of samples through which you have analyzed your given your opinion, then you say that you've given a true and fair view. Fair means not absolute, not 100%, and correct means absolutely 100% correct. The phrase true and fair in auditor's report signifies that auditor is required to express his opinion as to whether state of affairs and the results of the entity are truly and fairly represented by the accounts under audit. This requires that auditor should examine the accounts with view to verify that assets are neither overvalued nor undervalued. No material assets are omitted. Now please see the use of word material. Material means important, which means that if some very small or unimportant assets are omitted, that's okay. It is none of the botheration of the auditor. So no material assets are omitted. The charge, if any, on assets are disclosed. Material liability should not be omitted. Again, use of word material, which means some small immaterial liability may be omitted. It's okay. Auditor will not bother about it. The financial statements have been prepared as per the applicable financial reporting framework. Financial reporting framework means the law and the formats which are prescribed by the law to prepare the financial statements. In India, this relevant law is Companies Act 2013. So you have to verify that the financial statements have been prepared as per the applicable financial reporting framework. All unusual, exceptional or non-recurring items have been disclosed separately. Anything which is unusual, anything which is non-recurring should be disclosed separately. What constitutes true and fair is a matter of auditor's judgment. Now this is a very important thing, that auditor should decide what thing is important and what thing is not important. It depends on judgment of the auditor. Because if auditor says that this particular thing is important and this is not important, some other person should not be able to question that judgment of the auditor. So it is a matter of auditor's judgment in particular circumstances of a case. True and correct view. Now what is true and correct view? It signifies absolute assurance, 100% accuracy. However, true and fair view denotes reasonable assurance, that is less than 100% accuracy. In India, most of the audits requires the auditors to give a true and fair view. There is only one audit, which is income tax audit, which requires you to give a true and correct view, and there may be audit like GST audit which may be requiring a true and correct view, but statutory audit asks you to give true and fair view. Cost audit also requires you to give true and fair view. So this is the difference between true and fair view and true and correct view. Now we have been talking about this word a lot, which is materiality, and I have been in layman terms telling you that materiality means importance, anything which is of importance. But sir, for one person one thing is important, for other person another thing is important. So for a very very poor guy, rice is very important, wheat is very important. For a rich guy, BMW is very important, his bungalow is very important. So importance is subjective, it changes from person to person. So in financial statement, how would you determine that whether repair and maintenance of 1 crore rupees is important or not, or whether legal and professional expenses which are incorrectly stated by rupees 10 lakh is important or not? How would you ascertain, sir? A very simple criteria of judging whether a thing is material or not. Auditor has to think whether this incorrect thing in the financial statement, if disclosed to the stakeholders, would they change their mind? Would they take a different decision than what they are taking right now? So for example, if revenue of 1 crore rupees has been omitted from the financial statement, then auditor should think whether the revenue authorities would compute a tax in a different manner if 1 crore revenue is there. Answer is a big yes. Revenue authorities will be jittery if 1 crore revenue is missing in the financial statements. So this becomes material. So materiality means a thing which will impact the decision making of a particular stakeholder. Any stakeholder, shareholder, creditor, debtor, Government of India, GST department, indirect tax department, FEMA, RBI, any stakeholder. That is the criteria of materiality. So Now, this concept is applied by the auditor both at the planning stage and performing stage. Material misstatement, either individually or put together, may influence the decision of the users. Now, the concept is applied by the auditor. Auditor applies this concept at planning stage and performing stage because auditor has to decide whether a particular account head is to be audited or not. And this decision is taken on the basis of materiality. If account head is above the materiality limit, then this account will be selected for scrutiny. Otherwise, the account will not be selected for scrutiny. Material misstatement, either individually or put together, may influence the decision of the users of financial statements. Now, materiality means that if this misstatement is allowed to be put in the financial statement, that it will influence means it will change the decision of the users of financial statement, then it is material. Materiality is determined on the following factors. Now, there are certain factors on which materiality is determined. Individual, you will see individual amounts whether they are material to you or not. So for example, a payment of 1000 rupees may be material in small business, but even 1 lakh rupees could be immaterial for big business. So 1000 rupees for a small business is a big amount. It is a material amount. For big business, 1 lakh rupees is also not a material amount. So if there is a misstatement to the extent of 1 lakh rupees in big business, auditor might choose to ignore this qualification. However, in a small business, auditor will give this qualification if even 1000 rupees error is there. What to talk about 1 lakh rupees error? Then aggregate. Now, you also have to see whether the aggregate of all the misstatements put together become material or not. So for example, if you get a 1000 rupees error, you don't have to ignore it saying ये तो बहुत छोटा सा amount है. You don't have to ignore it. You have to write it on a audit notebook or in a Excel sheet. You have to total all the errors which have been done during the year, and if those errors are above materiality, so suppose 1000, 1000, 1000, 1000, many 1000s are there, and they total up to 10 lakh rupees, then what will you do? You will definitely highlight this error in the audit report. So if the individual amounts aggregated together are above the materiality threshold, then they become material. Next, legal considerations. Now, sometimes they are statutory or legal considerations which are there, which makes a particular item relevant. Although in monetary terms they are not relevant, but because of the legal restriction of statutory requirements, it makes that particular transaction relevant. For example, where the terms of appointment of whole-time director are not according to law. So law has prescribed the remuneration of the director. If the remuneration is not according to Companies Act 2013, then what will happen? The remuneration paid to him is material item, even if financial implication is not much. Even if the amount is minuscule, but since you have defalcated in the Companies Act 2013, it's a big problem. You as an auditor have to report it in the financial audit report. Then legal definition. It may be defined or described in law itself. So if there are certain errors which are defined in law, that these errors are to be disclosed mandatorily by the auditor, irrelevant of the amount. So for example, while doing tax audit, any TDS default is to be highlighted, whether it's of 1 rupee or 1 crore rupee. While during the statutory audit, you have to disclose the statutory dues which remain unpaid, like excise duty, like income tax, whether it is 1 rupee or whether it is 1 crore rupee. So if it is legally written somewhere that this item is material, then you have to treat it as material, whether the amount involved is 1 rupee or 1 crore rupee. That transaction becomes material if it is legally written somewhere. Then relative overall impact. You have to study the relative overall impact of the transaction also. So for example, if you have revenues of say 1000 crores, in those revenue there's a error in 1 lakh rupee of revenue, then 1 lakh rupee as compared to 1000 is too minuscule to be highlighted. So if your errors are relatively small, 1 lakh rupees in itself is a big amount, but as in relation to the overall scheme of things, it's too small. In that scenario, you may choose to report that particular thing or not report that particular thing. Then qualitative impact is very important impact. Qualitative impact means that financially it might not impact you, but in essence it is impacting you, like your going concern assumption is getting failed if you are not disclosing this particular transaction. So for example, if a company has applied to High Court for a winding up proceedings, then financially this year is okay, financially there's no impact in this year, but in future going concern assumption is at default. In this situation, you have to disclose this item qualitatively and not quantitatively in your auditor's report. Then insignificant quantities but special context. This is a very important thing, guys. It may be of insignificant quantity otherwise, but material in special circumstances. For example, rounding off to nearest rupee of fraction of 666 to 67 in the computer software. It may be material in future due to cumulative effect, even if insignificant now. So if you keep on rounding up, then this amount will become big in future. If you have already feeden up in the accounts in the software that 66 should be taken as 67.67, then it will have a triple down effect, which means it will multiply as it goes forward. So this is, although individually insignificant, but it will have a large impact in future. So this is a material item, even if individually it is an insignificant item. So these are the materiality considerations. You have to really learn them well, because materiality is not a amount thing. It may be a qualitative thing, it may be a cumulative amount thing, it may be a legal thing. So many things denote materiality. Materiality is not one thing, but many things denote materiality. But ultimate aim is that if the stakeholder's decision is altered by this transaction, then that transaction is material. This is the ultimate threshold which is to be seen by the auditor while computing materiality. Okay, accounting concerns. I am leaving accounting assumptions and accounting principles because these are too basic. You have to of course read them because they come in examination quite often, and these are the questions which we are skipping. Now we come on to the last aspect of our chapter, which is types of audit, and a very important aspect, guys, because in examination this topic along with miscellaneous audit, which we are going to do in our last chapter, these two topics are frequently recurring in the examination. So this topic is really an important topic. What are the types of audit? Okay, so as I've already told you that audits may vary from their perspective in which audit is being done. So for example, an income tax act would want an audit which caters to only income tax avoidance transactions which are there in the financial statements. Cost audit would focus on the cost records wherever there's an error in preparation of cost records. GST audit will focus on the transactions where GST are applicable and GST is not appropriately levied, or the rates where rates are not appropriately levied. So depending upon what is the focus of a particular audit may be categorized in different category. So now we are going to study what kind of audits are prevalent in India and entire world, and some are relevant to statutory provisions, some legal aspects, and some are not relevant to legal aspects. Some audits are done just for our benefit, and some are done because we have a danda from statutory authorities. That's why some audits are done. But there's a mixture of audit, whole gamut of audit which are there in India as well as abroad, and we are going to study what are those types of audits. All right, so organization structure. On the basis of organization structure, how are audits organized? On the basis of kind of organizations which they cater to, the audit can be divided into three parts: voluntary audit, private audit, statutory audit, and government audit. Guys, voluntary audit or private audit is audit of entities like sole proprietorship, partnership firm, LLP, NGO. Statutorily, there is no law to get these firms audited. Income Tax Act, yes, prescribes audit beyond a particular threshold, section 44, but otherwise there's no law which prescribes audit for a sole proprietorship, partnership, LLP, NGO. So these come under the category of voluntary audit. Voluntary means suo moto. Suo moto means on your own will. If you want to get audit done, please get audit done. If you don't want to get audit done, don't get audit done. This is known as voluntary audit or private audit. It is not bound by any legal constraint. It is not bound by any law, by any act. These audits are audits which are done suo moto for your own purpose. There is no binding authority which is requiring you to do these audit. These are known as voluntary audit. Number two, statutory audit. Statutory audit are prescribed by some act like Companies Act, like Income Tax Act, GST Act, and these are necessarily to be done for those particular aspects which the act requires you to do. For example, Companies Act prescribes you to get your books audited if you are a company registered with the Companies Act mandatorily by a chartered accountant, and a cost accountant if you are eligible for getting cost audit done. So statutory audit is relevant to particular act or particular legislation which requires you to get the audit done. Government audit is done for the government companies which are covered by which are governed by government authorities, or where there is stake of government authorities in a particular company or a particular unit. So those are government audit, and government audit is done by a CAG. There's no act to it, but CAG governs the audit of a government company. CAG appoints the auditors, and CAG fetches the report of a government audit. So on the basis of organization structure, what kind of organization are you? We have these three types of audit. Now, objective. What do you want to audit? Whether you want to audit financial statements, cost statements, internal controls, legal compliances, Companies Act compliances, GST compliances, Income Tax Act compliances. Depending upon what is your objective, there are several types of audit. Number one, independent financial audit, which is focused for financial statements, and of course a chartered accountant is authorized to do financial audit. Internal audit, which is focused on operations of an entity plus compliances with law. Both things are there in internal audit. Cost audit is concerned with auditing the cost records of a particular company, so that is cost audit. Management audit is concerned with the audit of decision making of a management. Decision making, that is the purpose of management audit. Tax audit is relevant for Income Tax Act and ensuring whether any tax avoidance has happened or not. Secretarial audit is for secretarial books. Now, company secretaries are required to maintain books of accounts of a particular company which are relevant to secretarial records, which means that board minutes, register of meetings, annual general meeting, whatever legal formalities are there in annual general meeting, then the resolutions which are passed, copy of resolutions, all these things are to be required to be prepared and kept by a company secretary, and company secretary is authorized to conduct the secretarial audit of a particular company. So that is secretarial audit. Forensic audit, as I have already discussed, investigation. If some fraud has taken place in a particular company, or some cash embezzlement or some siphoning off of assets have taken place in a particular company, which are not normal accounting frauds, but these are criminal frauds where some kind of net worth is eroded of the shareholders. In those cases, forensic audit are ordered, and these focus on a particular fact or a particular pattern or a particular area to investigate upon that particular area. Then information security audit, this is like audit of data. You have data secured in your drives, in your hard drives, in your servers, your Google drives. So company have huge amount of data within them, and to ensure that this data is not leaked, this data is not corrupt, this data is not being transferred for some bad purpose, information security audit is done by companies. Then social audit. Now, giving back to society is one of the very important elements which has also been recognized by the Companies Act 2013, whereby a principle of 2% of profit, net profit, has been allocated to CSR activities. Social audit means getting an audit done of a particular organization from the view whether that organization is giving back to society appropriately or not, whether that organization is giving its best to protect the resources of the society like air, water and soil, whether that particular aspect is taken care of by the auditor, by the company or not. That aspect is focused on social audit. Then environment audit. Environment audit is particularly related to environment in which organization is working at, and whether the company is polluting environment or not, protecting environment or not from any of its waste, hazardous products or not. So this is environment audit. Then performance audit. Of course, every company needs performance. Performance include two things. One, efficiency. You should be efficient in your performance, and second is effectiveness. You should be productive in your performance. So performance audit means an external third party will come in the organization and it will check whether the resources are fully exploited to the best possible use or not, and whether the performance of the company is best or not. This is known as performance audit. Then comes propriety audit. Propriety audit is nothing but prudence audit. Prudence audit means, I'll give an example to explain propriety audit. You go to a private company board of directors have ordered glasses worth rupees 50,000 each for board meeting proceedings to drink water. They want crystal glasses which are imported specially from Italy, and they will cost 50,000 rupees per glass, which means a set of 6 glasses will come for 3 lakh rupees. Now tell me something. If the company furnishes you the invoice, if the company deducts TDS properly, if the company shows you the bank statement through which payment is done, company shows you that bank statement appropriately, would you raise any finger on the company? Answer is no if it is a private company. However, if same expenditure is happened in a government company and you find invoice, TDS and everything else in place, even then you will raise finger on the government company, because government company includes public funds. Since government company includes public funds, you cannot afford to have imprudent expenses. Prudent means rational. Prudence means to the best interest of public. So in case of CAG audit, government audit, that audit is propriety audit. Propriety means samajhdari. Samajhdari means rational application of mind, justification. That is known as propriety. And if government is not prudent in its spending, then auditor will report that particular spending in its auditor's report. So propriety audit is government audit, which is CAG audit. CAG audit, and it refers to prudence of a particular person who's doing the expenditure, and a person should behave responsibly if public money is involved in this particular entity. Then operational audit. Operational audit means you are trying to do audit of the operations of a company, which means that whether all the operations are completed properly, adequately or not, and whether profits are generated from that operations adequately or not. I'll give you an example. So a company purchases raw material 1 kg in the morning, truck comes, half truck is loaded with 1 kg, and in the evening 1 kg again comes and half truck is loaded with 1 kg of the raw material. Now as an auditor, I would go and I would tell them, why are you buying half of the truck in the morning and the evening? You should buy the entire 2 kgs one time during the day. That will save upon your transportation cost. You are currently incurring double the cost. This is operational audit. Whether the company is performing its operations to the best possible extent or not. That is the question which is asked in operational audit. And let me tell you, internal audit and operational audit are almost similar to each other. They go hand in hand, because internal audit has one of the most important component as operational audit, because operational audit is a key aspect of internal audit. So these two audits are equivalently to be seen, they are equivalently to be analyzed. Next is timing. On the basis of timing, you can classify your audit. So some audits happen at the year end, some happen during the year, some happen continuously. So depending upon what is the time period of audit, you can classify audit as continuous audit. Now I'll tell you another name of continuous audit. It is also known as concurrent audit. And this is a special feature of banks. So guys, what do bank do? Bank would grant loan to people who need loans. Now loan is granted on the basis of credit worthiness. If you are credit worthy, if you have assets in place, full assets in place whereby you can take loan on the basis of those assets, then bank will grant loan to you. Simple. So your credit worthiness will decide whether you are eligible for loan or not. Simple. So a manager would analyze, bank manager would analyze the loan amount and would scrutinize the assets. Suppose a client's assets are worth rupees 2 crores and management says that the management of the bank says that you should give loan up to the extent of only 50%. So the loan which is to be granted to the person is 1 crores. Now manager and that person have a deal the person says, you grant me loan for 4 crores, ignore my net worth, grant me loan for 4 crores and I will give you 10 lakhs as bribe. So if the branch manager is not an honest one, he will take bribe of 10 lakh rupees and he will grant a loan of 4 crore rupees to a person who deserves a loan of 1 crore rupees. What will happen? If such transactions are allowed to prosper, bank will subside, bank will shut down, because bank will not be credit worthy. Bank in itself will be illiquid. Bank's liquidity will be compromised. To avoid such a situation, the auditor is asked to audit the transactions in a bank in a more frequent manner, which means auditor should come every week and see the transactions which have happened in the past week, and not at the year end. Because if auditor comes at the year end, it will be too late. The bank manager would have done many such frauds. So to avoid this, concurrent audit or continuous audit is done for banks, whereby banks auditors are required to visit banks every week or every month and close the audit there and then. Next, annual audit. Annual audit means you come at year end and you finish the audit. 31st March is the last date of financial statements closure. The auditor is asked to come by say 10th of April and to do audit in one go. This is known as annual audit. Then interim audit. Interim audit means if the auditor says that it will be bulky for me to come at the year end and do the entire audit together. So auditor is asked to first come after 6 months and freeze the accounts of 6 months, do audit of 6 months. Then come at the year end and do audit of the balance 6 months. This way, auditor will cover the entire 1 year period, and auditor will be able to do audit of the entire period, and auditor will in less amount of time, short span of time, will be able to complete audit fully. So this is the concept of interim audit. Then last is the concept of balance sheet audit, which is also known as final audit. It is guys similar to annual audit, whereby one time the balance sheet is closed and only one time the accounts are audited. That's it. There are no two splitting up of the accounts. There are no splitting up of the financial statements. They are audited at one go, and which is the balance sheet date. So 31st March is the closure date. Auditor would visit by say 5th of April or 10th of April, and that is when auditor will finish the audit. Then on the basis of scope, what is the scope? What is the extent of work which is required to be done by the auditor? On the basis of scope, we can divide the audit into 3 parts: complete audit, partial audit, and detailed audit. Complete audit means the audit is done of each and every account head and no account head is left. There can be some immaterial account heads which are very small, and those account heads may be left, but otherwise entire financial statements are audited at one go. Partial audit means that entire financial statements are not audited. Only the selective financial statements are audited. Only the selective account heads are audited. So management might choose that these are the account heads which we want to get audited, and management might get the audit done for those account heads only. This is known as partial audit. And if a auditor is doing partial audit, then one thing which is to be remembered is that auditor should mention that this audit is a partial audit in the auditor's report. Auditor should also mention that I have completed audit only of these account heads, and I have not done audit of complete balance sheet and complete financial statements. This is known as partial audit. And third, and one of the most important types of audit are detailed audit. So guys, in case of mergers and acquisition deal, due diligence is required to be done. Due diligence means you go beyond auditing procedures. You actually employ investigation procedures and see whether everything is all right or not. Now I'll tell you what do you mean by mergers and acquisition. Now if say company A is being acquired by company B, company A is being acquired by company B, then company B has to pay some purchase consideration to the shareholders of company A, and that purchase consideration will be determined on the basis of financial statements of company A. Whatever assets company A would have, the purchase consideration would be equal to those assets which company A has. So now an auditor from company B will go to company A to ascertain clearly whether company A has any assets on, and what is the value of that asset, whether company A has disclosed proper liabilities or not, because net assets value will be taken as the purchase consideration. So you will determine whether assets are complete or not, and whether assets are valued properly or not. You will determine whether liabilities are disclosed properly or not, whether any liability is to be additionally put in by the company. So this is a detailed review. This is not an audit. This is a detailed review, which is also known as due diligence. So if you are doing a special purpose audit which involves a due diligence in a merger and acquisition deal, then you are categorized under the third type of audit, which is detailed audit as per the scope. So these are the types of audits, and whatever I have explained you is given in short in the subsequent paragraphs, and you can just read them, go through them, and I'm sure you are able to understand them properly. With the explanation which I've given you in brief, you will be able to understand all these aspects of audit. And please do not hesitate in writing to me through Telegram or through a comment in the YouTube itself below this video, and I'll be able to explain you in detail. If you are not able to understand a particular aspect in detail, I will definitely explain that particular aspect in the detail, and my number is available to you, and you can call me in case of any doubt in this particular chapter. So in our next session of the marathon, this is part 1. In the part 2, we will continue with our marathon and quickly revise the next chapters of your syllabus. Till that time, all the very best and happy studying.
Hello and welcome guys, and welcome to the second part of the audit marathon. And in this part we are going to start second chapter of our syllabus, and second chapter, as you can see, holds consistently of 5 to 6 marks in the last 3 examination. And before that, this chapter has been coming for even more than 5 to 6 marks. It has been coming for 8 marks, and yes, it is an important chapter because it deals with audit engagement, audit program, audit working papers, audit notebook, audit evidence, and audit report. So in a nutshell, this chapter includes all the documentation which is required to make any which are required to be made in any audit since its inception. So this is the starting point of an audit, and this is the ending point of an audit. So all the documentation which is required to be prepared since the beginning of the audit to the end of the audit is noted in this particular chapter. And mind you guys, documentation is one of the most important areas of audit, because if you are not able to prove before the authorities the kind of audit which you've done and the substantial evidence which you've gathered, you have to demonstrate them by way of your evidences, which are documentary proofs only. So documentation is one of the most important elements of any audit. So let's start our chapter with the first documentation which takes place in any audit, that is audit engagement letter. So guys, what is an audit engagement letter? Audit engagement letter is a written agreement between the auditor and the auditee, in which all the terms and conditions of the audit are recorded. So whatever is being agreed between the auditor and the company, all those things are to be recorded in the engagement letter. For example, the scope of audit. What is auditor supposed to do? What is the fees of audit? I mean, what auditor will get after the audit is done? All these things are particularly noted in the audit engagement letter, so that tomorrow the client should not be able to contradict the auditor's view of demanding a particular fees. The client should not be in a position to say that auditor should have done this thing as well. So to give you an example, auditor is not supposed to prepare the financial accounts or cost accounts of a particular company. Now, if this particular aspect is clearly written in the engagement letter, then tomorrow client will not be able to say that you were supposed to prepare the cost record as well. Please do the cost recording and then you should do cost audit, or same goes for financial audit as well. So this written agreement will contain all the minute details, all the responsibilities which an auditor would entail, and all the things which auditor will assume, all the responsibilities which auditor will assume during the course of audit, including his fees, his restrictions, his area of work. If any scope is limited, so that scope will also be written in the engagement letter. So all these things are made in writing by the auditor and the auditee, so that no dispute arises at a later stage. So let's see what is the definition of engagement letter. The engagement letter is the auditor's contract or agreement with the client or the entity which is being audited. So whatever entity is being audited, for example, if you are doing audit of say ABC Limited, then your agreement with ABC Limited will be defined under the engagement letter. And the engagement letter is the starting point and oftentimes the ending point for the relationship. Yes, so engagement letter is the starting point because it enumerates when the audit will start, when the engagement will start, when will the client give all the details to the auditor, when will auditor start its work, when will auditor end its work, what is the audit report timeline. All these things will be written by the auditor. So starting point of an audit is definitely audit engagement letter, and the ending point of the audit, which means what fees will auditor charge, when will auditor issue its audit report, and whom will auditor issue its audit report. All these things are also written in the engagement letter. So the ending point, the last point of the audit is also audit written in audit engagement letter. Audit report is often the last aspect of any audit. And audit report, what format of audit report will be there, when will audit report will be issued, to whom will the audit report be issued, all these things are also written in engagement letter. So the starting point and the end point of any audit is audit engagement letter. Audit engagement letter is given by the auditor to the company. So guys, both auditor and the auditee signs the audit engagement letter. But yes, the audit engagement letter is prepared by the auditor and it is given by the auditor to the client, who signs it and sends it back to the auditor, explaining the scope of work, duties and responsibility of auditor and that of management of the company. So as I was mentioning, that this engagement letter will clearly communicate or clearly mention that the responsibility of preparing the financial statements will be of the management of the company and not the auditor. This will be clearly written in the engagement letter. So yes, many things are obvious, but in legal world, even the obvious is to be stated. It has to be in writing, it has to be in black and white, otherwise no one will follow it. So we have to state the obvious and the not so obvious things in the engagement letter. So what are the constituents of engagement letter? What all things will be covered under the engagement letter? First of all, it will be objectives and scope of engagement. So what is the scope of engagement, which means what type of audit is to be conducted for the client, whether it is GST audit, whether it is income tax audit, whether it is financial audit, whether it is cost audit, what kind of audit is to be done and under what law is this audit to be done. So I have explained you in first marathon part as well that audit can be done under various laws like Income Tax Act, like Companies Act, like GST Act. So which law are you referring to while you are doing this particular audit? This is to be stated in point number 1, which is objective and scope of engagement. What is the objective of engagement and what is the scope? What all accounts are to be seen? This is known as scope. So whether cost accounts are to be seen or financial accounts are to be seen or tax related books of accounts are to be seen or GST books are to be seen, what is to be seen? This is clearly mentioned in the engagement letter, so that tomorrow the client should not come back to the auditor and say, Mr. Auditor, you have done the cost audit of our company, you have audited the cost records. I wanted you to audit the GST records as well. Why didn't you audit GST records? Then auditor should have a shield against the client to prove that the agreement was only done for cost records and not GST records, and hence only cost records have been audited by the auditor. So this is the first point of engagement letter, which is objective and scope of engagement. Second is auditor's responsibility. What is the responsibility of the auditor? Guys, the responsibility of the auditor is to depict a true and fair view, to create an opinion and express an opinion on truthfulness and fairness of the accounts. The responsibility of any errors and frauds in the accounts is the secondary objective to find out those errors and frauds is the secondary objective of the auditor. The first objective is just to express an opinion whether the accounts are prepared fully as per the required law or not. That is the primary objective and responsibility of the auditor. So auditor will clearly state that my responsibility is to express an opinion. I will neither prepare books of accounts nor will be responsible for digging out any fraud kind of a situation in the company. But yes, if during course of audit I am faced with some fraud, then I will intimate it to the client's management. Do you remember, guys, in part 1 we had studied that investigation and audit are two different things. So fraud is to be investigated. So auditor's responsibility is not to investigate upon fraud. If any fraud kind of a thing is found out by the auditor, then he should simply express it or disclose it to the management. That's it. There is no other responsibility of the auditor with respect to fraud. So this is the second point, second constituent of engagement letter, that the auditor's responsibility is stated in the engagement letter. What is the work which auditor needs to do and for what things will the auditor be liable. Then third point is management's responsibility. So the engagement letter should also contain management's responsibility, which means that whatever things management needs to do. So for example, thing number 1, very obvious, that management needs to prepare the financial statements. So the first responsibility of the management is to prepare the financial statements. This responsibility is clearly stated in the engagement letter. Second responsibility is to have checks and balances within the system so that errors and mistakes are avoided. These are known as internal controls. So in the subsequent chapters, we will study this concept of internal controls, which is employed by the management. So management should clearly take the responsibility of the operational aspect of its organization. So it should be clearly mentioned in the engagement letter that the management should take care of the internal operations and internal controls of any of its organization, and the auditor's responsibility is just to check whether those controls are working fine and whether the systems are working to the appropriate standard or not. But to record the books, to record transactions truthfully in the financial statements, to maintain a good ERP system, to have a strong checks and balances over the financial statements, the responsibility lies only and only with the management. Auditor's responsibility is just to express an opinion. So we will write clearly about management's responsibility in point number 3. Point number 4, existence of inherent limitations of audit. So guys, as we have studied that auditor has a very limited tenure, very limited time to complete the audit, which means auditor might have just say a few days to complete audit. In such a short span of time, it is not possible for the auditor to review or to check 100% of the transactions. In such a case, the auditor should take help of techniques like sampling. He should sample test check certain transactions to ascertain whether the entire gamut of transactions or the entire family of transactions is fine or not. 1-2 transactions can be tested. This is known as test check, which is also known as sampling. Now sampling comes with its own problems. Problem is that sampling in itself has a limitation that the samples which are not picked, they run a big risk of being erroneous or being mistaken. So the auditor is running a risk of expressing an inappropriate opinion. Why? Because he is doing audit on the basis of sampling, and it is not possible for any auditor to completely check 100% of the transactions, because transactions run into lakhs and lakhs of number. So the engagement letter should express this limitation of audit, that audit is always conducted on test check basis, and due to its nature of sampling, the auditor is facing a risk, a consistent risk of being wrong in its opinion. So this is the inherent limitation of audit which should be expressed in the engagement letter. Management representation letter. Now this is a very important aspect of any audit, guys. Representation letter is to be taken from the management. So at this stage, at engagement stage, management should agree that it will issue a representation letter, and when audit finishes, the management should issue a management representation letter which should state that all the financial statements, all the procedures which are to be followed, like inventory counting, fixed assets counting, all these things are done by the management and they are personally supervised by the management properly. Now auditor cannot go and verify each and every transactions, each and every fixed asset, each and every inventory. Auditor cannot do 100% check. So to a very large extent, auditor has to rely on the internal controls which are established by the management. So in the MRL, which is the management representation letter, the auditor should take in writing from the management that all the transactions are being supervised and managed by the management well, and he should take it in writing that certain transactions like physical verification of fixed assets, which is not personally attended by the auditor, those kind of things are being done by the management senior staff. So this is known as MRL, and in the engagement letter, the management should agree that it will give MRL to the auditor at the end of audit. Next point is restrictions and limitations of auditor's liability. Now this is a very important point, and this point states that what is the financial liability which can be imposed on the auditor if anything goes wrong. So for example, if auditor's report does not mention about some loans which are faulty, some debtors, some loans which are given by the company which are shown as assets, they are faulty, they are irrecoverable, and the auditor misses upon this point and management also misses upon this point, then what should be the auditor's liability? As in, would auditor be liable to repay that amount of debt to the company? Can auditor be subject to monetary penalties if something goes wrong? That is known as the restrictions and limitations of auditor's liability. Guys, I have seen in my practical experience that auditors are always restricting their monetary liability to the extent of fees which is received by them from the management, and they do not accept any monetary liability over and above the fees which is received. So fees is the restriction which management has, limitation on auditor's liability which auditors generally accept in India. And guys, sometimes I have seen in US the trend is that the auditor accepts a restriction or a limitation of liability to the extent of 3 times of audit. So if audit fees is 1 lakh rupees, auditor is okay to undertake a liability on behalf of the client to the extent of 3 lakhs if anything goes wrong because of the audit report. So that is the clause which is known as restriction and limitations of auditor's liability. The next point is basis of computation of audit fees and billing arrangement. This is the most important point. Number 1, what should be the fees? Audit fees, what should be the amount of the audit fees? And billing arrangement means what is the timeline for payment of fees? So when should fees be payable to the auditor? Whether the entire fees will be paid at the end of the audit to the auditor, or the fees will be paid in parts, like half of the fees can be paid at the engagement letter signing date and balance half can be paid at the time of auditor's report when it is issued. So it depends on the mutual agreement between auditor and the auditee when the fees is to be payable to the auditor. Then form of report and other communication of engagement. What should be the audit report? What kind of format should it follow? How should it look like? Guys, generally audit report format is prescribed by the law itself, according to which audit is being governed. Like Income Tax Act has a specific format, 3CA and 3CB for the audit. Cost audit has a specific format which is form CRA 3 for cost audit. Then similarly, financial accounts audit, statutory audit has a specific format. However, there are certain audits which are voluntary audit, like internal audit. Internal audit does not have any prescribed format. And management audit does not have any prescribed format. So especially in those cases, the management and the auditor agree upon the format of the report, what kind of report will be issued. So this is the this is another aspect which is covered by the engagement letter. Then validity of the report. What is the validity of the report? Can report be presented to the statutory authorities? Can the report be, auditor's report be issued or given to governmental authorities? Is the auditor's report valid to be produced for loan purposes, etc., etc.? So any restriction if auditor is wanting to place on the auditor's report with respect to its validity, then that should be written in the engagement letter. So for example, the auditor's report does not guarantee a safe future of the company. That future is very good, very bright. This is not a guarantee which is given by the auditor's report. So this should be mentioned in the validity section, that this report is valid only to the extent of financial accounts which are mentioned in the audit report. The need for use of services of internal auditors and other experts. So if during the course of the audit, the statutory auditor or the cost auditor needs to use the expertise of an external expert, like auditor is not a valuation expert, so valuation of the fixed assets should be done by a valuer. Similarly, auditor is not expert in knowing what is the work in progress stage of work in progress of inventory while calculating the value of inventory. So in that case also, the auditor needs a specialized person who can be useful to the auditor. So all these things are to be done by external experts, and wherever external experts are required, the engagement letter should contain specific need and specific clauses which discloses that what kind of specialists are required at what stages of the audit. I'll give you another example, guys. Actuarial valuation is required for provisioning of gratuity and leave encashment, and the actuarial valuation are done by actuaries and not by accountants or the auditors. So he's also an expert. So that should also contain a mention for the actuary in the engagement letter. So depending upon what kind of experts are required, we need to mention name of the experts which are required during course of audit in the engagement letter, so that client is aware of the experts and he makes necessary arrangement for the experts to come. Then limits on submission of report to other authorities. If the auditor wants to limit the free circulation of the auditor's report, then auditor can do it via this clause. So sometimes some reports are very confidential. For example, cost audit report is a report which is very, very confidential because it contains the secret of the company, like what kind of raw material is being used, what proportion of raw material to raw material is being mixed to produce a particular product. These are very sensitive information. So the cost audit report is not to be floated freely amongst anyone and everyone. So if an auditor needs to put some limit on submission of audit reports to authorities, then auditors can do so by this clause. Auditor can specifically state that we are issuing this report, but you should not disclose this report to so and so person or to any bank or to any other person, third party. Usually this restriction cannot be made for governmental organization, because if governmental organization wants any part of audit report, then that cannot be denied by the company. So usually it is not for government parties, but it is for some private parties like banks, or like these reports cannot be used for taking loans. Sometimes auditor can put a restriction on taking loans, etc. So we should be careful in drafting this clause. An auditor can restrict its liabilities using this clause, which states that limits on submission of report to other authorities. On the next page, a specimen of engagement letter is given for all of you, and considering the time which is left for the examination, you can easily skip the specimen copy of the engagement letter. This is just for your knowledge, guys, and in exam there might not be a question which will ask you to create or draft an engagement letter, so you can easily skip this engagement letter. So I am also skipping this engagement letter. You can read it after your examination, but currently you can skip this entire engagement letter. And I am coming on to the next topic of benefits of having an engagement letter. So what are the reasons because of which engagement letter is signed between the client and the auditor? The reasons are very, very clear. There is no ambiguity of terms, what has to be done by whom, whose responsibility is there, who is liable to what an extent, what kind of work is to be done, which laws are to be followed. All these things are written in black and white inside the engagement letter. So the very first benefit of having an engagement letter is to avoid confusion. There is no confusion, there is clarity of work, there is no ambiguity in the objective and scope of an audit. So the first objective, the first benefit of having an engagement letter is to avoid confusion. Second one is to define the responsibility of the auditor and the management, who is responsible for what, who will do what, and the liability will be restricted to what extent. All these things are defined in the engagement letter. So the responsibilities of an auditor is clearly demarcated in the engagement letter. Then third is it protects the interest of the auditor against the allegations of professional misconduct. Guys, this is the biggest threat which any auditor can have, which is allegation of not performing his duties well, because the Institute of Chartered Accountants of India, Institute of Cost Accountants of India are the regulatory body to regulate the audits of both kinds, statutory audit and cost audit. So tomorrow if a cost accountant is found to be negligent of his professional due diligence, professional care and his professional duty, then he might be reprimanded, or he might be prosecuted, or he might be devoid of his degree, CMA degree and CA degree. So if an auditor wants to prove that yes, the kind of work which he's done under the engagement letter. So I'll give you a simple example, which is a real life example which happened in one of the companies. So the management of the company asked the auditor to not to audit certain type of expenses. Now those expenses were forming a key part of the financial statements, which is the profit and loss account. Still the management asked the auditor specifically not to perform any audit procedures on those particular expenses. The auditors wrote this fact in the engagement letter that the management has denied me to perform these activities and perform these procedures, and the audit was carried on. After 5 years, 4 years or 5 years, there was a major fraud which was detected in those expenses, and auditor was asked as to why didn't he perform any audit procedures on those expenses. So he had a simple explanation that the management had restricted me to do so, and the engagement letter was also evident of that fact. So the court held that the auditor was not negligent in his duties. So just because auditor took care of writing the fact that he was restricted in his scope of work, he was not reprimanded, he was not convicted of any professional misconduct. So if a auditor wants to protect himself from any kind of allegations in future, then he has to clearly write his scope and objectives and his entire scheme of doing the audit in the engagement letter. So these are the three benefits of having an engagement letter. It avoids confusion, it defines responsibility, and it protects interest of the auditor. Next topic, which is a very, very important topic, is audit program. Guys, audit program is nothing but planning. So whenever you go on a vacation, or you go to meet your relative in another city, or you want to visit some far-fetched place, then you make a plan. Plan as in you decide how will you get there, what kind of conveyance will you use. Will you use your bus, or will you use your car, or will you use the train which is existent in your city? What will you do? So Planning is essential for any and every element of life and work. Similarly, planning is also essential before an audit, because if there is no planning, then that activity will be done in a chaos, in a chaotic manner, and not in a systematic manner. It will all be haphazard. So to avoid this chaos, we need to plan even audit procedures, who will perform the audit, how many staff is required, how many days are required, what kind of financial statements are there which are to be audited, which account head is to be audited and which is not to be audited. So all these things require careful study and planning before this audit commences, because if audit commences without planning, then no one will be able to understand their responsibilities and everything will be in a chaos. So audit program is that document which will which will ask the auditor to write its plan of auditing before the audit starts. So audit program is nothing but an audit plan which is written on a piece of paper. It is a very strong evidence of documentation of what the auditor proposes to do and what the auditor actually does in an audit situation. So let's read the definition of audit program. An audit program is a detailed plan of auditing work to be performed, what work is to be performed, then what procedures are to be followed for verification of each item, estimated time required, how much time is required, estimated resources required. Resources means how many people are required, how many laptops are required, how many trainees are required. So these three things are there in an audit program. Audit work, what audit work is to be done, how is it to be done, that is the procedure of audit work, how much time will it take, and how many people will it take. These four things constitute an audit program. It is the description or memorandum of work to be done during an audit. Audit program serves as a guide in arranging, distributing audit work as well as checking against the possibility of omissions. So audit program not only is helpful in planning your work and systematic doing your work, it also helps you to avoid any omissions. So if you have written all the audit procedures in a document, then you will be reminded of those audit procedures again and again and again. So the chances of missing out on anything reduces if you have a detailed audit plan. So possibility of omissions are also omitted due to the audit program. Now I've given a sample of an audit program of, say, salaries and wages, an account head which is salaries and wages. What will it have? It will list down who will prepare this, who will audit this particular head, who will review this head, what head is there, which year is there, then what are the procedures which are to be followed, like verify the payroll is reviewed, authorized by the senior person, you have to verify it. Then work paper reference, you have to mention the number of work paper, the work paper reference which proves this point which you have verified. Then reviewed by and due date, here you need to put your signatures and you have to put the date on which you have performed this audit procedure. Coming on to the next one, confirm computation of wages. Computation of wages to be computed. Then again working paper references to be given. Then you have to sign whatever whosoever has done this audit procedure has to sign over here. Similarly, other procedures are carried out in an audit program. So audit program is a list of procedures, list of the aspects which are to be seen in an audit, and it is very, very important to have this kind of an audit program before an audit starts, because a proper planning will ensure that audit goes in a smooth manner. Then what kind of audit programs are there? There are two kind of audit programs: common audit programs, which are common to all types of audit. Like there are certain basic things which are necessary in every audit, like secretarial books are to be seen in every audit. So audit program will definitely have secretarial books for all the companies, because secretarial books are required to be maintained by all the companies. Then there are some special audit program. These are audit programs which are specific to a particular audit or entity. Now these audit programs are not general audit programs, these are specific audit programs, and they are to be applied only for certain type of entities. Like partnership firm would contain step for checking for profit sharing ratio. Now this step will not be there in a company. So the program which asks you to check the partnership firm's profit sharing ratio, that audit program is a specific audit program. And what is a common audit program? An audit program like checking of secretarial books of accounts. is like common audit program. It is audit program for all the companies which are registered under Companies Act 2013. Now, what are the advantages of audit program, guys? You tell me, what are the advantages of planning? If you plan your studies, if you plan your vacation, if you plan anything in your life, what is the benefit of having a plan? Simple. It makes your works easier, it makes your work systematic, it ensures timely completion of work, it ensures that you do not miss out on anything, it ensures that your responsibilities are fully aware, people are aware about their responsibilities, and the work is done in a proper manner, in a timely manner. These are the benefits of a plan. Similarly, audit programs benefit are also similar. So what are the advantages? It is a checklist for audit procedures. So to ensure that nothing remains, nothing is left out in a particular audit program will have a checklist, and that checklist serves as a proof that nothing has been left out in an audit. Audit work can be properly allocated, so you can know what work is to be done by which person. So allocation of work is done through audit program. Then extent of work, what is the extent of work which is already done? If audit program is prepared and it is signed on a regular basis, then whosoever looks at the audit can know what extent of work is already done in a particular audit. So it also serves as a supervisory benefit, because anyone who's reviewing the audit can come to know which procedures have already been done and which procedures are pending. Then it is good to fix individual responsibilities, because if some work is not done, then you know who had to do that work and you know whom to blame. So to fix individual's responsibility, to fix who has not done his work properly, you use the audit program. Then uniformity of work will be done in a uniform manner. So things which are common to every audit, that will be done in a uniform manner, and there will be no leftover, there will be no mistake, or there will be no dynamics in a particular situation which is a usual situation. So uniformity of work is a major advantage of audit program. Then it also serves as a basis for planning program of the following year. So once your audit is over for the current year, same audit program can be used for preparing the audit program for the next year as well, whenever audit comes for the next year, because largely the account heads will be same, the business of the organization will be same. So same audit program can be used for next year as well. Then it is also used as an evidence by the auditor to prove that he has done all the steps properly during an audit, and in future if someone puts an allegation on the auditor that he has not done anything properly, auditor can simply show his audit program and he can prove that he has done all the steps of the audit properly, and he has performed the audit with due diligence and absolute care. Then the last advantage is that team member and delegation of responsibility to them. Again, it is similar to the point which we had studied earlier, which is individual responsibilities. This point is similar to this point, that individual members are given the responsibility of a particular task, and they are also delegated with the responsibility of completing it. So if that work doesn't get completed, then the direct liability is to be fixed to that particular person, which means that it is easier to fix responsibility in case of audit program, if audit program is properly constructed. Now there are certain disadvantages of audit program as well. There are some problems with creating audit program as well. What are those problems? Those problems are auditor's task becomes mechanical, and auditor may lose interest and initiative. So guys, if you are instructed to do a particular thing in a particular manner, then sometimes you don't feel like inventing something new. You don't feel like having any creativity or innovativeness. You don't apply your mind. You just follow the checklist and just do things mechanically. So if a checklist is given to you, then there's a greater possibility that the auditor does everything mechanically and he does not do something which requires application of brain, and he would just follow the steps which are written in the checklist. In case there is no checklist, then the auditor has to apply his mind to do audit, and in that situation the benefit will be that there might be certain instances where something new comes out of the picture which is not there in audit program. So first disadvantage is that audit becomes mechanical, which means it becomes monotonous and boring for the auditor. So as a routine auditor does audit and not as a proper professional professional due diligence is not sometimes followed by the auditor. Second is that for small organizations, this audit program does not seems to be a good idea, because small organizations are so small that you hardly need any planning for completing the audit. So in case of small firms, small organizations, audit program is just a waste of time and waste of effort. You can just go over there and do the audit rather than preparing a audit program. Then audit program helps in fixing responsibilities, but inefficient staff may defend themselves by stating that matter was not contained in the audit program. Now assume a situation where an obvious thing has not been stated in the audit program. In that situation, the staff which is inefficient, the staff which is not so indulged in work, that staff will take that mistake of not having something obvious in the audit program as an excuse of not doing that thing. So if it is an obvious thing that it had to be done, then whether it is in the audit program or not, it should have been done. If it is not there in the audit program, then the audit staff will take it as an excuse of not performing that particular activity. So this is a drawback of an audit program. Then rigid audit programs cannot be laid out for each type of businesses. So every business requires a different audit program. That is also one of the shortcomings of the audit programs. Now we are on to the audit working papers, guys, and as I have already told you in the beginning of the chapter, that this entire chapter deals with the documentation bit of audit, and which is one of the most important aspect of any audit, documentation. So we have discussed about engagement letter, we have discussed about audit program. Engagement letter is the first step in audit. Audit program is the second step of audit, which is planning. Now the third step of audit is actual execution, and during execution we need to prepare audit working papers. These working papers should disclose the methods which are followed by us, the things which are followed by us to perform an audit. So these working papers are very, very important from a evidence standpoint. Evidence are created through these audit working papers. So audit working papers are record of planning and execution of an audit engagement. Auditors retain a set of working paper for each audit engagement for each year. Audit working papers should be sufficiently detailed to enable other auditor who is not familiar with the client to obtain an overall understanding of the engagement. So audit working papers should be made in a fashion that a person who is totally unaware about this particular audit is able to gauge the procedures which you have done to perform audit of this particular client. So these are the qualities of an audit working paper, and I have already told you that these audit working papers serves as a shield for the auditor. If in future he is alleged of gross negligence or misconduct, anything of that sort, if he is alleged, then these working papers prove to be his shield. He can protect himself from any such allegation. Purpose of audit working papers. What are the purpose of audit working papers? Planning and performance of an audit. So you plan and perform audit. Of course, planning is done through audit programs, which in short are known as APs, and performance of audit are done by audit working papers, which are known as AWP. Supervision and review of audit work is done through audit working papers and then serves as an evidence of audit work performed by the auditor. So whatever work auditor does, the audit working paper are the proof or are the evidence of whatever audit has been done by the auditor. And audit working papers are are discussed in Standard of Auditing 230 in great detail, and all the working papers which are to be maintained by the auditor are discussed in that Standard of Auditing. And let me tell you one more interesting fact, that audit working papers are property of the auditor, and the company cannot force the auditor to give the audit working papers to the company. This is the law, this is the directive which has been issued by the Institute of Chartered Accountants of India. Now, factors affecting type of audit working papers. So what kind of audit working papers are created? This is governed by the following factors. What are those factors? The form and content of working papers vary from audits to audits, and they are affected by the following matters. Number one, nature of engagement. What kind of engagement have you entered into? Is it a income tax engagement? Is it a cost audit engagement? Is it a management audit engagement? So every engagement will have a different type of audit working paper. Form of audit report. What kind of audit report is there? Is it a abridged audit report, or is it a detailed audit report? So if it is a detailed audit report, then working paper will also be detailed. If it is abridged audit report, then the working papers will also be abridged. So depending upon what kind of audit report has to be issued, your working papers will change accordingly. Nature and complexity of client's business. If the client's business is complex, then the working papers will also be complex, and vice versa. Then client's records, internal controls, and supervision of work performed by the assistants. These are other factors which will determine what kind of audit documentation will you have. Because so I'll explain you point number E, which is really important. So if an auditor is relying on the internal controls which are imposed by the management, then the audit working papers will be less rigorous. And if the auditor does not believe in the internal controls which are established by the management, then auditor will perform rigorous audit procedures. So the working papers will be much more in that case. So these are the factors which will determine what kind of working papers will you have. Then types of working files. So you must have seen files, the cardboard files or the plastic files which are used in offices. Yes, this topic relates to those files only, but those files which are maintained by the auditor. So auditor has to obviously if there are documents, then those documents are to be retained somewhere, are to be stored somewhere. And the best place to store the documents are files. We create files for the documents, and the files are then stored in the cabinets. So now audit files are of two types. There are two separate types of files which are used by any auditor. First is the permanent audit file, second is the current audit file. So guys, permanent audit file is the audit file which contains the documents which are used by the auditor year on year every year. So if an auditor is doing audit for a client for 3 years, then such documents which are used by him for all the 3 years are known as permanent documents. I'll give you an example. Memorandum of association, articles of association. These things are required by auditor every year, because he might refer to them for knowing the object clause or the activity clause or the profit sharing clause or the rights clause. He would require these documents every year for all the 3 years. So these documents will be placed in a file called permanent audit file, and this audit file will be used by the auditor for all the 3 years. Now there will be another audit file which is temporary audit file, current audit file, which will contain the documents for that particular year only, which means if the audit is being conducted for year 2019-20, then this current file will have all the documents which are related to year 2019-20. This file will not have the documents which will be relevant for the year 2021. This will only have the documents which are relevant for 1920. For example, accounts, ledger accounts. So guys, ledger accounts are required for only 1 year, because you prepare a ledger account for 1 year. Then for the next year, there will be a new ledger account. So the old ledger account will not be used next year. So ledger account is an example of a document which will be used only in the current year, and hence it will be kept in current audit file. So auditor need not carry the current audit file in the subsequent years. he can just store the current audit file in his office, and he just have to carry permanent audit file for each year of audit where he is appointed as the auditor. So this was the broad difference between permanent audit file and current audit file. Now let us go through the differences in detail. It relates to more than one accounting period. It relates to only one accounting period. It contains document related to organization structure. It contains document related to current year, like engagement letter, like board meeting, AGM meeting. Guys, all these documents are prepared afresh for each year under audit. They are not prepared once and used for each year. No, they are prepared for each year separately. And these documents are prepared for once and they are used in audit for each year. Then deficiencies in internal control are to be kept in permanent audit file, so that auditors of the future years are also able to understand what are the problems in internal control systems. Then assumption in management letter is to be is an element of putting it in current audit file. Significant ratios and trends are to be put in permanent audit file, and transactions for the year are to be put in current audit file. Significant accounting policies, permanent audit file. Audit program for the current year, only current file. Significant audit observations of prior years. So if there are major defaults which are found in the financial statements or cost statements of a company, then those defects or defaults are to be highlighted to the future auditors as well, so that they can lay higher emphasis on those areas. So to lay higher emphasis on those areas, they should be aware about those areas, and those areas are recorded in the permanent audit file. Then in the current audit file, the significant aspect of audit of that particular year which will not affect the future years are kept. So this is the difference between permanent audit file and current audit file. Guys, an important topic. It recurs in the examination a lot. So next topic is ownership or title to audit working papers, and I've already told you that auditor is the owner of the working papers, and it is auditor's prerogative if he wants to disclose or give the audit papers to the client or not. Institute of Chartered Accountants of India have released an advisory where they are saying that it is entirely auditors' discretion on whether they want to share their audit working papers with the client or not. So you cannot force an auditor to give his working papers. A client cannot force an auditor. So that is the law. Working papers are property of the auditors, and the portions or extract of which can be had at his discretion. The important words are at his discretion. Only if the auditor is willing to give out the working papers, then only can it give. However, if required by some legislation, if law is asking the auditor to give the working papers, then the auditor has to make working papers available to the regulatory authority and not the client. Again, the force is given by legislation, and legislation requires the auditor to give the working papers to the regulatory authority. I'll give you an example. So you must have studied assessment procedures in your income tax. When the assessing officer or the CIT appeals or the ITAT assesses your case and hears you out and decides whether you have paid the taxes correctly or not. Guys, in these proceedings, sometimes the assessing officers call upon certain documents from the auditors, so that the authenticity of the financial statements and the details of the financial statements can be vetted or verified. In that case, the auditor has to and must give the audit working papers to the statutory authority, which is income tax authority. In this case, auditor cannot deny giving the financial statements or the documentation which is required by the statutory authority. However, yes, if a company requires an auditor to give the audit working papers to them, then it is under auditor's discretion whether they want to give or not. These working papers should be kept in safe custody and in confidential manner for 7 years as prescribed by the Institute of Chartered Accountants of India as per SQC1. Guys, the next topic is an important one, which is the audit notebook. Now, during day-to-day working of an auditor and day-to-day operations of audit, sometimes a lot of things are communicated by the management orally and not in written. Management is very smart. What would management do? The things which are little dicey, the things which even management is not sure of, management would not give all these things in writing. They would give these things in oral. They would tell you that yes, this debtor is going to be bad, so we can create a provision for this bad debtor. Now it is auditor's responsibility to note down all these things in writing so that A, he does not forget the facts, and B, if tomorrow management refuses to accept the fact which they had stated, then the auditor can show the management his recording, and he can prove that management had said these words to the auditor. So basically, to gather proof, to gather evidence, the auditor always carries a notebook, a normal notebook, a normal register, just like you prepare register for your costing, for your income tax, a separate register for every subject. So that whatever teacher is teaching in the class, you quickly note down everything in the class. So those practices are also used in audit. Whatever is being said by the client which is not given in writing, all those things are to be written in the audit notebook, so that tomorrow audit notebook can be used as an evidence or can be referred to as a information provider. So an audit notebook is a bound book in which large variety of matters observed during the course of audit are recorded. Audit notebook is a permanent record of auditor, and it is a separate audit notebook. Audit notebook should be maintained clearly, completely and systematically. An audit notebook may be used as an evidence to defend the auditor against any charge against them. So again, same point guys, to defend against any charge, to act as a shield for the auditor, audit notebook is also one of the most important documentations which are there in audit. Then what are the contents of audit notebook? Name of the business is written, organization structure is written, MOA, AOA important provisions are written, communication with previous auditor. If previous auditor has given some communication to the current auditor, if he has given some hints on how the company is performing, what are the difficult areas, why did the earlier auditor leave, any such verbal communication which is done by the earlier auditor, they are to be recorded in audit notebook. Management representations and instructions, whichever management is giving verbally, all those things are to be properly recorded in the audit notebook. List of books and accounts maintained by the enterprise, accounting methods, internal control system followed, applicable laws, key managerial personnel. So who are the people who are responsible for taking key decisions with respect to finance, with respect to marketing, with respect to advertising? All those persons' name should be written in the audit notebook so that you can refer to it at a later stage. Errors and fraud discovered are to be recorded in audit notebook. Matters relating to explanations and clarifications, and here we specifically deal with the explanations which are given verbally by the management and not in writing by the management. Those are to be recorded in the audit notebook. Special point that need attention in the auditor's report. If any special point is to be discussed with the management in the auditor's report, then that point is also written in the audit notebook. Now comes a very, very, very important point, a very important aspect of your syllabus, which is audit risk. You can put a star, you can write very, very important, because in examination this topic is recurring a lot of times. Now what do you mean by audit risk? Now before discussing audit risk, I would like you to tell me, what do you mean by risk? What is a risk? So in simple word, risk means probability of not getting what you want. Whatever is your objective, probability of not achieving that objective is known as a risk. So now tell me, what is the objective of doing audit? It is to express a true and fair opinion on the financial statements of the company. This is the objective of audit, to express a true and fair opinion, that we auditor will express the validity of the accounts, the accuracy of the accounts. We will vouch for the accuracy of the accounts. That process of verification should be unbiased and should prove to be truthful and fairful. Okay, so truth and true and fair view is to be expressed by an auditor. Now what is the risk? That auditor does not express this true and fair view. That is known as audit risk. So probability of not achieving what you wanted to achieve, whatever was your goal, is known as audit risk. And in this audit risk, the most important audit risk is that the auditor expresses an inappropriate opinion, where the books of accounts are not showing true and fair view. There, if auditor certifies that books of accounts are showing true and fair view, then that is known as the misstatement which auditor has done, and there is a risk which is associated to any statement which is produced by the auditor, and that risk is known as audit risk. Now let's read the definition of audit risk. It is the risk of material misstatement. Material means important or major, and misstatement means mistake. It simply means if you have done something erroneously, if you have mistaken in doing something, of an item that is included in the audited financial statements of an entity. So audit risk is the risk that some important or major mistakes are left out, which are not pointed by the auditor in the financial statements. Audit risk is always greater than 0, so there has to be some kind of audit risk which is always there. There's always some risk of material misstatement, and audit risk may emanate from either fraud or error. Fraud or error are also two areas from which audit risk arises, because if there's a fraud happening in the company and the auditor is not able to detect that fraud, then it is a major risky area for the client and for the auditor, because then the auditor will express an inappropriate opinion. Yes sir. Now what are the types of audit risk? Now there are 3 types of audit risk: inherent risk, control risk, detection risk. And if we multiply all 3 of them, then it gives us audit risk. So if I apply a formula to audit risk is equal to inherent risk multiplied by control risk multiplied by detection risk. So what are these 3 risks? We are going to now study. Number 1, inherent risk. Now please understand what do you mean by inherent risk. Inherent risk means some risk which are already existing in an account statement, which will not be removed by audit procedures. Whatever audit procedures auditor can apply, he can apply, but those risks will remain in those account heads. The risk may be reduced to a certain extent by the procedures which are done by auditor, but majorly those risks never end. These are known as inherent risk. I'll give you an example. If there's a complex calculation of a particular expenditure, or there's a complex calculation of gratuity payment which is to be made, or leave encashment payment which is to be made, or provident fund payment which is to be made, if there is a complex calculation which is there, then there is an inherent shortcoming in that calculation, that it may be erroneous. If it is complex, so actuarial valuation is a very complex procedure. Even chartered accountants and auditors and cost auditors are not able to apprehend or comprehend what is written in the actuarial valuation report. So sometimes, due to complexity of an account head, there is an inherent risk of misstatement, which means mistake. Similarly, I'll give you another example. If now you are making a provision for bad and doubtful debts, now please remember that it is just a provision. There's a risk that you provide for an amount which is due to Mr. A as bad debt, but there's a possibility that after 2 years he pays back your entire money. So there is a risk in estimation. This is known as risk of estimation. Wherever you estimate, there is a risk that your estimation will go wrong. These are certain inherent risks which are existing in certain account heads, and this will always remain in an organization. And in an audit, an auditor cannot reduce the inherent risk to 0. It can just manage the inherent risk by doing his work efficiently. Let's read. It is the possibility of material misstatement in the either individually or when taken together with other misstatements, assuming that there was no internal controls. So either individually these misstatements are major, or when they are combined with other misstatement, they are major, they are above the materiality level, they are very, very important. So inherent risk is the possibility of mistake which can happen when there are no internal controls. If there are no internal controls, then this misstatement can happen. For example, complex calculation estimates again always run a risk of being materially misstated. Second is control risk. Now, what is a control risk? Control risk, I've already told you, internal controls means the check and balances which are put in by the management to ensure that the financial statements do not have error and fraud. So even before auditor will come to the organization, the management will ensure that its financial statements are built up in a proper way. To give that insurance, management has to build certain balances and checks and balances, certain controls, like one transaction will be done by one person and checked by another person. This will ensure that the organization is recording all the events and transactions properly. So control risk is the risk that these control might fail, because again a human element is involved in these controls. So if I give you an example, to have a control in the amounts which are deposited to bank, Mr. A is the person who hands over the cash to the person who goes to the bank, and the person who goes to the bank takes the cash from Mr. A and deposits it in bank. This way the cash is deposited using two people, so chances of misstatement is very less in this case. However, there is a possibility that those two people join hands. If they join hands, then the control will lapse and a fraud or error can happen. So control risk is the risk that if the internal controls are not followed properly, or they are not strong enough to prevent a mistake or a fraud, then that risk is known as control risk. So control risk is the possibility of material misstatement either individually or when taken together, which will not be prevented, detected, corrected on a timely manner by the accounting and internal control system. So these errors and these mistakes will not be controlled by the internal control systems or the checks and balances which are put up by the management. For example, weak internal controls may lead to misstatement creeping into the financials. So if you have an organization which has weak internal controls, then naturally its errors and probability of fraud and probability of misstatement will increase. Then there is detection risk. Detection risk means that due to faulty procedures adopted by the auditor, the error and fraud is not actually detected. So this is the responsibility of the auditor to ensure that the audit procedures are proper. Now everyone is human, guys. You are a human being, I am a human being, even auditor is a human being. When you will qualify and you will become a CMA, then of course you will be a human being first, and human being is prone to errors. So what is the probability that auditor performs an erroneous audit procedure which leads to a material misstatement in the financial statements? This risk is known as detection risk. Although this risk is very less, because all the auditors are very careful in their auditing procedure, but still there is this risk, which is detection risk, which means that your audit procedures are not sufficient and good enough to detect the errors or frauds in the financial statements. These are the three types of risks, and it is an important topic, guys. Let's come on to the next aspect, which is surprise checks. Surprise checks are the checks which are employed by the auditor out of nowhere. He would not inform the management of these checks, and he would suddenly appear from nowhere and do some checking work. So for example, cash balance which is kept in the factory may be checked suddenly by the management may be checked suddenly by the auditor, and auditor can ensure that the balance which is appearing in the cash book versus balance which is appearing in the books of accounts, those two things should marry. So I'll again repeat, the cash which is present physically in the management's cupboard or the safe, that should match with the cash which is appearing in the books of accounts. Those two things should marry. So the auditor should suddenly appear some day and ask management to show their cash or show their inventory or show their fixed assets suddenly. This will induce a surprise element in the audit, and this will the auditor will be able to understand if there are any weaknesses in the internal control. Because if the auditor tells the management before coming, then management would ensure that all the systems are working properly. So surprise checks are one of the important tools which are used by the management to ensure that the management's work is doing properly. Then factors which are to be considered while doing surprise checks. Guys, these factors can be done by you very easily. These are simple factors which are to be seen while doing surprise checks, nothing complicated. Then we come on to audit evidence, and of course you have already in the last chapter we had discussed the three elements of the audit evidence. First behavior pattern of audit evidence was it should be relevant, then it should be reliable, it means you are able to rely on them, then it should be appropriate or sufficient. These are the three elements of audit evidence. Audit evidence should be relevant, it should be reliable, and it should be appropriate. These are the precise features which are there for audit evidence, and audit evidence are to be put in the file, guys, so that the file contains the evidence basis which an auditor has given his opinion. What is the need of audit evidence? So to prove that what kind of work has been done, and to prove that the management's assertion, remember we had learned about assertions. Assertion means claims which a management personnel is doing over its financial statements. Like management would say that we have 100 crore worth of fixed assets. This is a claim or the assertion which is made by the management. As an auditor, I would want to find out the documents behind these claims so that I can comfortably comment whether the company has 100 crores of assets or not. So the first important part is that management makes assertion on various elements of financial statements. For example, the management may assert that it owns land and building worth 10 crore which are shown in the balance sheet. The auditor has to evaluate these assertions so that he would be able to express his opinion on the financial statements. Audit evidence provides auditor a reasonable assurance in respect of assertions made by the management. So whatever management is asserting means claiming. Evidence will prove the claims of the management. Now we'll tell you about what are the different assertions made by the management, what kind of claims are made by the management. Number one, existence. The management will say that my assets exist. They are not bogus assets. They are not just on paper assets. They actually exist. So existence is of assets and liabilities is a first claim that is made by the management. Second is rights and obligations. So management will first of all claim and then prove that I don't only have physical possession of the assets, I also have the legal title or the right on the assets. So the second thing which management should prove is rights and obligation on the assets and liabilities. First is existence, that the assets and liabilities do exist at the time of balance sheet. Second is their right and obligation is on the management, on the company. This is also to be proved. Occurrence, the transactions have actually happened. Occurrence is to be proved by the management by using substantiating evidence like invoices, like transporter bill, etc. So occurrence is an assertion made by the management. Valuation, whatever value is given in the financial statements of a particular thing, like bad debts, like provision for bad debts, like fixed assets. So in Ind AS regime, guys, fixed assets are no longer valued at historical cost. They are valued at fair value or the market value. So valuation is to be seen by the auditor whether the management assertion of true and correct value is right or wrong. Then measurement, what amount has been recorded in the books of accounts of every transaction, like revenue, like expenses. This is again an assertion which is made by the management. Management would always say my amount of expenses, my amount of revenue is perfect, but you as an auditor have to really cull out documents. You have to find out documents which prove that the claim of the management is correct. Then presentation and disclosure. presentation is appropriate or not, disclosures are appropriate or not in the financial statements. So for example, if any asset is mortgaged for taking any loan, this has to be presented as a disclosure in the financial statements, so that user of financial statement know that these assets have been pledged. So disclosures and presentation is one of the claims of the management would say that my balance sheet is full of disclosures and is absolutely presented correctly, and the auditor should study whether the balance sheet is properly presented or not. So that is the thing which is known as the assertions of the management. Now, types of evidence, guys. The evidence are of a lot of types. Some evidences are gathered within the factory premises or within the office of the client, and for other evidences, the auditor might need to travel outside the organization, like going to bank for bank statements, going to debtors for confirmations. All these procedures are all these evidences are external evidences. So evidences broadly categorized on the basis of source. Then they are categorized as internal audit evidence and external audit evidence. Internal audit evidence are gathered from the management. Management will give internal audit evidence like vouchers, invoices, supporting evidence, and the evidence which are gathered by an independent third party. If a third party gives you some evidence about a transaction with the company, then that is known as external evidence, like confirmation from debtors, bank confirmation, etc. So guys, to confirm whether the bank has the bank account of the client has been appropriately reflected in the financials or not, for that thing, bank confirmation is required. So an audit team member goes to the bank and gets sign of the manager to vet that the bank account of this particular company has so and so amount. So external evidence are these. So on the basis of nature, if you see that what is the nature of the audit evidence, it can be a oral evidence or a visual audit evidence. So for example, existence of a fixed assets is always verified by a visual evidence, which is the eyes of the auditor. Auditor has to see whether fixed assets are there in the factory to the amount which is disclosed in the financial statements or not. So on the basis of nature, oral or visual audit evidence and documentary evidence. Documentary means evidence which are there not in your eyes or memory or ears. These evidence are there on paper, that they are known as documentary evidence. Now on the basis of methods of obtaining evidence, what are the methods of obtaining evidence? Evidence obtained by the auditor himself, and evidence obtained by auditor through the management. So sometimes the auditor himself obtains the audit evidence. For example, auditor himself will go to the bank account and ask the bank to give a confirmation. This is procedure number 1. Procedure number 2 is that the auditor will ask the management to get a audit confirmation from the bank. The responsibility of getting audit confirmation is on the management of the company. So auditor can ask the management to get the confirmation from the bank. Now obviously, if management is involved in any transaction, then there might be a possibility that management, while bringing that confirmation on board, can tamper with the evidence. So the more relevant audit evidence is the audit evidence which is gathered by the auditor himself, and the less reliable audit evidence is the audit evidence which is gathered by the auditor through the management. Auditor should always avoid gathering any evidence through the management. Auditor should endeavor that the auditor should himself get the evidence directly himself and not involve management while gathering the evidence. Next topic is methods of obtaining audit evidence. What are the methods which you can employ to get the audit evidence? As I've already told you guys, you can hear, look at, or see some things to get an audit evidence, and secondly, you can have documentary evidences to have audit evidence. So these are the ways or the methods of obtaining audit evidence. Number 1 is inspection, that is examining. We can scrutinize what documents are available. We can inspect what documents are available to ensure that that transaction has actually happened. So inspection is one way. Second is observation. This is using your eyes, using your sight. You can see whether the process, you can witness whether the process or procedure is being performed properly. Third is inquiry and confirmation, guys. Inquiry and confirmation means you can ask the management of the company for their confirmation on a particular thing, like debit balance of their cash bank account. So if there's a bank account and there's a balance kept in the bank account, then you can get an inquiry or a confirmation on that particular bank account. Then computation. This is an important aspect of any audit, guys. Sometimes auditors recompute the entire mathematics themselves. So for example, depreciation. To ensure that depreciation is computed properly, the auditor will recompute the entire depreciation figure, and then he will be satisfied that yes, depreciation is correctly disclosed. Then last is analytical review. This is a specialized kind of method which is required, which is used by the auditor to obtain evidence. This, guys, include ratios and trends. Some past details are required for this particular step, and I'll give you an example. So for example, the last year's balance sheet and current year's balance sheet will be kept side by side in an Excel sheet. Then the figures will be deducted and the percentage increase or decrease will be analyzed. This way the auditor will be able to understand that if there is an increase or decrease in a particular figure, then what is the reason for it. So for example, if there is a 20% growth in the entire organization, then all the figures, be it sales, be it expenses, should increase by 20%. If there's an abnormally high increase of say 40% in marketing expenses, then the auditor can ask the management the reason for the same. So this is known as analytical review of a particular aspect of the financial statement. So guys, next topic which we are going to start is compliance procedures and substantive procedures. So basically the procedures which are followed by the auditor, the process, it is divided into two parts. First part is known as compliance procedure or test checking, and second part is known as substantive procedure. To explain the difference between these two things, these are the two methods of obtaining audit evidence. So auditors use this two things to collect audit evidence. So to explain these two things, I'll give you a very simple example, guys. So there's a boy in my class. He belongs to CMA Final Group 4. He is giving Group 4 examination in December 2019, and this boy is really a notorious one and has got a girlfriend. That girlfriend fears, or that girlfriend is not sure whether the boy visits our coaching classes or goes somewhere else, taking it as a excuse of going to the coaching classes. Now the girlfriend of the boy can employ two procedures. Procedure number one, the girlfriend can call up the institute reception and ask whether the boy is in the institute or not. This is procedure number one. And the boy can also have a tab, the girl can also have a tab on the timings when boy leaves his home and when he gets back his home. So these are the test points which the girl can test to ensure that the boy is reaching the organization, the coaching institute, well on time, and he is actually going to the coaching institute. Process number two can be, now this boy is very smart. He has bribed the receptionist of the coaching institute to tell her that if some girl calls and asks whether I am in coaching institute or not, then you have to say that yes, I am in the coaching institute. So this boy is very smart. He can play around with the controls which are employed in a particular organization, and this smart boy is the management of the company who's trying to befool the girl is the auditor of the company. So this boy can very well play around with the control testing bit, the test check which is employed by the girl, and girl is maybe she is a bit naive that she is not able to understand this particular aspect of the boy. So the second procedure which girl can employ to be 100% sure about the transaction is that girl can hire a detective and that detective can be with the boy all the time, follow him wherever he goes, and gives accurate picture to the girl. Now guys, process number 1 which was followed is known as compliance procedure or test checking, where we do not see or audit the entire transaction. We just look at the checkpoints, the important points through which the transaction goes through. We only check those points. This is known as test checking or compliance procedures. Substantive procedure are those procedures which test the organization or which test the entire transaction properly and do not leave any aspect of the transaction. So this is the difference between compliance procedure and substantive procedure. Now you would appreciate one thing guys, substantive procedures are a little difficult to follow. Why? Because substantive procedure will take a lot of time and effort, and substantive procedure will also be very expensive because hiring a detective is very expensive. Similarly, in an audit of a business organization, if I want to apply substantive procedure, I will not apply it to all the account heads. I will apply it to very highly risky account heads, very important account heads. For the other account heads, I can simply go with the compliance procedures or the test of controls. So these are the two procedures which are employed by any auditor. Substantive procedure involves 100% checking of the transaction, and test check or compliance procedure involves only controls testing. So if controls are working fine, then I assume that the transaction will also be working fine. So this is the difference between substantive procedure and control testing. And this is the difference which is given in the tabular form. It involves checking of only control points of the transaction. It involves checking the complete transaction. It is very first step. It starts where control testing ends. It is less time taking and less costly. It is more time taking, more costly. Commonly used for relatively less material account heads. It is used for less difficult account heads. It is used for highly critical account heads. There is one type of compliance procedure, control testing. There are two types of substantive procedure, test of details and analytical procedures. Guys, you just need to remember the names of types of procedures. You need not go into the details of these procedures. So yes, this was the difference between substantive procedure and compliance procedures or test checking. So guys, there are certain questions which are given as practice questions to all of you, which contains past examination questions also, and it is really important for you to read through all these questions. Somewhere I have also put in certain answers to make you well aware of the kind of answers which are expected by the institute. So yes, this marks end of our chapter number 2 of the audit marathon, part number 2 as well. Guys, do revise your audit at least 3 times before attempting in the examination, because audit is all about revision. If you revise it thrice or 4 times, then it will be really good for you, and you can hear these marathons while traveling, while going to somewhere, while coming back from somewhere. You can just quickly revise your entire audit through these audit marathons. And if you like these marathons, please press the like button so that I can be definitely, it will be motivating for me also to produce the next marathons, and I will definitely be producing the next marathons and will be continuing with this marathon classes for the next chapters as well. So that's all for this chapter, and that's all for today. We'll meet in our next marathon video. Till that time, all the very best and happy studying.
For latest updates and information on entire CMA profession, just subscribe to our channel and don't forget to press the bell icon to get notification on the latest videos which are being uploaded on the channel. For products related to paper number 19, paper number 20 for final students and paper number 12 for intermediate students, log on to www.agrawallawhouse.com. It contains the compilation of handwritten notes, books, reference materials and video lectures of these 3 subjects. If you have any further query or you want to speak to me personally for any kind of counseling, you can call me at the number given on the screen.
Hello and welcome guys, and welcome to the third part of the audit marathon. I hope you have done part number 1 and 2 pretty well, and you've completed the first 2 chapters. I know that you must have completed all the chapters by now, and this is just a revisionary session in which I'm going to make you go through the entire chapter in very quick manner and in a very short span of time. So today we are going to start one of the most important chapters of our syllabus, that is chapter number 3, which commands a weightage of about 8 to 10 marks in your examination. And the chapter 3 deals with internal control, internal check, internal audit, vouching and verification. So guys, in this chapter we are going to study the essential elements of internal control. Now what is internal control? I've already given you a brief background of internal control in chapter number 2, whereby I had explained that internal control means even before the auditor visits the premises of the company, the auditor is supposed to check the internal controls which are already installed by the management of the company to curtail or to restrict errors and frauds in the financial statements. These are known as internal controls. So let's start the chapter. Now, as you can see on the screen, there is a diagram which shows that internal control has 2 elements, internal checks and internal audit. So internal control is employed by the management of the company to ensure that even before the auditor comes, the errors and frauds are minimal in a financial statement of an organization. Now, while ensuring that the errors and frauds are minimal, the management takes help of 2 things. Thing number 1 is internal check. Thing number 2 is internal audit. So both these things clubbed together forms the internal control, and if there is weakness in any of these 2 elements, then internal controls of that company is said to be weak. Now we need to analyze what is internal control, what is internal check and what is internal audit. Let's start with internal check. Now guys, in layman terms, in absolute simple terms, internal check means a system whereby a transaction which is done by one of the employees is automatically checked by another employee. So I'll give you an example. In your examination, your teachers advise you to revise your paper before giving it to the examiner finally. Revise it once for 10-15 minutes. Guys, that last moment revision is an internal check which ensures that whatever you have written it perfectly. Because while you are writing it, you are prone to making many mistakes while writing a particular answer to a question. But when at the end of the paper, when you have finished the entire paper, your mind is at ease and it is relaxed. At that point in time, you tend to check or recheck your paper, and that rechecking is known as internal checking. So whenever a transaction is being entered into, the management forces the employees to cross-check that transaction several times so that no mathematical inaccuracy, no numeric inaccuracy, no factual inaccuracy creeps into the transaction, and the transaction is recorded pretty much perfectly. One of the most important ways of doing internal check is that work of one person should be checked by another person. So suppose an accounting entry has been put in the system by Mr. A. Now Mr. B should actually review the accounting entry which has been put by Mr. A, whether the accounting entry has been put as per the required standards, as per the required norms, as per the requisite policies which are installed by the company, and also to ensure that the transaction has been entered perfectly. There should not be any error while recording the transaction. This is one of the ways in which the management keeps control over the entire organization and the transactions which are being entered into. This is known as internal check. So the definition is, internal check is a system whereby work of one individual is checked by other. In the staff, internal check is a valuable part of internal control. So it is the first part of internal control, and it is really important for an organization to have a strong internal checking system. In other words, internal check is an arrangement of staff duties where no one is allowed to carry out and record every aspect of the transaction single-handedly. So this is a way in which the entire staff is required to divide its responsibilities into various people. So for example, if in a banking transaction the money is to be deposited into a bank, at that point in time the organization will ensure that there are 2 or 3 people involved in the entire transaction. So selling is done by one person who collects the cash, then the cash is given to the accountant who counts the cash and records it in the books of account. Then the third person is the person who is going to bank and depositing this cash in the bank. So in a way, a transaction is audited by 3 people, and that is how internal check works. When a transaction goes through the hands of multiple people, the possibility of errors and frauds are reduced. Now, what are the benefits of internal check? Benefits are it fixes responsibility of a particular act to a particular person. I mean, if suppose if accountant has not counted the cash properly or has not booked the entry properly, then we can easily fix the responsibility of not doing this on the accountant. Then obtain confirmation of facts and entries, physical, financial, by the creation and preservation of necessary records. The internal checks ensures that we have confirmed the facts, entries, all the documentation behind the entry, and everything is done properly. This is the benefit which is there if we are doing an internal check system properly. Then third is breakdown of routine procedures. All the procedures are broke down into small parts, and that segregation helps the organization to properly arrange its work, and the work does not get suffered if a person is absent. So if a person is absent, the other person knows that he is absent, and the work gets reallocated to the first person automatically. So this is the benefit of having internal check system in an organization. Then fourth is it reduces the chances of fraud and error. Of course, if 2-3 people are looking at one transaction, it will definitely reduce the chances of fraud and error. So these are the 4 benefits of internal check: fixes responsibility, obtain confirmation, breakdown of routine procedure, and reduce errors and frauds in a transaction. Then what are the duties with respect to internal check system of the auditor? Now the question arises that, sir, this is internal management's decision. What kind of internal check should be employed? What kind of internal control should be employed? This is management's discretion. This is management's prerogative. What does the auditor do with this? What is the role of the auditor in this entire scheme of internal check, internal control, and internal audit? Because statutory auditor, who's an outside party, has to perform the audit procedures to gain confidence on the financial statements. So what is his role, or what is his involvement in the internal check system of an organization? Now guys, let me tell you, the statutory auditor, he does not have a lot of time to do the audit. He merely would be provided, say, 3 to 4 months to complete the audit for the entire organization. So auditor does one very smart thing, and the smart thing is that he tests the internal controls. If internal controls are working fine, then the auditor reduces the intensity of the audit procedures which he employs, because he is reasonably certain that if internal controls are working fine, then all the transactions would have been recorded fine. So the auditor checks the internal control, checks the internal audit system, and checks the internal checks. And if he is confident that yes, all these things are working fine, then he gains confidence on the financial system of the entity, and then his workload reduces. He would employ less rigorous audit procedures. This is the benefit which auditor has of an internal control system. One more thing, auditor also has to report in his audit report whether the internal control system and whether the internal reporting framework and all the controls which are surrounding it are working absolutely fine or not. So for that reporting also, auditors need to check the internal check system. So let's come on to the theory, the text part. The auditor should apply a few test checks, that is, he should check a few transactions on a random basis, or check fully accounts of for a few months and carry out through check of whole of certain class of transaction taking place during the particular period. So the advisory to the auditor is that he should check whether the internal control system is working fine or not. If the internal control system is working fine, then the auditor is in a very positive situation or a better position as compared to a situation where auditor finds loopholes in internal control system. The existence of a good internal check system reduces the work of the auditor but does not reduce his liability. Now, the auditor cannot stand up and say tomorrow that I had relied on the internal control system, my report was based on internal control system. Now if there is a lapse in internal control system, it is none of my business. Auditor cannot say this, guys. Even if auditor relies on the internal control system of the management, the responsibility does not reduce. The liability of the auditor does not reduce. Auditor's responsibility was to check the internal control systems properly, and his responsibility was to ensure that they are working fine and then accordingly prepare his report. If the auditor had done some mistake in doing this analysis, tomorrow he cannot take a ground or claim that he was relying on the management's internal control system and hence his audit report was bad. He cannot take this shelter of internal control system. So the liability does not reduce even if the auditor chooses to rely on the internal control system. Now, what is a checklist? Checklist is usually a comprehensive list of all the aspects of internal check system designed to draw attention to important aspects of the system of internal check. Now, guys, checklist means it is a list of to-dos. It is a list of things which are to be done with respect to the internal check system and what kind of internal check systems are there. It is a comprehensive list, a big list, which highlights what are the parts of internal checks and what are the elements of internal checks. So this is a checklist which is drawn to make auditor aware about the internal check system, about the internal control systems which are existing in an organization. Now, what are internal control questionnaires? Internal control questionnaires are the internal check system questionnaire is a list of systematically and logically prepared questions designed to evaluate the effectiveness of internal check system. Now, what auditor does is auditor would prepare a questionnaire in which he would ask relevant questions to the management to ascertain whether the internal controls are proper or not and whether they are working fine or not. So we have also taken an example. Just see the example of an internal control checklist over here. So if you are in a restaurant and checking the cash receipts of that particular restaurant, and if you want to prepare an internal control questionnaire regarding the internal checks which are employed by the company or the restaurant, the questions you would ask is: accounting personnel are prevented from having access to cash, inventory and others. So guys, the person who's doing accounting is different and the person who's actually handling cash and inventory should be different. That is how two people will look at one transaction. So the first internal control question is that accounting person should be separate from the people who are actually on ground collecting cash from the customers or the guest. Then the cash deposits are made daily or as frequently as possible. The auditor has to ensure that the cash deposits are being made on a regular interval and daily or not. Then surprise cash counts are conducted regularly by bartender, cashier positions. So the cash count should be a general practice which should be followed by every organization, and the senior accountants, the bartenders or the cashiers should do surprise check for cash count. Then the cashier, servers, bartenders do not have access to their register totals. Now the people who are doing cash count should not be having any access to the register of cash. I mean, if they have access to register of cash, then they would try to match the cash balance which they actually have with the register balance. This should not happen. The bartenders or the people who are handling cash should tell their balance to the finance people, and then finance people should check it with the register. If bartender would have cash register with them, then bartender would misappropriate the cash to siphon off the cash from the company, and that would not be a good situation. Then the fifth part is that the managers observe cash handlers and complete their checkout sheets and then provide amount due. The managers should keenly observe what is happening with their cash. They should check out the sheets and then they should provide amount due in the cash book, which should have been in the cash book, to the bartenders or to the people who are collecting cash. So guys, this is the internal control question, type of internal control questionnaire which you will issue as a auditor to know. This is a prima facie evidence, the first evidence which you will gather to know whether the internal controls surrounding cash are working fine or not. Then the questionnaire are as comprehensive as possible to make sure that all aspects of accounting transactions are covered. So questionnaire should be very, very robust. Ask as many questions as you can, because to gain an understanding of a particular process is not easy. Hence the questionnaires should be comprehensive. During the course of audit, pre-commencement of audit, statutory auditors submit questionnaire to the management. Now statutory auditor will submit the questionnaire to the management and the managerial officers should respond to these questionnaires. The replies by the concerned official will help the auditor to form an opinion as to adequacy and reasonableness of internal check system. So by reading these questionnaires, the auditor will get a fair idea of whether the controls are working fine or not, or is the management misappropriating their assets or cash by using faulty internal control systems. This will be apparent from the internal control questionnaire. So next is an example of an internal control questionnaire of another area. This time the area is human resource function. The question which you will ask to the management is, are HR goals in line with those of the organization? Are the work weeks identified and defined? Are the full-time and part-time hours defined? Are the shifts defined? So these are certain questions which you will ask your HR department while checking the internal control system. Now the question arises, what is the difference between a checklist and an internal control questionnaire? So guys, first of all, the checklist is a guideline, set of guidelines which are to be followed by the audit staff. However, internal control questionnaires are the questions related to internal controls which are to be answered by the management of the company. This is prepared by the auditor, but it is to be answered by the management of the company. However, checklists are prepared by the auditors and auditors only have to fill that checklist to ensure that nothing remains in an audit exercise. Point of time, the checklist is prepared and issued at the commencement of audit. However, the questionnaire are prepared and issued during the course of the audit. So checklists are formed even before audit starts. However, the questionnaires are formed during the course of audit as and when required. The checklist is issued to the audit staff and the internal control questionnaire are issued to the management of the company. So checklists are relating to questionnaires, questions which are given to the audit staff so that they do not miss upon any important aspect of an audit. And the internal control questionnaire is for the management of the company to ensure that auditor understands the internal controls well. Objective is to set the guideline for audit staff so that nothing remains unchecked, and the objective of internal control questionnaire, it is used to collect information about the internal control system. Now the relationship between internal audit, internal control and internal check is that internal control is equal to internal check plus internal audit. So internal control is a wholesome exercise of controlling the errors and frauds in the financial accounts of an organization. And this is done using two techniques. One is internal check and second is internal audit. Now what is the difference between internal audit, internal control and internal check? This you will be able to appreciate very well now because we have already discussed the basics of all these three things. Now I come upon to a very, very important aspect of auditing, which is the cut-off procedure. Now guys, as the word itself says, cut off means to cut off between and set two things apart. So like if you cut a thread, then you make two threads out of one thread. So we cut certain things. Now sir, what are those certain things which we cut? Now to give you a live example guys, the business is carried on perennially. I mean, year after year after year, business never stops. It just carries on perennially. However, it is the accountant who cuts the period financial year and make financial statements for a particular period only. Because we cannot afford to prepare the financial statements after the organization ends its business and ends its entire system of working. We cannot afford to wait till that time. We cannot afford to wait till eternity to understand the financial position of a company. Hence, the auditors or the accountants cut the entire life of the business into small parts. Those small parts are the financial years in which the audit is conducted and in which the financial statements are made. So now when sales are going on and on and on, expenses are going on and on and on, it is really important to classify the expenses and sales in the respective period to which they pertain to. So for example, if you are creating financial statements of financial year 2019-20, then you need to ensure that whatever sales have occurred during financial year 19-20, they only should be recorded in the financial accounts of the financial year 19-20, and the sales which happens after 19-20 should not be recorded in the financial statement. This is what is to be ensured, and to ensure this, every auditor employs cut-off procedures. Now let us understand what are these cut-off procedures. These are adopted to allocate revenues and costs to the proper accounting period. Now to allocate the revenue and cost to the proper accounting period, we adopt these cut-off procedures. These are accounts payable and accounts receivable. These are the two accounts where mostly these procedures are employed, because these are most susceptible to any kind of fraud and error in the recording. So accounts payable and accounts receivable are typically categorized for using the cutoff procedure. Serially numbered documents like invoice for sale are allocated to the respective accounting period by establishing cutoff points based on the serial number. Now this point you won't be able to understand, and if you want to understand this point, let us first come on to an example which is given as a class note. From the following extracts of sale register of Messrs Modern Paper Product Limited, you are required to ascertain which sales invoice should be recognized as income in the financial year 18-19. You may employ the suitable cutoff procedures. Now guys, these are the sales invoice number 364, 65, 67 is missing, 68, 69. Sale invoice date, when was this invoice raised? 29th March, 30th March, 31st March, 31st March and 1st of April. Remember, we are dealing with financial year 18-19, which means sales which have happened in 18-19, which is March 31st, 2019, before this date. All those sales should be recognized in the financial statements. Now party name is AK Papers, 1 lakh rupees, goods, risk and rewards delivered on 30th March 2019. Now guys, remember one thing, revenues as per the accounting standards are to be allocated when risk and rewards are transferred, and not when invoice is raised, not when cash is received, but when risks and rewards are transferred, then only revenue should be recognized. So tell me, when should revenue of this particular 364 serial number be recognized? It should be recognized in the year financial year 18-19. Similarly, revenue should be recognized for these two invoices 365 and 366 on 31st March 2019. So they should also be recognized in 18-19. Now comes on a case where the invoice was raised on 31st March but the risks and rewards were transferred on 1st April. Guys, in this case, invoice date is irrelevant and you should recognize the revenue as per the date on which sales, the risk and rewards have been transferred, and that date pertains to financial year 2019-20. So this revenue should not be recognized in the year financial year 2018-19, but this revenue should be recognized in the year 2019-20. Next is the invoices raised on 1st of April and the goods, that is risk and rewards, are transferred on 2nd of April. Guys, in this case also the risk and rewards have been transferred on 2nd of April and the invoice is also raised on 1st of April. So the revenue is to be recognized in the year 2019-20. So this is how cutoff procedures work, and this is how we recognize revenue as per the cutoff procedures, that is risk and rewards which are transferred. Then cutoff procedures require detailed testing by the auditor so as to ensure proper accounting of assets and liabilities which may arise without corresponding physical delivery of goods taking place. So cutoff procedure are also useful in determining when should an asset or liability be recognized in the books of accounts, because guys, similar to revenue and expenses, the assets and liabilities are also to be recognized in the correct period. That is, when they are capitalized, when they are put to use, these assets and liabilities should be capitalized. For example, purchase procedure involves a number of steps like issuing the purchase requisition, inviting quotation, selecting sellers, defining terms of purchase, entering agreement, receipt of goods, storage of goods, payment, etc. All the documents and vouchers that substantiate the proof of authentication of these transactions are serially numbered. It is the auditor's duty to examine the cutoff points and ensure that transaction has been recorded in the period in which title in goods is transferred, irrespective of accounting period of physical delivery of goods, and to ensure compliance of Indian accounting standards and the relevant statute. So we understood by way of an example how does this system of cutoff procedure work, and this should be employed by every auditor to ensure that the right revenue is booked in the right period. Guys, otherwise revenue keeps on accruing. Sales keeps on happening. Sales doesn't stop when the year stops. Year is our prerogative, that is accountant's prerogative. Otherwise the business never stops. So this is the cut-off procedure, that is allocating the right revenue and cost to the right period. It is known as cut-off procedures. Now coming on to the next aspect, which is examination in depth or walk-through test. Guys, in this concept, the auditor tries to gauge an insight into the entire transaction, because if auditor wants to audit a transaction, then he has to really go through the entire transaction properly, and he has to ensure that he understands the entire transaction well. So before the audit starts, what auditor does is, auditor on a test check basis pulls out certain transaction and sees it end to end. He would just see all the papers which are related to that transaction, so that he is able to understand the process, the steps which are taking place in that transaction. He understands that process well. This is known as examination in depth or walkthrough analysis. Steps of in-depth analysis: fixation of maximum tolerable error limit. So first of all, the auditor fix a maximum limit which is tolerable, which is above the minimum threshold limit. He fix that limit. Then he selects a few transactions in each area of audit to be checked. Then he verifies certain selected transaction, that is 100% by verifying accounting aspects, internal control aspects, documentation, audit trail. He verifies 100% of certain few transactions. Then the audit trail refers to the documents. Audit trail means the documents or the records or the books, files which enable the auditor to trace the transaction from its source till it is summed up and recorded and presented in the accounting report. So in a nutshell, the auditor would start from the scratch. He would analyze a transaction or verify a transaction from its very beginning. Beginning means the area or the point at which that transaction was generated. Auditor would start observing from that area, that particular transaction, to ensure that he understands the entire transaction well. Analysis of the result with maximum tolerable limit. Then he analyzes the result with the maximum tolerable limit, which means that whatever he has verified, he would see whether that verification has been done as per the materiality limit set by the auditor. I mean, the errors should not be increased, the errors should not be more than the materiality limit set by him. So for example, if the auditor has fixed up a materiality limit of 1 lakh rupees, then all the errors which comes up during this detailed examination should be below 1 lakh rupees. If they are above 1 lakh rupees, then auditor would definitely qualify his auditor report, and he would have an observation in the auditor's report that there are certain material discrepancies which were found out by the auditor during the walkthrough or the in-depth analysis. Now guys, the downside of in-depth analysis is that in-depth analysis cannot be done for entire transaction, all the transactions, because in-depth analysis requires a lot of time. So in-depth analysis can be done only for quite few selected transactions, and not for all the transactions. So the next topic is differentiate between test checking and statistical sampling. So guys, as I have already told you that it is not practically possible for any auditor to check all the transactions of a company fully. So it has to necessarily employ certain procedures which will help him to select what transactions would he check and what transactions would he leave. So there are two ways in which an auditor can pick out certain samples which he will check, because he cannot check the entire transactions. So the two methods are, number one is test checking and the number two is statistical sampling. Guys, test checking involves selecting certain transactions, selected transactions which are to be verified, and same is the selection of statistical sampling. It is drawing sample from large number of transactions. Both means the same. Test checking also means the same, that certain selective transactions are verified, and statistical sampling also has the same selection objective to verify certain transactions from a large number of transactions. Technique is, no specific technique is used, which means test checking is a random method of picking out samples. So auditor on his own will pick out certain samples, that is test checking. However, in case of statistical sampling, the sampling is done on a random basis but on statistical measures. Statistical measures means there are certain procedures of statistics which are to be employed while picking up samples for statistical sampling, and so the statistical sampling bit is selection of transactions, but absolutely randomly, where the auditor will not have any discretion of identifying which transaction to choose and which transaction not to choose. Guys, in case of test checking, that is random sampling, the auditor can involve into some fraud with management, and the auditor can pick up those transactions which are asked by the management itself. So test checking becomes a little risky. However, statistical sampling is not done by the auditor, it is done by the system, the software. Hence statistical sampling is much more error free or fraud free. Subjective, it is subjective and depends upon choice of the auditor. However, statistical sampling depends on the statistical technique employed. Risk and methods, it involves more risk, and there are no specific methods for test checking. It is just a random selection of some samples. And statistical sampling carries out lesser risk, and various statistical methods can be used at different times. So statistical sampling is much more scientific, is much more logical, and is much more rational as compared to test checking. So guys, most of the big fours which are pioneers in auditing an organization use statistical sampling while picking up samples for their audit. They do not use test checking, or they do not allow the auditor to have his say or have his discretion in picking up the samples. Now let's come on to the next aspect, which is the internal controls. Guys, we have studied internal checks. Now we'll come to internal control. I hope you remember that internal control consists of two parts. One is internal check and other is internal audit. So internal control system comprises all the methods and procedures adopted to assist in achieving of objective of efficient conduct of business. Conduct of business is efficient, and that is the objective of internal control. Then it ensures adherence to management policies. Management policies should be adhered properly. Safeguarding of assets. Now assets should not be stolen. Assets should not be siphoned off. Assets should not be misappropriated. Therefore, this is one of the most important objective of setting an internal control, that the management or the employees should not misappropriate the assets. Then prevention and detection of errors and frauds. Of course, this is one of the major elements or major objectives of internal control system. Checking accuracy and completeness of the accounting records. Accounting records are accurately made and completely made. This is checked by internal control system. Internal checks and internal audit are integral part of overall internal control system. What are the essential elements of internal control system? How would a management employ a good internal control system? Guys, first of all, financial and other organizational plans. The internal control starts with planning. Soon as you have a plan in your mind about your business, plan related to operations, plan related to finance, you have to employ good people, right people on those jobs, and those people should be accountable to their seniors. So authority and responsibility should be delegated at the time when planning is being done, and that is the first step of every internal control, because control starts at the planning stage. Second is competent personnel. Your people should be competent and efficient and honest, and they should have integrity while performing job. So competent personnel is the second essential element of internal control system. Division of work should be divided amongst the employees properly. That is the third aspect of internal control system. No employee should be allowed to carry out a single transaction all by himself. The transaction should involve many people before it is completed, so that work of one person is checked by another person. Separation of operational responsibility from record keeping. Now, a person who is recording the transaction in the books of accounts should be absolutely different from the person who is actually undertaking this transaction. So these two people should be different people. That is one of the prime requirements of a good internal control system. Separation of custody of assets from accounting. Again, just like the operations people are different and accounting people are different, the assets should be under the control of some other person, and assets should be recorded or accounted for by another person. There should be separation of custody of assets from accounting. Authorization. Every transaction should have a proper authorization. That is, all the activities, all the assets which are being purchased should be authorized by responsible people, and authority should be separately given to each person. Managerial supervision and review. The management should review and supervise the internal control system regularly, and the management should have an environment or have a system whereby the supervision and review happens for every transaction, so that it is ensured that the transactions are not recorded erroneously. The transaction should not have any error in it. So next is, what are the objectives of internal control? The objectives of internal control. Why do we employ internal control in any organization, guys? First is compliance. The compliance should be done for law and accounting practices properly. Everyone should follow the law which is prevalent in the country. Then reliance on the financial systems, reliance on the people, accounting records. All these reliance are strong only when there are strong internal controls. Security. It is secured, your security of your money, security of your assets, security of your entire financial statements happen only when you have strong internal control system. Then is increased efficiency. Efficiency is increased. Human resources, performance management, everyone will perform to their best possible extent if there are proper internal controls prevalent. If internal controls are not there, then human resource will be lured to ill perform or not perform up to their standards. Review and correction happens in a timely manner. Authorization takes place properly. Every transaction happens only with authority, otherwise it doesn't happen. Delegation of responsibility, division of duties happen if there are proper internal controls. Setting of goals. Goal setting happens only when you have strong internal control systems. You will be able to understand what are your future goals only if you have internal control systems. Conformity with accounting principles. Accounting principles are followed properly. Evaluation of transaction. Accurate planning. An objective with respect to resources of the organization. Resources are utilized properly. They are safeguarded properly. I mean, the employees cannot steal those assets, or they cannot misappropriate those assets if internal controls are proper. Then safeguarding of assets. Assets are safeguarded. All the accounts, employees, everyone is safeguarded. Policies are foolproof if internal control system is working efficiently. So next topic, what are the advantages and disadvantages of internal control system? These are two pretty easy topic, guys. So I'm leaving these two topics and I'm directly jumping on to a very important topic. What are the types of internal control system? Now, ultimately, the objective of the management is to control or prevent detection of any errors and frauds, and to ensure that the recording in the books of accounts is being done properly and is being done appropriately. So there are various types of internal control systems. There are various types of checks and balances which can be employed by the management in the books of accounts. What are all those types we are going to study in this particular concept? So the first type of control is preventive controls. These are the controls which are designed to discourage errors and irregularities from occurring. So they prevent the mistakes from happening, and they prevent any kind of errors and frauds from creeping in the organization, transactions and financial statements. They are proactive controls. Proactive means before the incidents happen, they control that incidents that help to ensure that departmental objectives are being met. Examples of preventive controls are segregation of duties, approvals, authorizations and verifications, security of assets. So these are the three kinds of preventive controls. First is segregation of duty, which means two people should be taking care of one transaction. So if there is a banking transaction, then that should not be held by one person. It should be split between two people, like Mr. A and Mr. B should both take care of the banking transactions. Second is approvals, authorizations and verifications. Guys, expenditure of a junior should always be approved by a senior. Activity or transactions of a junior should always be approved by the senior. Even the top management, board of directors should take approval of each other while performing any action in the organization. This ensures that any kind of errors and frauds are not crept in the organization. Third is security of assets. Of course, your assets should be secured. They should be dealt with in a manner that records are maintained properly and the assets are safeguarded from any probable theft, any probable breakage or misappropriations. So yes, security of assets is the third limb of preventive controls. The second kind of controls are detective controls. Detective control means that once any error or irregularity has taken place, then after that irregularity has taken place, what are the steps which we can take to detect and to detect this misappropriation or this error in the entire transaction. Now, the best way is to review the performance. You have to review and supervise the performance and you will be able to figure out where controls have lapsed. Reconciliations are one of the very important means of telling if controls have lapsed or not, because if two things are not reconciling, then it is a clear proof that internal control system is weak in an organization. Like you prepare bank reconciliation statement that will present any internal control weaknesses which are there in the organization before the auditor. Then physical inventories, the auditor should actually go in the go down and check what are the inventories which are lying over there. This is known as physical verification, and after physical verification the auditor will be able to know if any control lapse, if any error has crept in while valuing the inventory. Then audits are one very important source of detecting control lapses and detecting control weaknesses. Like internal audit is one of the most important areas of analyzing whether the internal controls are working fine or not. Then corrective controls, once controls have occurred and they have been detected, now you have to ensure that the error does not repeat in future. So those controls which ensure that the errors don't repeat in future are known as corrective controls. They are a correction of errors and irregularities as soon as they are detected. Steps in internal control consist of control environment. You should create an environment which is full of control, full of discipline, full of policies and procedures which ensure that transactions do not happen inappropriately. Then you have to assess the risk of every transaction and assess whether this risk is there or not. Then control activities, you have to control the activities which are there in an organization. Information and communication, you have to communicate the irregularities in the information in the transaction to the relevant people at regular intervals. Monitoring, you need to monitor or supervise on a day-to-day basis that these controls are working fine. Now, what are the nature of internal controls? How do you classify internal controls? What are their characteristics? Now, first of all, it is prerequisite of every efficient and effective management, because without an internal control system, the management cannot survive. Management cannot be present when the transaction is happening, each and every transaction is happening. Management cannot be present over there. So they should ensure that the internal controls are sufficient enough to prevent any errors and frauds in their absence also. So it ensures a efficient and effective management if internal control systems are working fine. The primary responsibility of every management is to establish and maintain an adequate system of internal controls. Then you need to report the deficiencies. Management should report the deficiencies to the people who are charged with governance, that is the high top end officials of an organization. Management should communicate these to the high the top level management. What is the scope of internal controls? Where all are internal controls useful? Guys, entities, organization structure, first of all, the internal control arises from there, because that ensures segregation of duties and authority responsibility relationship. So this is the first element of internal control. This is the scope of internal control. Second is functioning of board of directors. Board of directors are functioning well or not. This is again an element of internal control system. Scope of internal control system will be clearly evidenced if the board of directors are not working fine. Then management philosophy and operating style is the third element of scope of internal control system. What are the responsibility of managements and auditors with respect to internal control? Guys, very simple as it can get. Management should devise or maintain the internal controls, and auditors should examine and evaluate the internal control. So who will create internal controls? It is management. Who will create internal checks? It is management. And who will evaluate or examine those internal controls? It will be the auditor. So the responsibility of the auditor and the management is clearly demarcated in this respect. Both have to do different functions. What are the techniques of evaluation of internal control? If an auditor needs to check whether internal control is working fine or not, how can he check? Number one, narrative records. Narrative records means auditor can ask questions and get a description of the internal control system, and that is how auditor can know whether the internal controls are working fine or not. Second, checklist. Auditor can prepare a checklist to the people who are doing internal controls in a day-to-day manner, and auditor can give this checklist to the person who's responsible for internal controls, and while the auditor gets answers to those questions which he has raised, he will be able to evaluate whether internal controls are working fine or not. Now, flow charts are pictorial representations of internal control system or authority responsibility relationship. So flow charts is a very important and useful tool to evaluate internal control system by the auditor, and flowcharts can be used as a technique for evaluation of internal control system. Then comes internal control questionnaire. Internal control questionnaire means the auditor can ask some relevant questions from the management of the company, and they can respond to those questions, and the auditor will know whether the internal controls are working fine or not. Internal audit. This is the second limb of internal control. First limb is internal check, which we have already studied, and internal audit is the second limb. So to ensure that things are working fine, to ensure that everything is going as per the established standard, the management has to appoint a person who can check whatever is happening in the organization. This is known as internal audit. It is an independent appraisal activity within the organization by the staff of the entity. Guys, the staff of the company only does the internal control, internal audit, or it can also be done by a third party, but again that third party is also hired by the management of the company. So strictly speaking, the internal auditors are not independent of the company. They are dependent on the company. Strictly speaking, this is to be kept in mind. Now, 5 areas of scope of internal audit. Where do internal auditors work? Guys, financial and operating information. Of course, financial statements are the first things which an internal auditor see, which an internal auditor can check. Second is laws, policies, plans. Law, whichever relevant statute is there, whichever policy is being created, plans are being created. All these things are checked by the internal auditor. Then assets are to be checked by the internal auditor. Then resources, whatever resources are there with the organization, which means infrastructure, monetary resources, physical resources, all these resources are checked by the internal auditor. Then internal auditor has to see whether the objectives and goals of the operations are being satisfied or performed well or not. Then what are the features of internal audit? Features of internal audit are that it is an independent appraisal conducted by the staff or independent professional. Both can do audit of a particular organization. Review of accounting, financial and other operation controls. Service to the organization. It is conducted as a service to the organization. Organization is taking internal audit service, that it is conducted as a service. Then it intends to furnish, analyze, appraisals, suggestions and informations concerning the activity reviewed by the management. Then internal audit function is a continuous effort. It does not stop or it does not take place at the end of the year. Internal audit is a continuous process which is happening daily on a daily basis. Functions of internal auditor are that internal audit is an appraisal function, which means it reviews the activities of an organization from standpoint of finance, from standpoint of law, from standpoint of operations, from any other standpoint. So it is an appraisal activity. Second is it is service to the organization, which means that it is just like taking any service from a third party. It is a service to the organization which is being given, and it is required to ensure that policies are fulfilled, information is required, information it requires to manage effectively is reliable and complete, so information is proper. Then assets are safeguarded. This is the service which is internal audit service which is given to the organization. Internal control system is well defined and internal control system is working efficiently. These are the areas where internal auditor work. Other duties of internal auditor may be with respect to social responsibility, implementation of social responsibility, that is CSR policies should be in place for an organization. It acts as training officer in internal control matters, auditing the information given to the management, particularly interim accounts and management accounting reports, taking a share of external auditor's responsibility, etc. These are the other responsibilities of internal auditor. Now, what is the need of internal audit, guide? This is a very easy topic, so I leave this topic to you, but it is important. Please read both these topics. These are important topics. What are the advantages of internal audit? What is the benefit of internal audit? And what is the need for internal audit? These are quite similar to each other. Now we come on to the last aspect of this topic, which is difference between internal audit and operational audit. So guys, both these words, internal audit and operational audit, are leading to only the same thing, which is to ensure that operations of an organization are done well. The ultimate objective is to ensure that legal formalities are being fulfilled properly. The objective is to ensure that financial statements are being reported in an transparent manner, in a crystal clear manner. So both of these words are synonym to each other, internal audit and operational audit, and both these can be used interchangeably. However, there are certain small differences which are there in these two kind of audit. But let me tell you, while doing internal audit, operational audit is also part of it, and while doing operational audit, internal audit policies are also taken care of or being checked by the auditor. So compliance objective and risk identification process improvement. Internal audit more focuses on compliance with law, with accounting principles and procedures. However, operational audit identifies the risk process improvement objective. Then the focus is financial accounts in case of internal audit, and operational audit focuses on the operations, that is the business. Audit focus, efficiency and improvement focus. Here the focus is that you have to do audit, and here the focus is that you have to improve, suggest measures to improve the efficiency and effectiveness. Transaction based. So internal audit is done as per the transactions which have happened in the organizations, which are recorded in the books of accounts. And operational audit is process based. Operational audit is not bothered with the transactions, it is bothered with the entire process. Policies and procedures focus. The focus of internal audit is on policies and procedures, and focus of operational audit is on risk management. Internal audit focuses on policies, transaction and compliance, and operational audit focuses on goal, strategy and risk management processes. So these are the broad differences between internal audit and operational audit. Okay, so now let us start the second topic or the second aspect of this particular chapter, which is a very important aspect of auditing as a whole. And it is not an understatement to say that this is the basic core of auditing. The core of auditing is vouching and verification. These two aspects are core of auditing. So let us see what are the different procedures in which we are going to do the vouching and verification of assets. So put it very simply, voucher means any substantiating document which proves a particular transaction. So for example, if your mother asked you to buy tomatoes worth 1 kgs, and you would spend 40 rupees to buy those tomatoes, and you did not go to any unregulated market, but you went to a regulated store, which is big bazaar, or some 24/7 kind of a store, which is a regulated store, there you will get a receipt. Your mom will ask for that receipt, and that receipt will be the substantiating document, which will also be known as voucher. So voucher is a piece of substantiating evidence. It is evidencing in form of written record of expenditure, disbursement or completed transaction. Examples of types of vouchers are cash memo, sales invoice, purchase requisition, purchase invoice, etc. So auditor essentially vouches or audits these entire documentation, which is known as vouching. Second is types of vouchers. What are the types of vouchers? Original or collateral vouchers. Original vouchers are the primary vouchers, which are invoices and which are documents which substantiate a particular transaction. And collateral vouchers are the supporting documents which support a particular transaction. So I'll give you an example. Now, if there is an expenditure of a director who's traveling to USA for some official work, invoice of the airlines will be the substantiating evidence, primary voucher for you. You will be studying the invoice of the travel agent who has raised the invoice on you. The secondary evidence will be the boarding pass of the director. It will prove that yes, director had traveled to UK and it is not a bogus expenditure. So along with original vouchers, you also see collateral vouchers, which are the secondary vouchers. Next is internal and external vouchers. Internal vouchers are vouchers that may generate inside the company. For example, in case of a sales, the sales invoice is generated by the company itself. However, in case of purchases, the invoice is generated by the party who is selling the goods to you. So if the voucher is generated from a third party that is outside the organization, it is known as external voucher. And if the voucher is being generated from inside the organization, it is known as internal voucher. Of course, internal vouchers are less reliable because it is being generated within the company, and external vouchers are more reliable than internal vouchers. Then there are certain missing vouchers. Missing vouchers means so generally documents should be serially numbered. All the sales invoices, whatever sales you are doing, should be serially numbered. If those serial numbers are missing, then those vouchers are known as missing vouchers, and the auditor gets a clue that something is going wrong within the organization if there are missing vouchers which are not explained by the management. So these are the types of vouchers. Now, what is vouching? Vouching is an activity which is the activity of checking voucher. Vouching is examination by the auditor of all documentary evidences. So checking the documentary evidences is vouching to support the authenticity of the transaction. Basic objective is to establish authenticity of the transaction recorded in the primary books of accounts. Vouching is said to be essence of auditing, or may be termed as backbone of auditing. So this is an important statement, guys, which you should remember, that vouching is the basis, or vouching is the essence, or vouching is the backbone of auditing. Now you are going to see this payment voucher, guys, and I have already created a video on this payment voucher, which you can see on the I button above. Please see this video in which I have in detail referred to this payment voucher and have told you the techniques of filling this payment voucher in that particular video. Next is teaming, lading and lapping. Now this is a kind of fraud which happens in a company in case of which are detected while vouching. So this is a fraud which relates to misappropriation of cash. So whenever a person or a accountant or a cashier wants to misappropriate cash, it can employ this technique of teaming and lading and lapping. What is this technique? This technique is used to conceal the cash shortages and covering them through recoveries from another customer. So for example, let's see the example and understand what is teaming, lading and lapping. A salesman recovers 10,000 rupees from customer C. So salesman recovers some money from customer C. Customer C is the person who has bought goods from your company and misappropriates the same, but to conceal the misappropriation, he declares rupees 10,000 received later from another customer D as received from C. So the salesman takes away this 10,000 to his home and do not tell it to the company. But later on, when Mr. D pays the money, the salesman appropriates that money to Mr. C's account. So that balance of Mr. C confirms to client's debtor list and so on for recovery from E. Now when E gives the payment, then the salesman says that this recovery has been done from customer D. This goes on and on and on till the time the employee resigns, and one fine day employee resigns and goes away from the company when this fraud comes into picture. Negligence on part of the management and weaknesses in the internal checks or controls may lead to substantial amounts being misappropriated by the cashier. This may result in a huge loss. This is known as teaming and lading error. And audit steps to detect teaming and lading error. The very first audit step is that any missing voucher should be disclosed to the auditor, and it should be carefully scrutinized that why any missing voucher is there. So if number is 1, 2, 3, 4, 5, then fourth number memo should also be there, and there should not be any missing vouchers. Reconciliation is an essential element of teaming and lading error and fraud. You should reconcile your receipts with the cash books, and this reconciliation will present any irregularity which is there in the cash register. Then pay-in slips and counterfoils should be matched. So while depositing money to bank, the pay-in slips should be filled and it should be reconciled with the cash book and cash memos. Cash receipts should be deposited in the bank on a timely manner. And debtors ledger, especially entries showing part payment to satisfy the debtors concerned, have indeed made the part payments. So debtors ledger, wherever debtors you have recovered the amount from the debtors, you should reconcile the entries properly, and you should check whether the debtor who has paid the amount to the company is the same person from whom the amount has been recovered. So debtor ledger should be carefully scrutinized. Confirmation should be obtained from the debtors from time to time. Debtor should be able to tell you whether the amount has been paid by the debtor or it has been not paid by the debtor. So these are confirmations which are essential to reduce the teaming and lading frauds. Now there are certain steps for auditing of receipts, whatever cash receipts or sales of assets receipts can be of two types. It can be due to cash sales, it can be due to sales of asset. So guys, whenever you want to audit receipts, you have to follow certain things. Like first of all, authorization should be there for receiving the cash. Sales should be done by authorized representative of the company and the salesman. So authorization should be there. Then you have to examine few bills and ensure that the rate, amount and discount which are there in the invoice are put in properly. Cash summary book shall be reconciled with the transactions which are happening on a day-to-day basis. So cash sales summary book should be carefully scrutinized by the auditor. Cash sales should be verified with the cash memos. Cash memos should be checked and they should be reconciled with the cash book or cash register to ensure that all the cash sales have been recorded properly. Ensure that cash entry made in cash book is with reference to date on memos. Then you need to verify bank statements for ensuring that the cash which is collected is duly deposited in the banks. Examine the cancelled memo. If there are any cancelled memo, you have to examine them and you have to reconcile them with the original copy. Then what about sales of asset? If there is any money which is received on selling of an asset, then what you should do for that? Again guys, authorization is the primary step. You should be the employees who are selling the assets should be authorized by the board of directors to do so. Second is that if you are selling the assets through an agent, and in case of direct sales, whatever, then you should examine the terms and conditions with the agents, and you should ensure that the amount which is collected is as per the agreement between the agent and the company. Sales value of the asset is reasonable. You should not sell an asset at throwaway prices. This should be ensured. Then duly accounted for. Whatever sale has happened, it should be accounted for in the books of accounts, and loss and profit should be recorded in the financial statements. You should ensure that. Now comes on to a very important aspect. What is the procedure of audit of an expenditure? Guys, again, audit of an expenditure is treated as if you are just vouching any expenditure So the first step would be to see whether the expenditure has been done by authorized person or not. Then you have to see whether proper documentation, which is vouchers, are present for that particular expenditure or not. You have to, in certain cases, see if Companies Act provisions are being fulfilled. All these things are to be checked by you. So authorization, ownership in case of assets, ownership should be with the company, existence of assets, compliance is there with Companies Act, capitalization of assets. All these things should be checked while vouching for expenses. Guys, while vouching for assets and liabilities, you have to check their physical existence, that yes, it is not that the assets has been only procured on papers, they should be existing in the company as well. Title, existence, possession, whether they are overstated or understated, their value should be disclosed properly. This thing should also be carefully scrutinized in verification of assets and liabilities. What is the importance of verification? Now I'll tell you guys a basic difference between verification and vouching. So vouching relates to seeing only the documentation which is existing for a particular transaction, but verification means to actually go inside the factory. The auditor will visit the factory and he will see if the fixed assets actually exist over there or not. So verification is a much more detailed process rather than vouching, and vouching relates or confines to only documentation. Verification actually mobilizes the auditor's movement inside the factory, and the auditor ensures that the assets are actually existing. Then what is the importance of verification? Importance is that true and fair view is given in the balance sheet. Valuation is done properly for every asset. An asset is disclosed at the true value. Any omission, any thing which is remaining to be disclosed is not there if verification happens. Scope of verification, it is done to ensure the existence of assets. Then purpose of business only should be there. Proper authority should be there. Ownership of assets should be with the company, free from any charge. Charge means any mortgage. The loans should not be securitized by the assets, and if they are securitized by the assets, then assets should be disclosed as mortgaged assets or charged assets. They should not be disclosed as free assets. Then assets are valued and disclosed properly. Objectives of verification, again true and fair view, existence, ownership and title, valuation of assets should be proper, arithmetical accuracy should be proper, recorded properly, direct error and fraud, etc. Advantages, same. This is a very important topic, guys. Techniques of verification. So verification can be done by inspection, observation or confirmation. Inspection means the auditor physically visits the factory premises and sees the physical existence of a particular asset. Observes means he witnesses the physical verification of a particular asset. So the verification is done by the management, and auditor just goes there and just observes that physical verification is happening properly. In case of inspection, the auditor himself verifies the particular asset. In case of observation, management is actually inspecting the assets and the auditor is only observing it. Next is confirmation. So sometimes the assets of the company are kept at a third party's place. For example, leasing company leases out their assets to third parties. In that case, a confirmation from the third party can serve as a valid document of verification. The auditor need not physically go to the third party's premises to verify a particular asset. How to conduct verification work? So verification work, it starts with documentary evidence, which is vouching. Vouching is the first step of verification. Then you verify opening balance from schedule of fixed assets. Then you verify the acquisition, which is done during the course of the audit, during the course of year, what all new assets have been purchased, you check that. You check the self-constructed assets and whether they are valued properly or not. Then you ensure that fully written off assets are properly recorded. Authority of disposal, the assets which are disposed of, that is which are sold, there was proper authority of those assets. Similarly, proper procedure to ascertain omissions, verify ownership of fixed asset on the basis of title deeds, existence of asset is verified. On a test check basis, physical verification reports are gathered for assets, because assets are nothing but physical tangible goods which are kept in your company. So if I verify those assets physically, then that serves as a good purpose of verification. See whether the assets are charged. Charged means again mortgaged. You should not have mortgaged assets, and if you have mortgaged assets, then you have to disclose them in your balance sheet. So you should ensure that. So that is all about chapter number 3, guys, and yes, it's an important chapter, more than chapter number 1 and 2, because it holds more weightage in your examination. So yes, that's all for this audit marathon. And if you are not able to understand any aspect of this particular chapter, because obviously guys, this is a revisionary video where I'll be quickly going through the chapters. So if you are not able to understand any particular aspect, please call me up on my number and I will explain you that particular aspect. But yes, from an exam perspective, this is an important chapter. So that's all in this marathon, and we'll meet in the next one with the next chapter, which is companies audit, which is one of the very important chapters of our syllabus. Till that time, all the very best and happy studying.
For latest updates and information on entire CMA profession, just subscribe to our channel and don't forget to press the bell icon to get notification on the latest videos which are being uploaded on the channel. For products related to paper number 19, paper number 20 for final students and paper number 12 for intermediate students, log on to www.agrawallawhouse.com. It contains the compilation of handwritten notes, books, reference materials and video lectures of these 3 subjects. If you have any further query or you want to speak to me personally for any kind of counseling, you can call me at the number given on the screen.
Hello and welcome guys, and welcome to the next session of the audit marathon. And in this session we are going to study a very important chapter of your syllabus, guys, and the chapter is chapter number 4, which is company audit. And as you can see on your screen, this chapter has a weightage of about 12 marks, which is recurring in the examination for past few attempts regularly. Most likely in December 2019 attempt as well, this chapter would hold at least 12 marks in the examination. So yes, you have to study this chapter very carefully, and it's an easy one, it's not a difficult one, and you'll be able to understand its provision quite well. But yes, you have to revise all the provisions before appearing in the examination, and you have to re-revise it again and again, because yes, this chapter is category A chapter in your audit syllabus. So let's start. Chapter number 4, company audit. So first section that we are going to study is section 128. Before we come on to section 128, guys, we need to understand what do we mean by company audit. So as we have already discussed that audit can be of various types. Audit can be a GST audit, audit can be a tax audit, audit can be a social audit, audit can be a partnership audit, audit can be of various types depending upon which statute requires that particular audit to happen. Now in this particular chapter, we are specifically focusing on the audit which is prescribed by the Companies Act 2013. And this audit is done by chartered accountants. Statutory audit is done by chartered accountants, and cost audit is done by cost accountants. So both these audits are governed by Companies Act 2013, and we are going to study particularly these two kind of audits in this particular chapter. So section 128 refers to the books of accounts. Now what is to be audited? Books of accounts. Obviously books of accounts are to be audited. So the section, the Companies Act should prescribe the criteria of classifying a particular books as books of accounts, and section 128 defines what do you mean by a book of account and what is preparation of books of accounts and where should it be kept. So every company shall prepare and keep books of accounts, either physical or electronic mode, and other relevant books and papers and financial statements for every financial year at its registered office. Guys, point to be noted that the books of accounts are to be kept at the registered office and not at any branch offices. No, you have to keep books of accounts at registered office itself. However, the section is not stated over here, but I'll tell you, if you want to keep your books of accounts in branch office, then there is a provision whereby you have to intimate the ROC that you are maintaining these books of accounts in the branch office, and you will be permitted to keep your accounts at the branch office. But prima facie, the section requires you to maintain the books of accounts in the registered office, which gives a true and fair view of the state of affairs of the company. Now, this is an obligation carved on the management of the company, guys, that the management should prepare a books of accounts which give a true and fair view. So management is required to prepare books of accounts which give a true and fair view. Automatically the management should be held responsible if the books of accounts are not giving true and fair view. The auditor's responsibility is just to check whether the management has been able to successfully prepare the books of accounts which give a true and fair view.
Then the fourth condition is that on accrual basis, these books are to be prepared on accrual basis and according to the double entry system of accounting. So guys, there was a time when single entry system was there prevalent in India. Now this section particularly says that those times are gone and double entry system of accounting is to be put in the books of accounts while you are preparing the books of accounts. So this is section 128 books of accounts of the Companies Act 2013, and guys, do not study this section. This section is just for your reference. It is not relevant for the exam perspective. Now coming on to the main sections of the Companies Act relating to audit and auditors, and yes guys, from these sections, major part of your examination is the questions are asked from these particular sections. So first section and the foremost section is section 139, which deals with the appointment of the first auditor. How would the first auditor of a company be appointed? Section 139 deals with this particular aspect. Now the question is, sir, what do you mean by the first auditor? Definition is given in the footnote. Auditors who are appointed in the first year of incorporation of a company. Guys, in the first year, the time might be really less for having an AGM and appointing the auditor through shareholders resolution. The time would be really less for all those formalities to happen. So the Companies Act has given a leeway that if you are appointing the auditors for the very first time in the initial stages of incorporation of your company, then you can easily appoint the auditors using the board of directors instead of auditors being appointed by the shareholders. The board of directors can appoint the auditors. The reason being very simple, that in the initial year, in the first year of your incorporation, time is really less, guys. The year is not full year is only half a year. So company can be incorporated in middle of the year, towards the end of the year, towards the beginning of the year. Any time can happen. Can incorporation be taking place for a company? So in that situation, we don't have time to appoint our auditors in full-blown formal way through the shareholders meeting. So the first auditor of the company is to be appointed by the board of directors. The first auditor of a government company is to be appointed by the CAG, Comptroller and Auditor General of India. Guys, this is a government body which has been assigned the responsibility of conducting audit of government organizations. Now, what do you mean by government organization? They are the companies which are owned or controlled. So the conjunction used is or, which means either they are owned or controlled by a central government, state government, or partly by central or one or more state governments. So if a company has involvement of government in it in a majority form, then that company is liable to get its audit done by the Comptroller and Auditor General of India, and the auditor has to be selected by the CAG, and board is not authorized to select the auditor in this case. So first auditor for non-government company, board of directors; for government company, CAG. Time limit is within 30 days of date of registration of the company. So guys, ROC is the authority, Registrar of Companies is the authority where every company needs to get itself registered. Soon as the company gets itself registered, it gets a certificate of incorporation and then certificate of commencement of business. So soon as the company gets the certificate of incorporation, which is treated as the registration of the company, at that point in time, 30 days are given to the board of directors to appoint the first auditors of the company. For the government company, this limit is increased by 30 more days, which means total limit is given to as 60 days. So 30 days for non-government company, 60 days for government companies. Now, if the first auditor is not appointed by the board of director, then board of director shall inform the members of the company who shall within 90 days at an AGM shall appoint the auditor. So if the board of director fails to appoint the auditors of the company, then the authority is vested with the shareholders, who will take another 90 days and they will organize an EGM, extraordinary general meeting, and they will appoint the auditor. But yes, in 120 days the auditor has to be appointed in case of first time incorporation of the company. In case of government company, If CAG does not appoint the first auditor, then the board of directors shall appoint the auditors within next 30 days. In case board also doesn't fulfill the appointment of the auditor, then board shall inform the members, and members in next 60 days should appoint the auditors in an AEGM. So the auditors are to be appointed primarily by board of directors and CAG, and if they fail, then board of directors should approach the members, and if CAG fails, then there are two steps. CAG should approach the board of directors, and if board of directors fails, then the matter goes to the members of the company. So this is the appointment of first auditor of any company. Now what is the tenure of the first auditor of the company? Guys, first auditor shall hold office till conclusion of the first AGM. So if the AGM happens in the year of incorporation itself, then the first auditor shall hold its office till the first AGM, and if the first AGM happens in the subsequent year or the next year, then the first auditor shall hold its position till the next AGM. First auditor shall hold office till conclusion of the first AGM. In case of government company, the first auditor again should hold the office in till the conclusion of first AGM. So in first AGM, the auditors should be revised and new auditors should be appointed by the company, both government company as well as non-government company. Now comes on to a situation where first auditor has already been appointed and subsequent year has been started. So soon as subsequent year is started, guys, now we will follow the normal route, the real route of appointment of auditors. Yes, the first auditor was not the real route, it was the hush-hush route, it was the hurry route. Now comes the normal route, the normal procedure of appointment of subsequent auditors, which means after first year, how would the auditors be appointed till the company exist in future. So the auditors are to be appointed by the shareholders of the company, and we are referring to the statutory auditors. So statutory auditors are to be appointed by the shareholders of the company. So if we are referring to the statutory auditors, then who is responsible to appoint the cost auditor of the company? Guys, that is a separate discussion altogether. We will study that entire topic in chapter number 5. I'll just give you a small hint of what will happen over there. Cost auditors are to be appointed by the board of directors and not the shareholders. This is the difference between appointment of statutory auditor and cost auditor. So statutory auditor is the financial auditor. He will audit the financial books, and cost auditor will audit the cost books. This is the difference between a statutory auditor and a cost auditor. Sir, what can CMAs become? Statutory auditor or cost auditor? Guys, only and only cost auditor. CMAs cannot become statutory auditors of a particular company. Perfect. So in case of government company, what happens in case of government company? Guys, in case of government company, CAG appoints the auditor and CAG will ensure that within 180 days of commencement of the financial year, the auditor is appointed. And in case of non-government company, the auditor is appointed at the AGM. Now, what is the tenure of the auditor, which means till when is the auditor supposed to or can remain the auditor of the company? Till the conclusion of 6th AGM. So, till 6th AGM, the auditor, an auditor which has been appointed in subsequent year, can hold position as an auditor. However, in case of a government company, the auditor can be an auditor till the conclusion of the AGM, which means only 1 year. Now let me explain this particular aspect to you in little more great detail. Guys, if the auditor is appointed for year 1, then in AGM of year 1, then he will remain the auditor for year 2, year 3, year 4 and year 5. So he can audit the financial books till year 5. In year 6, he will not remain the auditor of the company. Soon as the AGM concludes for year 6, that person will not hold audit of that particular company. So in effect, the auditor will remain auditor for 5 years. Year 1, year 2, year 3, year 4 and year 5. In year 6, there has to be a new auditor. There has to be a new auditor.
And this is the concept of rotation of auditors, which has been introduced by the Companies Act 2013, and a very, very welcome step. This was not there, this section was not there in Companies Act 1956. It is only there in Companies Act 2013, and industry is really welcoming this change. That, sir, what is the logic behind this particular change? Why do we want to change our auditors after every 5 years? Sir, the auditor becomes so comfortable with the company in 5 years. He will understand the entire processes well in 5 years. Why do you want to change the auditor in every 5 years? Guys, this is the precise reason why we want to change the auditor every 5 years, because he becomes comfortable. Once a person becomes comfortable, once a auditor becomes comfortable, he will not be able to audit well or audit completely. He will be very comfortable with the financial accounts, and there is a possibility that he gets more easy with the finance people, and he leaves some errors while checking the accounts. To give you a simple example, guys, do you remember that in school this used to happen very often, that the students who were favorite of the teacher and who were securing marks regularly, high marks regularly, teachers used to become a little easy on their papers, and they would check their papers without applying a lot of mind, because of the notion that if this paper belongs to this particular person, it has to be correct. So this is the comfort level which definitely arises in any person's brain and mind and heart, and this comfort is really problematic for us, and we want to extract our auditors from this comfort zone, and therefore after every 5 years we want our auditors to change their stand, and new auditor should come in, and he should look at the financials from a different mindset, from a fresh mindset. This is the concept of rotation of auditors. Now, just to give you an example, guys, a comparison, cost audit is not subject to provisions of 139, hence it is not subject to rotation provisions. So for statutory auditors, rotation provisions are applicable, but for cost auditors, rotation provisions are not applicable. Now, what are the prerequisites before appointment of auditor? Who can become an auditor, and what are the things which auditor should take care while being appointed as an auditor? Of course, guys, the auditor can only be a person who is a chartered accountant and who has got certificate of practice. So, financial auditor can be a person only who has cleared the CA examination and has obtained certificate of practice. Now, what are the certificates which a statutory auditor should have with himself? He should have a written consent of auditor to such appointment. He should give a written consent of his appointment. Then his appointment should be as per the conditions mentioned under Companies Act, which means that he should not be indebted. He should not be disqualified. He should not have some dependency on the company. He should not be an employee of the company. We will be studying all these conditions which are prescribed under the Companies Act very, very shortly in this chapter. So, second condition is that he should fulfill all the conditions which are mentioned under Companies Act. Third is he should give a certificate regarding his fulfillment of criteria specified under section 141. Guys, 141 section deals with the disqualifications of the auditor. So the auditor should state that in writing that he is not disqualified from being appointed as the auditor of the company. So this certificate is also required by the company. Sir, what are those criteria, or what are those cases where the auditor is disqualified from being appointed as the auditor? Guys, we'll be studying this aspect in section 141 very, very shortly. The company shall inform the auditor concerned of his appointment and also file a notice of such appointment with the registrar within 15 days of the meeting in which auditor is appointed. So the company's responsibility is to file a notice of such appointment with the registrar. Now, there's a very specific section, guys, and an important one: casual vacancy. Now, we have studied how can an auditor be appointed under section 139. Suppose you have appointed the auditor within the statutory timelines of AGM and 180 days of commencement of the financial year. However, soon as the appointment happens, the auditor dies. When auditor dies, or he resigns or he becomes disqualified, he ceases to exist as an auditor of a company. When he ceases to exist as an auditor of the company, this vacancy in the auditor's place is known as casual vacancy. Now there are three situations when casual vacancy can happen, guys. One is death of the auditor, second is resignation of the auditor. So auditor can not remain the auditor if he dies, or if he resigns, or if he becomes disqualified. In these three situations, there would be a casual vacancy which arises in the company, and obviously if a company is conducting the business, then it requires an auditor for sure. So what will happen if the auditor suddenly dies or resigns, or he is disqualified? He becomes disqualified after the appointment. So sir, how can he become disqualified after the appointment? Guys, during the appointment, when he was being appointed, then he was not an employee of the company, but after he was appointed as the auditor, he became the employee of the company. This is when he will be disqualified after being appointed as the auditor of the company. Now what will happen in this case? New auditor should be appointed. Obviously guys, my company cannot remain without an auditor. There has to be an auditor in my company all the time. So board of directors have the responsibility to appoint the auditor in case of a casual vacancy, and in case of government companies, it is always CAG, Comptroller and Auditor General of India, who will appoint the new auditor. Time limit 30 days of occurrence of vacancy. Within 30 days, the board of directors should appoint the new auditor in place of the auditor who has died, or who has resigned, or who has become disqualified. Similarly, 30 days of occurrence of the vacancy. Same limit is there in non-government companies and government companies. Now, in government company, if CAG does not fill the casual vacancy, then the board of directors will fill the casual vacancy till the next 30 days. Special condition in case of casual vacancy on resignation of the auditor. Now, amongst the three situation, guys, one situation is really critical, which is the resignation situation, because it is not usual for anyone to resign from his job. So if resignation has happened, then there has to be some special things which you need to take care of. What are those special things? In case of non-government company, the resigning auditor should file a statement with the company and registrar stating reason for resignation. Guys, everyone should know why a person has resigned from a particular company, because obviously that person is earning amount of money, a good amount of money from that company. Then why should he resign from that company? There is no reason for it. So the reason has to be stated in writing to the company as well as the registrar. Then appointment of new auditor should be approved by the company in AGM in case of resignation, because shareholders should also come to know that the auditor has resigned. Such new auditor holds the office till conclusion of the next AGM only. So the new auditor who has been appointed, he holds the office till conclusion of next AGM. In case of government companies, the resigning auditor should file a statement with the company and the registrar and the CAG stating the reason for resignation. So in this case, there is one additional party whom we are required to inform, which is the CAG. Then section 139, conditions for reappointment of retiring auditor. Now, if you want to reappoint the retiring auditor, now first of all, please understand what do you mean by retiring auditor. Retiring auditor means an auditor whose tenure has ended. So the maximum tenure which an auditor can have is 6 years. But sometimes company appoints an auditor for say 2 years. So at the end of 2 years, the auditor becomes retired. So if the company feels that no, for the 3rd year also we want the same auditor, then the company can reappoint that particular auditor for 3rd year, 4th year and 5th year. Guys, please note that for 6th year, the auditor cannot be reappointed in any case. So the reappointment of retiring auditor can happen only for 2nd, 3rd, 4th, 5th year. This can also happen that in the 1st year itself, the auditor is appointed till 5th year cumulatively. So in that case, the reappointment of retiring auditor cannot happen in the 6th year at all. This is the section 139(1) which deals with conditions for reappointment. Conditions are: he shall not be disqualified for reappointment. Obviously, he should not be disqualified under section 143, various subsections which we are going to study in a while. Second is he has not given a company a notice in writing regarding his unwillingness to be reappointed. So if he himself doesn't want to get reappointed, then we cannot do anything. So he cannot be reappointed if he doesn't want to be reappointed. A special resolution has not been passed at that meeting appointed some other auditor or providing expressly that he shall not be reappointed. Now, a special resolution appointing some other auditor shall not be passed. So if you have already passed a special resolution whereby another auditor has been appointed as the auditor, then guys, your retiring partner cannot be reappointed as the auditor of the company. He has not furnished a written certificate that he is eligible for sealing under section 141(3)(g). So if an auditor has not filed a declaration that under 141(3)(g), I'll tell you in brief, we are going to discuss in detail subsequently. 141(3)(g) states that an auditor can only audit 20 companies in a particular year. Beyond that, it cannot audit any further companies. So the auditor has to file a declaration that yes, I am the auditor for 20 companies only. This is really important if the auditor wants to be reappointed as the auditor of the same company. Where at any AGM no auditor is appointed or reappointment, the existing shall continue to be auditor of the company. So if at any AGM new auditor is not appointed, then the existing one is continued till the fifth year, because in sixth year the person cannot be reappointed. In the sixth year, the AGM should have been conducted, the shareholders should have appointed a new auditor. Now we are going to study the application of rotation provision in great detail, guys. Now this is a very important section of our Companies Act, and it has really been successfully being playing in the corporate world. And this section is read with Rule 5 of the company's rules. So Rule 5 read with section 139 is the section for rotation of auditors, which we are going to study in great detail now. So first of all, applicability. So not all companies are applicable for rotating their auditors every sixth year. Yes, there are certain companies which categorically are big companies which come under purview of rotation. We don't want to unnecessarily exploit or disturb the small companies, because in small companies even the same auditor can be the auditor again and again and again. So we don't want to disturb, or we don't want to create nuisance for the small companies. Hence, only listed companies, all the listed companies are required to get their auditors rotated, and unlisted companies having a paid up capital of 10 crore or more, or having a borrowing of 50 crore or more, should be eligible to get their auditors rotated. Then private companies, this was referring to unlisted public company. Now we come on to private company. Private company having a paid up share capital of 50 crores or more, or borrowings of 50 crore or more, are required to get their auditors rotated. Exclusions is one-person company and small company. So one-person company and small company, even if their turnovers are huge as stated in these limits, even in those situations, guys, OPC and small companies are not required to get their auditors rotated. Now, types of auditor. Now, we will see till when can an auditor be become an auditor of a particular company. Okay, so the retiring auditor, if an individual is the auditor, individual is a proprietor firm and the proprietor is the auditor, then the retiring auditor shall not be reappointed for more than one term of initial 5 years. So 5 years is the limit for a proprietor. Proprietor means a single auditor, which a partner who is the only partner of a particular partnership firm. In that case, guys, for 5 years the rotation principle happens, and
After 5 years, there has to be a new auditor in case your auditor is an individual auditor. However, where your auditor is a firm of auditors and an LLP or an LLP, which means there are multiple partners of that particular audit firm, then in that case, your rotation period is extended for 2 months of initial 5 years, which means your rotation periods extends for 10 years. So in case of individual auditor, means proprietor auditor, the tenure of rotation is after 5 years, and in case of firm or LLP, which means that you have multiple partners, you have multiple partnership, you have a partnership deed whereby multiple partners are sharing your profits. In those case, 10 years is the limit when you will be required to, after which you will be required to rotate your auditors. If a partner who is in charge of an audit firm and also certifies financial statements of the company retires from the said firm and joins another firm of chartered accountancy, such other firm shall also be ineligible for appointment for a period of 5 years. Now this is to plug a loophole in law, so people can exploit law by stating that we were a partner in so and so firm, but now we have resigned from that firm and we are partner in some other firm, and the audit is done by some other firm. So guys, if you were a partner in a firm where audit had happened earlier, and if you become a partner in a new firm, then the new firm is also not eligible to do audit of that particular entity after a period of 10 years. So these were the provisions of rotation. Now we come on to the provisions of cooling off period. Guys, what is this cooling off period? Cooling off period means, so an auditor has been appointed for a period of 5 years. Then he is not eligible to be appointed in the 6th year. Sir, till how many years will he not be eligible to be appointed as the auditor of the same company? Guys, 6th, 7th, 8th, 9th and 10th year, he will not be allowed to be appointed as the auditor of the same company in which he was the auditor in the first 5 years. Sir, which means that in the 11th year, 12th year, 13th year, 14th year and 15th year, that person will be allowed to be an auditor of that company. Yes, your interpretation is absolutely correct. So rotation will happen at the end of 5th year, and cooling off period will begin from end of 5th year till end of 10th year, and in the beginning of 11th year, the same person who was the auditor in 1st, 2nd, 3rd, 4th year, he can very well again become the auditor of that particular company. This period is known as cooling off period, because in this period the auditor is given time to forget about all the things which he knows about the company, and 5 years is a sufficient time to make any person forget about everything about the company, because we want our auditor to start afresh with a fresh bend of mind. So we give a cooling off period to our auditor before he is reappointed as the auditor of a particular company, same company again. So these were the two most important provisions, guys, of the company's audit: rotation of the auditor and cooling off period. You have to really understand and learn the time limits very, very well. So I leave the case study up to you. You have to study the case studies yourself. These are important case studies because in examination also questions are asked from these case studies. Now coming on to section 141, removal before expiry of the term. Now we have studied about resignation of the auditor. Auditor doesn't want to continue with the organization. Now it can so happen that organization doesn't want to continue with the auditor. Organization is saying we don't want the auditor to be auditor of the company even before the expiry of his term. So if the auditor is appointed from 1st year to 3rd year as the auditor, then in the 2nd year the company is saying no, we don't want this auditor in the 3rd year, we want some other auditor in the 3rd year. This section deals with this particular situation, removal before expiry of the term. We will also study section 146
subsection 4, which will tell us the removal after expiry of the term. So if the term expires, which means the auditor was appointed for first to third year, and after the third year the company is asking the auditor not to be reappointed, because the auditor can be very well be reappointed for fourth and fifth year as well, but the company is saying no, we are not going to reappoint the auditor for fourth and fifth year. This is known as removal after expiry of the term, which we will be studying in 144. Currently we are studying 141, where the removal happens before expiry of the term. And guys, this is a much more serious concern, because when a company appoints the auditor and the auditor is appointed for a particular tenure, then what is the reason why the company has removed the auditor before expiry of the term? This is a very serious concern. Therefore, first of all, a board resolution is to be passed to remove the auditor before expiry of the term. Then application has to be made to central government within 30 days of the board resolution to tell the central government that yes, we are taking this drastic step of removing our auditor for whatever reason stated in the application. Then company holds a general meeting within 60 days of receipt of approval of the central government and pass a special resolution informing the shareholders and also taking their consent on removal of the auditor. Then the auditor concerned shall be given a reasonable opportunity of being heard. The auditor should be asked why should he not be removed from the auditorship, and after doing all these 4 steps, the company can remove the auditor of the company before expiry of the term. Now let me jump on to after expiry of the term. Guys, this procedure will not be that difficult, will not be that stringent, because after expiry though I can anytime change my auditor. This is my prerogative. Yes, before expiry changing was a little suspicious activity, but after expiry it's no suspicion. So removal after expiry of the term, unless the auditor has completed a consecutive term of 5 years or 10 years, the removal shall be approved by resolution in AGM after giving a special notice. So only AGM approval is required, no central government involvement is required. If you pass a resolution in AGM, that is more than sufficient. The special notice must contain information on representation made by the retiring auditor. If retiring auditor wants to say something about his retirement, then he can tell it. The copy of representation shall be sent to all the members. If copy of representation is not sent because it was received late, then auditor may require that representation be read out in the meeting. Whatever auditor has to state in his favor, the auditor can compel the board of directors to read those things out in the board meeting. Company or any other aggrieved party may apply to tribunal for not sending or reading the representation if this right is being abused by the auditor. If the tribunal is satisfied the auditor is misusing this right of representation, then the copy of representation may not be sent and the representation need not be read out loudly in the meeting. So if we think that our auditors, out of anger and out of frustration, are not doing certain right things, and through this representation they might mislead or misguide the shareholders and other concerned parties, then we can approach the tribunal and request the tribunal to pass an order that the auditor be not allowed to represent before the board of directors and the shareholders. So that provision is also there. But did you see the difference, guys, between before expiry and after expiry? Guys, after expiry all the things happened within the company. However, before expiry things went on to central government. So this is the major difference between before removal before expiry and removal after expiry of the tenure. Now let us come on to 2 sections which are sandwiched between these 2 big sections, and we could actually skip those sections. And the sections are resignation of the auditor. 142, the auditor shall file within a period of 30 days from date of resignation a statement with the company and the registrar. If the auditor resigns from his duties, so we had already studied that if an auditor resigns, then the vacancy is known as casual vacancy. So in case of casual vacancy, the auditor has to file within 30 days a statement with the company and the registrar. The auditor of government company shall additionally file the statement with CAG. So auditor of government company will file 3 statements, one with the company, one with the registrar, and third with the CAG. Breach of section 142, if the auditor does not fulfill the provisions of section 142, that means while resigning he does not file an intimation to either of these parties, then what will happen? If the auditor does not comply with the requirement of section 142, he or it shall be punishable with a fine of 5,000 to rupees 1 lakh. There is a penalty for this particular offense of an auditor. So we need to take care that our formalities, legal formalities are fulfilled as per section 140 subsection 2. Got it, sir? Now coming on to section 140 subsection 5, directions by tribunal for removal of the auditor. Now it may so happen, guys, that the removal of the auditor is not done by the company but is done by the tribunal through an order. So if any third party apart from the board of directors or the company complains or files a letter to tribunal, files an appeal to tribunal asking the tribunal to order for resignation of a particular person as the auditor of the company, then the tribunal has got powers to remove the auditor of the company at any time whenever it wants. So if the tribunal is satisfied that the auditor of the company has acted in fraudulent manner in relation to the company or its directors or officers, it may by order direct company to change its auditors. Such direction may be made suo motu by the tribunal. Tribunal can make the direction themselves. There is no requirement of anyone to file the appeal in this case, or an application made to the tribunal by a central government on any other concerned person. So tribunal has got this right of removing an auditor from a particular auditorship. Guys, auditorship is a very, very critical matter. Please understand that auditor of the company is just like a policeman or the guard standing at the gates of the company. And if guard is not performing his duty well, then the company is at a risk and public money is at a risk. So tribunal has the power to remove this risk and ensure that the auditor is doing its duties well. If the application is made by the central government and the tribunal is satisfied that any change of auditor is required, it shall, within 15 days of receipt of such application, make an order that he shall not function as an auditor, and the central government may appoint another auditor in his place. Now, this is the question of a government company. In case of a government company, the application can be made by the central government and the tribunal has to follow this application and has to give its order within 15 days of receipt of the application. An auditor against whom final order has been passed by the tribunal under this section shall not be eligible to be appointed as an auditor of a company for a period of 5 years from the date of passing of such order. Now this is a very, very harsh and a stringent section, guys, and you must have heard that PwC was under realm of this particular section, whereby because of the fraudulent activities which were done by PwC, this section was being provoked for PwC. Similarly, very, very recently, this section was also being revoked for Deloitte and KPMG in IL&FS case, and they were also being barred from doing audit of a particular of doing audit of companies for a period of 5 years. So yes, this is a very, very stringent and a very strict section which is to be carefully followed by all the auditors. Now we are coming on to eligibility, qualifications and disqualifications of a auditor. Section 141, guys, deals with the qualifications and disqualifications of the auditor. Who can be auditor? Can any Tom, Dick and Harry be an auditor? The answer is an obvious no. So this section will expel out the conditions required to become an auditor of a company and what are the safeguards which are to be followed by any auditor of the company and what are the things which are to be avoided to become an auditor of the company. So let's start this section 141. The person shall be eligible for appointment as an auditor of the company only if he is a chartered accountant. So Companies Act requires a degree of chartered accountancy for conducting the financial audit of a particular company. A firm whereof majority of partners practicing in India are qualified for appointment as aforesaid be appointed by the firm's name to be the auditor of the company. Then if a person is collaborating with several partners and has become a firm, then the firm is also eligible to be appointed as the auditor of the company. Where a firm including LLP is appointed as the auditor of the company, only partners who are chartered accountants shall be authorized to act and sign on behalf of the firm. So in case a firm or an LLP is appointed as the auditor of the company, then only those partners who are chartered accountants can become the signing partners of that particular audit. So audit should be signed only and only by chartered accountants. So guys, in LLP Act, there is a provision that cost accountants, company secretaries and chartered accountants, all three can be the partners. So in that case, the signing authority of an audit is to be given only and only to the chartered accountant and not to the remaining three partners. Then section 141 subsection 3 read with rule 10, which deals with disqualifications of the auditor. Guys, these are the points to be watched out for, and if you are not taking care of these points, then you run a risk of becoming a infructuous auditor. Infructuous auditor means you are not an auditor at all if you fall under any of these clauses. These are disqualifications of auditor. You cannot afford to mess around with this particular section. This is the most important section in life of an auditor. An auditor has to take care of this section at any cost. First disqualification is in respect of a body corporate. Guys, a company cannot be an auditor of a particular other company. Why is this restriction? This restriction is primarily for a reason that the body corporate has a concept of corporate weal. So the owners are different from the people who are managing the organization. In such a case, liability has to be restricted to only the paid up share capital of the owners. And therefore, a body corporate cannot be an auditor of the company, because we want a situation where the auditor can be held responsible severally and jointly and unlimitedly to any fraud which happens which happens in the audit firm or which happens by the auditor. We don't want a situation where the auditor says that no, I have limited liability towards this particular audit. We want unlimited liability to be there for the auditors, and therefore body corporate cannot be an auditor of the company. Officer or employee of the company, an auditor cannot be an officer or employee of the company. Naturally, guys, if an auditor is an officer of the company, then he will be under influence of the company, and we don't want our auditors to be under the influence of any person while doing audit. Then third disqualification is a person who is a partner or who is in employment of an officer or employee of the company. A person who is a partner of a company, of an employee of a company, or who is in employment by the officer or employee of the company, then that person can also not be auditor of that particular company. Again, the point of influence comes over here, because an employee of the company would have an influence over the auditor, and therefore the employee's partner or employee's employee cannot be an auditor of the company. Again, the point of influence comes over here. A person who or his relative or partner is holding any security or interest in the company. So guys, if the auditor does not hold any security in the company, or any kind of relationship is not there of the auditor, but his relative is his relative means the auditor's wife is holding securities of the company, or auditor wife is not independent, then guys, it will be presumed that even the auditor, even the person who's auditing, is also not independent. So a person who or his relative or partner is holding any security of or interest in the company or its subsidiary of, or of its holding associate or company of such holding. So you should not be holding securities of a particular company, provided that relative may hold security or interest in the company with face value not exceeding 1 lakh. Now this is an important one, guys. So if you are the auditor, then you can hold securities worth ₹0. But if you are a relative of the auditor, then guys, you can hold securities worth ₹1 lakhs. But remember that this security should be 1 lakh should be the face value. Market value can be, yes, in several crores, 2 crores, 3 crores, 4 crores, whatever you like. But the face value should not be more than 1 lakhs. Provided further that in event of acquiring and security or interest by relative above the threshold limit, the corrective action to maintain the limits specified above shall be taken by the auditor within 60 days of such acquisition of interest. So if post employment the auditor comes to know that his relatives have acquired certain securities in a particular company, then within 60 days those securities are to be sold off. If you do not sell off those securities within 60 days, you will be termed as disqualified for doing audit of that particular company. Next is that the auditor is indebted to the company. Auditor should not be indebted to the company. Indebted means the auditor should not have taken any loan from the company or its subsidiary or holding or associate company or subsidiary of such holding company in excess of 5 lakh rupees. So the auditor cannot be indebted to the company above 5 lakh rupees. Auditor should not have given guarantee or provided any security in connection with indebtedness of any third party to the company above rupees 1 lakh. Now this is an important provision, guys. The auditor cannot take guarantee of a particular company, because guys, taking guarantee is equivalent to giving loan to the company. There is a equal risk that if loan is not fulfilled, is not repaid, then the guarantor repays the loan. So even if a person has given guarantee to a particular for the loan of the company, then he cannot be an auditor of the company. So guarantor cannot be an auditor. Next is a person or a firm who, whether directly or indirectly, has business relationship with the company or its subsidiary or its holding or associate company or subsidiary of such holding company, associate of such nature as may be prescribed. So a person who has directly or indirectly any business relationship. So guys, you cannot have business relationship with your audit client. So if suppose you have auditor as Adidas, you cannot be supplying shoe soles or rubber to Adidas. You are a chartered accountant. If you are a chartered accountant, you are not supposed to supply shoe soles. So business relationship should not be there with a particular company if you want to be an auditor of the company. Again, what is the reason? Reason is, guys, influence. If you are a creditor of that company or debtor of that company, the company will be able to exercise undue influence on you. So you cannot be directly or indirectly, you cannot be in any business relationship with that particular company. And guys, business relationship has been defined to mean any person who is into any commercial transaction which are in nature of professional services permitted to be rendered. So if any transaction you have entered into a transaction which is permitted, which means an auditor can perform, then you are not eligible to be as treated as defaulter under business relationship. So these are the things which are excluded from business relationship. Number one, commercial transaction which are in normal course of an purview of an auditor. For example, tax consultancy. If you are providing tax consultancy, no one has any problem. You can very well be an auditor of the company and also be a tax consultant of that particular company. No one has any problem in it. But yes, if you are an auditor of the company and you are supplying shoe soles or rubber or plastic or leather to the company, then there is a questionable transaction. Then second is commercial transaction which are in the nature of ordinary course of business of the company and at arm's length price, then you will not be disqualified as the auditor of the company. So for example, if you are auditing Holiday Inn group of resorts, and Holiday Inn, you are also buying their rooms and you are staying over there overnight, and you are paying full fare of those particular vacation days when you are spending time with your family. Guys, in those cases also, we will not say that you have any business relationship, because it is a perfect commercial transaction which you have entered into with that particular entity. So a person whose relative is a director or is an employment of a company or is a director or a key management personnel in the company, that then audit cannot be given to that particular person. A person who is in full-time employment elsewhere, or a person or a partner of a firm holding appointment as its auditor. So a person who has done employment, who is into employment somewhere else, he cannot be an auditor of a particular company. Or this is the very important, most important part of your eligibility criteria 141(3)(g). He should not be appointed as the auditor for more than 20 companies other than one-person company, dormant company, small company, private company having paid up share capital of less than 100 crores. This is the most important provision of your 141(3) section, guys, because it gives you a ceiling on number of audits, and the ceiling is 20 audits. So more than 20 audits, a person cannot have an audit. And remember, this 20 limit is per partner and is not on the whole firm. So if a firm has 4 partners, then the limit is increased to 80 audits per firm. So 80 audits, 20 audits per partner means 4 partners, so 80 audits can be performed by that particular firm. A person who has been convicted by a court or offense involving fraud and a period of 10 years has not elapsed from date of such conviction. So a person who has been convicted by a court for any forgery, for 10 years that person cannot be appointed as the auditor of that particular, of any company in entire India. A person who directly or indirectly renders services under section 144. So guys, if you are rendering services under section 144, then you will not be eligible to be appointed as the auditor of the company. And what are these services? Accounting and bookkeeping service. Of course, you cannot keep books of accounts of that particular company. Internal audit, design and implementation of financial system, actuarial services, investment advisory services, investment banking services, rendering of outsourced financial services, management services, any other services which may be prescribed. And guys, there is no other service which has been prescribed. So only these 8 services are prohibited services for any auditor. So auditor cannot give services of these kind to the audit client. Yes, even if they are services which auditor can give. So guys, accounting and bookkeeping service can be given by a chartered accountant, but no, this is not a usual commercial transaction. This is a different section altogether, and the section specifically prohibits you to give these services to your clients if you want to do audit of that particular client. So this is the section of disqualification of a particular auditor. If you do not follow any of the subsections of this section, then you are not eligible to be appointed as the auditor of that particular company. Now let's come on to the section 141.4, which deals with the subsequent disqualification of an auditor. Guys, what can happen is that when the auditor was appointed, he was not disqualified. He was very much eligible to be appointed as the auditor, and he was not disqualified. But soon as he is appointed, he has entered into certain transactions which were not supposed to be entered into by him. So what happens in subsequent disqualification, where a person appointed as an auditor of the company incurs any of the disqualification mentioned in subsection 3 after his appointment, so appointment has happened but disqualification happens after it, he shall vacate his office. Vacate means he shall leave his office. He shall leave his office as an auditor, and such vacation shall be deemed to be casual vacancy. This is an example of casual vacancy again. And you know what happens in case of casual vacancy, guys? Within 30 days, the board of directors have to appoint a fresh auditor of that particular company. So this is the section of subsequent disqualification of an auditor. Now what is the provision of remuneration of the auditor? Who is eligible to be fixing the remuneration of the auditor? Guys, I'll give you a very easy way to learn this. Whosoever appoints the auditor remunerates the auditor also. So first auditor is appointed by the board of directors. So remuneration including out-of-pocket expenses are fixed by the board of directors. The subsequent auditor is appointed by the shareholder in the general meeting. Hence the remuneration is also fixed by the shareholder in the general meeting for subsequent auditors. Simple. Whosoever appoints has the right to fix the remuneration as well. However, this does not include any remuneration paid for him for other services rendered by him. Like any other service which the auditor renders, those remuneration should be fixed by anyone in the company, not necessarily by the shareholders or the board of directors as prescribed under this section. Alright, now comes on to 3 sections which are interrelated to each other, and these 3 sections are powers and duties of the auditors, then who has to sign the audit report, and who can auditor be authorized to attend the general meeting. Can auditor attend the general meeting of a particular company? These sections are dealt with in these in the subsequent paragraphs. What are the powers and rights of the auditor, guys? First power is right to access the books of accounts. Books of accounts
are the basic things which the auditor looks at and which the auditor audits. So the first and foremost right which the auditor should get is the right to access the books of accounts and the vouchers. What is voucher, guys? Vouchers are the documents or the evidences which are in support of the transactions which have been entered into by the company. So these are the supporting documents. So the auditor should catch hold of the books of accounts as well as the supporting documents which proves that books of accounts are correct. Then the auditor has right to inquire. He can ask anything, any information or explanation he can ask from the management of the company. All these explanation can be asked by him. Then in case of a holding company, he has right to access records of all its subsidiary, because as you are aware that the accounts of holding company are nothing but an amalgamation of accounts of all the subsidiaries. So the auditor has the right to catch hold of records of all the subsidiary companies. Then the auditor has right to receive notices, to attend and to be heard in general meetings. The auditor has the specific right to attend the general meetings and to receive notices of the general meeting. Obviously, guys, auditor has the right to inform the shareholders about whatever mistake, whatever errors are happening in the company. So he has the right to come at the general meeting as well. Then he has right to report to the members of the financial statements whether they give true and fair view or not. We have studied this in great detail in chapter number 2. What are the objectives of the auditor? Then he has right to lien. Lien, guys, means that having a lawful possession of somebody else's property in event of non-payment of dues. So the auditor has the right to lien the books of accounts, which means he can take the books of accounts with himself if the client has not paid fees for his work. Now, guys, this section becomes a little redundant these days because the books of accounts are not prepared in physical form. They are prepared online. So the maximum the auditor can take is the vouchers or the supporting documents, but not the books of accounts. So this lien section becomes a little less effective. In case of government companies, CHG has the power to test, audit or do supplementary audit. So in case of government companies, the CHG can order for another audit after getting audit done by one auditor. If the CHG is of a notion that no, I am not satisfied with the audit which is done by the first auditor, he can audit a supplementary audit, or he can conduct a test audit of certain transactions again. Now, obviously, with rights come some certain duties also. So what are the duties of the auditor? First of all, he has to inquire into all relevant matter, guys. He cannot leave any stone unturned, any transaction not checked. He cannot leave that. He has to inquire on all the transactions. Secondly, he has to report on the truthfulness and fairness of the financial statements, and he has to report according to CARO. CARO is the order which states that there are certain 16 elements which the auditor has to mandatorily report on. So these 16 elements, auditor has to say something, yes or no, whether these 16 things are right or wrong. So I'll give you an example. So whether the loans and advances which are given to given by the company, whether they are prejudicial to the interest of the company, whether they harm the interest of the company or not, which means whether they will be repaid to the company or not. Auditor has to mandatorily comment on this particular aspect in CARO report. Similarly, auditor has to mandatorily comment on whether the fixed assets are properly verified by the physical verification process of the company or not. So the auditor does this particular testing also and reports about this aspect in the CARO. So auditor has to report about certain things in the audit report which are included in CARO. To report on adequacy of internal financial controls. So internal financial controls, whether they are working fine or not, auditor has to state. Auditor has to state the reason for qualification. If any qualification has been given by the auditor, auditor has to state reasons for that qualification. Why has he given that qualification? So just saying that CAS or accounting standard 2 is not followed is not sufficient, guys. The auditor has to give a proper explanation that if accounting standard 2 has not been followed, then what has been done by the auditor? What is the reason for not following accounting standard 2? What are the alternative things which the company has done?
So all these things are to be stated by the auditor. To report on branch financials after considering report of the branch auditor. So if there is a branch which has been audited by some other auditor, then the auditor should state the findings of the branch auditor as well. Now this is one of the most important duties of an auditor, guys. In case of fraud, the auditor has to report to the officer or the employees, and the auditor shall take following steps. As soon as fraud is discovered by the auditor, he should not wait for his audit report to get finalized. He should do certain things immediately. So where the amount involved is 1 crore or above, the auditor should report the matter to central government within such time as may be prescribed, and the prescribed time is 60 days. Within 60 days, the auditor has to approach the central government and tell them that fraud has been discovered in this particular company. Where the amount involved is less than 1 crore, then the auditor need not go to central government. It can just inform the audit committee or the board of directors within such time. Additionally, the details about fraud should be disclosed in the board report. The auditor should make sure that the details about this fraud are mentioned by the board in its report. That is very important step which is to be ensured by the auditor. Then provision related to fraud are equally applicable to cost auditors. Cost auditors are also required to report to central government if any fraud has been noticed by the cost auditor. Then who can sign the audit report? Of course, the auditor should sign the audit report. Where a firm including LLP is appointed as an auditor, only partners who are chartered accountants can sign the audit report. No CMA can sign the audit report of statutory audit. No CS can sign the audit report of statutory audit. No lawyer can sign the audit report of statutory audit. Now, next thing is to comply with the auditing standards. The auditor should comply with the auditing standards. He should also report any matter if it is to be specified. If it is specified by the central government, the auditor should report any such matter to the central government if central government has specified those matters. The next section is section 147, which deals with the punishment for contravention of the above mentioned sections. So if the auditor or the company or the officer of the company are not able to fulfill any of the conditions prescribed under section 139 to 146, then they are eligible to be penalized as per section 147. So 147 is the penalty and punishment section for any contravention with respect to auditor's section. So first of all, for the auditor, what is the contravention of, what are the penal consequences for an auditor? If the default is an unknowing default, which means that auditor was not aware of a particular thing and there's an unknowing default, then the fine is from 25,000 to 5 lakh rupees. And in case of a knowing default or a willful default, where the auditor was aware about the default and he still committed that default, fine will be of 1 lakh rupees to 25 lakh rupees and imprisonment of 0 to 1 years. Where the cost auditor is convicted, he or she shall also be required to refund the remuneration. This is the worst thing which auditor has to face. He has to refund the remuneration received by him from the client. He shall pay damages to the company or statutory bodies or authorities or to any other person for loss arising out of incorrect or misleading statements. So these are the two consequences apart from penalty and prosecution. These are the consequences which the auditor has to face. For the company, if there is a default by a company, then the company will be fined from 25,000 to 5 lakh rupees. And for the officer, if we are talking about the officers of the company who are at default, who have not followed the provisions of these sections properly, then they will also face a prosecution of 0 to 1 years, and they will also face a fine of 10,000 to 1 lakh rupees. Now we come on to a very important section of our syllabus, guys, audit committee. And audit committee is a committee which is specially formed for overview of the audit, for ensuring that audit has been done in a proper manner, for fixing remuneration of the auditor, for ensuring that the qualifications which are there in the audit report are not repeated in the next audit. So all these are the responsibilities of an audit committee, and the audit committee is required to be maintained by the following companies. These are mandatory by the following companies. Number one, listed company has to make an audit committee. Then all public companies with paid up share capital of 10 crore or more are required to construct an audit committee.
All public companies having a turnover of 100 crore or more, and all the public companies having an aggregate outstanding loan or borrowing or debentures exceeding 50 crores or more. So 10, 100 and 50. Paid up share capital, turnover and loans. These are the limits for constitution of audit committee. These companies have to mandatorily constitute an audit committee. Then what is the constitution of audit committee? An audit committee shall have minimum 3 directors. Majority of them should be independent directors. Majority of the members of audit committee should be able to read and understand the financial statements, because obviously the purpose of audit committee is to prepare and assist the auditors in preparation and checking of the correct, true and fair financial statements. So the members of the committee should be financial statement literate. They cannot be marketing people, they cannot be sales people, they cannot be HR people. What are the functions of audit committee? The functions are appointment and fixation of remuneration of the auditor, examination of financial statements, scrutiny of intercorporate loans, valuation of assets of the company, evaluation of internal financial controls, risk management. All these things are responsibility of a audit committee. Evaluation of related party transaction, use of funds which are collected through public offers. What are the powers of audit committee? What can audit committee do and what it can't do? It can call for comments, observation of the auditor about internal control system. It can review the financial statement before they are submitted to the board and before they are submitted to the auditors. It has to discuss the issues with the statutory and internal auditor and the management of the company in relation to the matters contained in the financial statement, and the audit committee has to make sure that if there is a qualification in the financial audit report, then that qualification is not repeated by the management in the next or subsequent terms. So these are the powers of audit committee, and this finishes our most important chapter number 4, which is company audit. And guys, you have to do all these practical questions yourself so that you are able to attempt the questions which are coming in the examination well. And yes, this chapter holds approximately 12 marks, which is really a big score out of 50 marks. So you have to do this particular chapter well, revise it well, and if you face any problem, just give me a call or drop in a message and I'll be able to help you for your queries. On that note, we'll meet in our next part of our marathon, and at this point in time, I wish you all the very best for your examination, guys, because now very few days are left. I know you must be brushing up your last moment revisions. So all the very best and happy studying.
For latest updates and information on entire CMA profession, just subscribe to our channel and don't forget to press the bell icon to get notification on the latest videos which are being uploaded on the channel. For products related to paper number 19, paper number 20 for final students and paper number 12 for intermediate students, log on to www.agrawallawhouse.com. It contains the compilation of handwritten notes, books, reference materials and video lectures of these 3 subjects. If you have any further query or you want to speak to me personally for any kind of counseling, you can call me at the number given on the screen.
Hello and welcome, guys, and welcome to the next part of the audit marathon. And yes, I know your exams are around the corner and I know you will be really busy with your schedule of studying and revising your syllabus. Guys, all the very best for your examination and just a few days to go. So I would just like to tell you that do not lose hope, be confident of whatever you've studied and just revise your syllabus as much as you can, because that is the key to success in your examination. Especially for the inter students, revision is the key to both theory and practical subjects, and during the 1.5 days or half day respectively for the students who are giving one group only and the students who are giving both the groups, guys, in that short tenure you have to prepare your notes in such a way that during that short tenure you are able to revise only the key aspects of the entire syllabus, and you need not refer to the entire study material or entire book before that one day. So yes, today we are going to start chapter number 5 of audit, and the chapter deals with 2 specific kinds of audit, which is one cost audit and second is secretarial audit. Guys, cost audit is the monopoly of CMAs, and CMAs are only authorized to do cost audit, and secretarial audit is the monopoly of company secretaries, and company secretaries are supposed to do secretarial audit. So these are kind of audits which are statutory audits, and they are
statutorily to be done by the respective professionals. Guys, during start of our audit syllabus, I had told you that audit can be of various types, and whatever audit is there, its rules and its regulations govern what is to be done in that audit. So if there is an environment audit, then environment law will tell you what is to be done in that particular audit. So cost audit is a special kind of audit which relates only and only to the cost records, and cost records means, of course, cost sheet. We have made so many cost sheets in our costing syllabus. Guys, to audit that cost sheet is known as cost audit. So first of all, there should be a mandate in law to make cost sheet. So that mandate comes from section 148 subsection 1. This section does not relate to audit, but it relates to maintenance of cost records, because unless cost records are prepared, guys, cost audit cannot be done. So this section says that if your company is engaged in production of goods or providing services as may be prescribed, then the company has to prepare particulars related to utilization of material, labor and other item of cost, and it is nothing but cost sheet. So you in the cost sheet also you are giving the details of three things, primarily three things: material cost, labor cost and other item of cost, which are overheads. Provided that central government shall, before issuing such order in respect of any class of companies regulated under the special act, consult the regulatory body. So if this audit is being prescribed for companies which are formed under special act like RBI, like insurance companies, like banking companies, then the Companies Act, before prescribing such audit, should consult these companies, should consult the regulatory authorities which under which these companies are formed, and only then audit of these companies can be prescribed. Records are to be made by these companies in accordance with the law which is prescribed by the respective acts. So RBI law is governed under RBI Act, insurance companies are governed by Insurance Act, and banking companies are governed by Banking Act. Now, one very important thing which I want to highlight from this section is, guys, financial accounts, financial statements are required to be prepared by every company, be it banking, be it anyone, and there's no specific prescription for preparation of financial records. But for cost records, there is a special prescription, which is that a company which is engaged in production of such goods or providing such services, such is the prescription, guys. Over here, such is the prescription which is given by the law, and this prescription is to be used to know which companies are to be are required to maintain their cost records. So, sir, are there any companies in India which do not prepare cost records? Of course, yes. Answer is a big yes. There are companies which do not make cost records, and there are companies which do not even get their cost audit done, because law doesn't prescribe those two things for them. So, sir, are there any companies in which financial records are not prepared? Are there any companies where statutory audit is not done? Answer is a big no. There is no company in which the financial records are not prepared, and there is no company in which financial audit is not done. Every company is required to prepare its financial records, and every company is required to get its financial audit done. So yes, subsection 2 talks of audit. Now we are concerned with cost audit, and subsection 2 says that if central government is of an opinion, then it may order audit of cost records of companies which are covered under subsection 1. Obviously, guys, if you are not covered under subsection 1, which means that you are not required to prepare your cost records, obviously audit cannot be done for you. So if central government is of an opinion, central government will tell for which companies amongst the companies which are prescribed under subsection 1, which companies out of these companies are required to do their cost audit. So I'll give you an example. If 10,000 companies are required to prepare their cost records as per subsection 1, then lesser than 10,000 companies will be required to get their cost audit done. So the requirement of cost audit is that company should fall under subsection 1, then the net worth and turnover should be above the limit, then only cost audit can be done for such companies. Guys, what is this net worth and turnover? This we'll be studying in the rules which are prescribed by the ministry for audit of cost records. And these rules, although in Inter these rules are in a very small, concise, abridged manner, and mostly they do not even come in the examination, but in finals, guys, you are going to read these rules in depth. So we are not bothered about finals. We are now currently in Inter and we need to clear our Inter. So sir, please let's get on to the Inter syllabus. All right, guys. So subsection 3 deals with the audit. Who can do the audit? Audit is to be done by a cost accountant in practice who is appointed by board of director. He becomes the cost auditor. This is subsection 3. Provided that no person appointed under section 139 as an auditor. Guys, 139 is statutory auditor. So a statutory auditor cannot be a cost auditor. It has to be two different persons. So statutory auditor, there's a restriction from the Companies Act perspective to appoint statutory auditor as the cost auditor. Statutory auditor cannot be appointed as the cost auditor of the company. Provide further that auditor conducting the audit shall comply with cost auditing standards. Of course, the cost auditing standards are to be followed by the cost auditor. Now, rule number 3, applicability of maintenance of cost records. Now, there are some exceptions to people who can who are required to prepare their cost records. Let us read those exceptions, and also we'll be reading the turnover limits which are there for prescribed for companies to prepare their cost records. Now we are dealing with the sub rule which will tell us which companies are required to prepare their cost records. And yes, to reiterate, all the companies are not required to prepare their cost records. Only specified companies are required to get their cost records maintained. So companies engaged in production of specified goods. So if a company is engaged in production of category A and B goods, and guys, this is a list of 6 plus 33 companies or products for which cost records are to be made. Category A contains 6 products. Category B contains 33 products. Having an overall turnover of 35 crores or more. So the government wants to cater to the big companies who have turnover above 35 crores for preparing the cost records. Of course, guys, for small players, preparing separate cost records is a big hassle. So government has prescribed only those companies who have their turnover of 35 crores for preparation of cost records. Now there are two exclusions from this limit. So MSMED, micro enterprise and small enterprise, as per the turnover criteria prescribed by MSMED, are not required to prepare their cost records. Then foreign companies having only license office in India with respect to medical devices are not required to prepare their cost records. So these are the two exceptions which the government has created. So even if MSMED, micro enterprise and small enterprise has a turnover of more than 35 crore, they are not required to prepare their cost records. Similarly, foreign companies who have only license office. Guys, license means communication office. So some companies, instead of opening a subsidiary, they open a communication office, license office in India, and this license office is basically communicating between the foreign country and the Indian country. And if this license office is respect to medical devices, then even if the turnover is more than 35 crores, you are not required to prepare the cost records. Now, how can we maintain the cost records? Manner of maintenance of cost records. Records should be maintained in form CRA1. Guys, you have to remember this name because this number comes in the examination quite often. CRA1. So there's a regulation prescribed according to which cost records are to be prepared, and it is prescribed under form CRA1. They should be prepared in accordance with cost accounting standards. Cost records should facilitate. Now, what is the objective of preparing cost records? It should have per unit cost of production, cost of operation, cost of sales, margin for sales, and they should be prepared in a true and fair manner. No format has been prescribed, so there's no format for preparing cost records. Guys, the cost sheet which you prepare in your CMA Inter, that is, you can also choose that format. So there's no format which is prescribed to prepare cost records. So it is open to the businessman to choose whichever format he wants. Yes, these 4 things should be apparent from the format: A, B, C, D. Per unit cost of production, cost of operation, cost of sales, and margin for each product should be very, very apparent from the cost record. That is the bottom line. May be prepared on monthly, quarterly, or half yearly or annual basis. Now, there's a leeway over here that these records can be maintained either on monthly, quarterly, half yearly, or annual basis. Now, the applicability of cost audit. Guys, if you were wondering, so what are the limits of turnover or net worth which are to be prescribed, which are prescribed by the ministry for recommending the cost audit? Now, for category A products, There are 6 products in this category. If you are inquisitive, you can read this footnote 1, but it is not necessary for you because a question from this cannot be asked. So category A contains 6 products and category B contains 33 products. Again, I have noted the 33 products over here. If you want to read, you can read them. But the turnover limit is that the annual turnover of the company from all its product during the immediately preceding year is 50 crore or more. And the turnover of products for which cost records are required to be maintained should be 25 crore or more. And the conjunction which is used, conjunction means the addition which is used is and, which means plus, which means both of these conditions should be satisfied if you want to get your cost audit done for category A products. Guys, let's read the condition once again. Overall annual turnover of the company should exceed 50 crores and the turnover of the products which are prescribed for cost records should be 25 crores or more. This is the condition which is given for regulated goods and if the regulated goods are to be audited. Then for non-regulated goods, goods which are not to be which are not falling under any regulation, any law is not made for those goods. So guys, sir, what are the goods for which regulations are made? Guys, communication is one such good or service, you can say, for which there are strict regulations of TRAI, Telecom Regulatory Authority of India. Similarly, petroleum is one such product which falls under category A products. So these are regulated goods and these are non-regulated goods. And non-regulated goods turnover is 100 crore for the entire company and 35 crores for the product for which cost records are prepared. And again, the conjunction is and, which means both these conditions are required to be fulfilled to get the cost audit done. So you have to just remember these limits, which are 50 crores, 25 crores for A, 100 crores, 35 crores for B. So for category A goods, the limit is 50 crore, 25 crore. For category B goods, the limit is 100 crores and 35 crores. These are the limits which you need to really remember. What are the exclusions for cost audit? Guys, the exclusion is that where rule 3 is not applicable. If your rule 3 is not applicable, of course, cost audit is not required to be done, because if you are not preparing the cost records, then there is no need of getting cost audit done. Exclusion number 2 is the companies whose revenue from export in foreign exchange exceeds 75% of its turnover. So if the turnover is say 100 crores and out of 100 crores, 75 crores or more is from exports which is in foreign currency, then those companies are not required to get its audit done. Guys, this is a benefit which is given to the companies which are mainly into exports, so that their burden of compliance is not increased. This benefit is given to them. Third exclusion is which is operating from a SEZ. If you are operating from a special economic zone, then it's a concession for you. You are not required to get your cost audit done, even if your turnover is exceeding those limits for category A and B products which we have just studied. Then the companies which are engaged in generation of electricity for captive consumption through captive generating plant. So guys, electricity is one such product which is listed in table A. So if a company is generating electricity but it is consuming that electricity for captive consumption, which means it is consuming the electricity within its factory for its own production, then this production does not require audit. So this is the fourth exclusion. Then benefits or use of cost audit. How is cost audit useful, guys? So management gets reliable data for its operations, like costing data is given to the management, which is really reliable because it's audited by an external party. It acts as a continuous checking tool and wastages can be avoided if cost audit is done. Inefficiencies is reduced and corrective measures can be taken for any inefficiency which is observed during audit. Then management can allocate the responsibilities and it can actually concentrate on the important things if cost audit is being done. Then budgetary control is automatically taken care of if cost audit is being done, because cost audit has a benchmark which is the budgets. So cost auditor always see the budgets, what were the budgets which are allocated to a particular cost, and according to the cost, whether budgets are
followed by the company or not. Reliable check on valuation of closing stock and work in progress. So cost auditor audits the work in progress and closing stock. And of course, last but not at all the least, frauds and errors are detected. Guys, errors are unintentional mistakes, and frauds are intentional mistakes. So that is the difference between errors and frauds. Usefulness to society. Now, how are these audits useful to society? Guys, first of all, right price fixation can be really done by a cost auditor. Why? Because obviously it is done by management, but it can be vetted by a cost auditor. Why? Because the company can show any cost to you, but the most reliable cost of the production is to be given to you by the cost auditor. Cost auditor will actually audit the cost and will ascertain whether the price is right or not. Then secondly, price increase by the industry is not allowed without proper justification. If the industry is increasing its prices, then a justification is to be given according to the cost of production to the consumers, and that justification is based on the cost audit. Cost audit is also useful for cost control, reduction and proper utilization of resources. Of course, cost audit is definitely beneficial for controlling the overall cost and cost reduction, proper utilization of resources. Shareholders are also benefited because when the purchases and utilization reports are maintained and records are maintained, then the auditor is able to secure data with respect to these expenses. Also, the valuation of closing stock and work in progress is also done, and it is checked by the cost auditor. So the shareholder is assured that the financials which are in front of him, or the profitability which is being shown to him, is actually reflected in the cost sheet as well. Then what is government's benefit in cost audit? Guys, any cost plus contract which is there, like metro, Delhi Metro is being constructed, and sometimes these infrastructure projects are cost plus projects, which means that they will have a clause which says that cost plus 15% will be reimbursed to them. Now, cost is the deciding factor in these agreements, and cost is to be given by the cost auditor, and that cost is the most important cost. Cost audit helps in fixation of selling price. Selling price is fixed. Of course, it enables the government to focus its attention to inefficient units. It enables government to decide in favor of giving protection to certain industries. It facilitates settlement of trade dispute, and it promotes healthy competition among the industry. Now the question is, who can be a cost auditor? Guys, we have already studied that a cost accountant who is in practice can be a cost auditor. Then statutory auditor cannot be a cost auditor. Disqualifications for appointment as a cost auditor. Guys, we have studied disqualifications in chapter number 4, section 141. Those disqualifications are as it is, mutatis mutandis, which means as it is applicable on the cost auditors as well. So section 141 of the Companies Act, which we have studied in chapter number 4, you have to insert that particular concept over here. Now, how to appoint the cost auditor? Cost auditor is appointed by the board of directors. Now, please tell me if you remember who is responsible for appointing the statutory auditor. Yes, it is the shareholders. So, big difference between cost auditor's appointment and shareholders appointment. Sorry, statutory auditor's appointment. Guys, here it is board of directors, and there it is shareholders of the company. Company to inform about such appointment to central government within period of 30 days of board meeting, or within a period of 180 days of commencement of financial year. So the company has to inform about the appointment of the auditor to the central government within 30 days of the board meeting in which auditor is appointed, or within 180 days of commencement of the financial year, whichever is earlier. Now again, you have to definitely remember the form. The appointment form is form CRA 2. Then any casual vacancy in office of cost auditor, casual vacancy arises because of resignation of auditor or death of the auditor or removal of the auditor, shall be filled by the board of directors within 30 days of occurrence of such vacancy, and the company shall inform central government in form CRA 2 within 30 days of such appointment of the cost auditor. Rotation. Now, a very important guys, a section from a Companies Act perspective with respect to the statutory auditors. But now the question is that is rotation applicable to cost auditors as well? Of course, in chapter number 4's video, which is there on my channel, you would have already studied the rotation concept and the freeze out point, cooling off period concept. Now, are these concepts applicable to cost auditor as well? So the answer to this question primarily is no. So section 139 is applicable to appointment of auditors, which is financial auditor, deals with provision of rotation of auditors, and these provisions are applicable only to appointment of auditor, which is financial auditor. The Act does not provide for rotation in case of appointment of cost auditor, and the same is not applicable to cost auditor. So on cost auditors, neither rotation principles are applicable nor cooling off period principles are applicable. It may, however, be noted that though there is no statutory provision for rotation, individual companies may do so as part of their policy. So if a company wants, then as a part of policy, it is a healthy practice to rotate your directors every 5 years. Of course, not a mandate. If a company wants to keep the auditor for more than 5 years, his or her sweet will. We won't interfere in their decision. Remuneration of cost auditors. Who can fix the remuneration? Of course, the people who have appointed can fix the remuneration, which is the board of directors in consultation with the audit committee can fix the remuneration of the auditor. And in case of other companies means where audit committee was not there, then only board shall fix the remuneration. So guys, very simple principle. Person who appoints a particular auditor, that person only actually fixes the remuneration of auditor. Obligation to report offense of fraud. Now, this is a very important section, and yes, the cost auditor has the obligation to report the fraud. If he discovers a fraud, then the auditor should report it to the management there and then. He should not wait for releasing his audit report. He should report the management of the fraud, not only management but also to central government within the time prescribed as per the law. And the procedure is also prescribed and the time is also prescribed. So this is the duty of the auditor with respect to fraud. Cost audit report, form CRA 3 is to be given by the cost auditor to the board of directors as the cost audit report, and the time period is 180 days of the closure of the financial year. So you have 180 days to finish your entire audit process, and within 180 days you need to submit the audit report to the company. Auditor has to submit it to the company board of directors. Then board of directors should file the audit report to central government in form CRA 4. Now guys, this is important. In statutory audit, the auditors give the report to the shareholders. However, in cost audit, the auditors give the report to the board of directors, and then board of directors file this report with the central government within 30 days of receipt of this report. Now next is the secretarial section, which is again devoted to company secretary position, and only a company secretary can perform a secretarial audit. So every listed company and a company belonging to other prescribed class of companies shall annex with its board report a secretarial audit report. So the applicability is on every listed company and the company which are prescribed. It shall be duty of the company to give all assistance and facilities to the company secretary in practice. So whatever is required to get the secretarial audit done, the company should do all those things and should provide all those facilities to the company secretary. Board of directors shall explain in full any qualification, observation or remarks made by the company secretary in practice in his report. So whatever remarks, whatever observations are made by the company secretary, the board of directors should give an explanation of those in his report. If a company or officer or company secretary in practice contravenes the provision of this section, every officer should be punishable with fine which is not less than 1 lakh rupees. So the fine is 1 lakh rupees and it may extend to 5 lakh rupees if company secretary or the officer of the company or the company does not follow this section. Now, what is the applicability of secretarial audit? Which comes from this part, which are the prescribed companies. Guys, prescribed companies are every listed company, every public company having paid up share capital of 50 crores or more, every public company having a turnover of 250 crores or more. So there's an or, conjunction is or. So if any one of these two conditions are satisfied, then that company will be eligible for a secretarial audit. However, turnover means aggregate value of realization of amount made from sale. Of course, guys, this is the turnover definition which is given to you. What is the audit report? Secretarial audit report, guys. Secretarial audit report is required to be provided in the format prescribed under MR3 form. So again, you have to remember this form name. And how to appoint a secretarial auditor as per Rule 8, required to be appointed by means of a resolution passed in a duly convened board meeting. It is advisable for secretarial auditor to get letter of engagement from the company. Secretarial auditor should accept the letter of engagement. However, it is advisable that any change in secretarial audit during financial year is to be reported to the members in the board report. So yes, this was the brief section on secretarial audit. Yes, this chapter primarily focuses on cost audit, and secretarial audit is a small part of this particular chapter. So guys, I hope you will do these past examination questions yourself. And yes, you will revise one day or half day before the examination using these key points to remember section. And this section has been written very crisp in a brief form. Of course, in this chapter I have given one more thing, guys, flow charts which will aid you to revise or learn these processes of appointment of cost auditor pretty well. So yes, this was your chapter number 5. And now we are going to start chapter number 6. So let's revise chapter number 6, which is the reporting requirements under the Companies Act. Now guys, whatever we do in our audit, the ultimate output that we are going to give to the client, just like our product, will be our auditor's report. So our auditor's report has to be made in a absolutely perfect manner so that it actually calls out the opinion which we have formed, and it should also reflect the kind of work which we have done. So audit report forms the ultimate product of any audit, and the importance which is given to audit report is second to none in the audit process, because ultimately in the shareholders' hands only audit report goes. So let us now study the meaning and types of audit reports. So audit report is called as the ultimate and final product of every audit. Of course, this is the output of audit. If I have to say in costing terms, input is the hard work and the scrutiny which we do, and output is the audit report. A report is statement of collected and considered facts which gives clear and concise information to the persons who are not already in possession of full facts of subject matter of the report. And what is the subject matter of the report? It is an opinion on the financial statements of the company. This is the subject matter of the report. Now, how is the report to be drafted? What are the elements of the report? Guys, first of all, there has to be a title, and title is always the auditor's report. Or only auditor's report. It should be distinguished from other reports, for example, report of officer of entity, board of directors, etc. Second element is addressee. Who is the report addressed to? So whom are you obliged to report these findings? That is the second thing which we need to write in our auditor's report. And guys, remember the golden rule. Person who has appointed you should be the person whom you should address the auditor's report to. So it is the authority appointing. Then there is the opening paragraph. So you do not start with your opinion directly. You first of all make the readers of the audit report aware about the whereabouts of the audit report. So the starting happens with the entity's name, date and period of financial statements, responsibility of the entity's management towards preparation and maintenance of financial statements. So it starts with the name of the entity, and it starts with the responsibility of the entity's management to prepare and maintain financial statements. Scope paragraph, there is a scope paragraph which calls out what is the scope of that particular audit, and it enumerates that the audit has been done as per the auditing standards. Then the objective of audit was to obtain a reasonable assurance. Assurance means a guarantee, or assurance means a confidence. So the purpose is to gain confidence
Whether the financial statements are free from material misstatement. The auditor's report should be described the audit as including examining on a test basis evidence to support amount and disclosures in the financial statements. A statement by auditor that the audit provides a reasonable basis for his opinion. So we always, guys, provide a reasonable basis and we do not provide an absolute opinion. Our opinion is always reasonable and not absolute. Absolute means 100% correct. Absolute means 100% correct. And reasonable means high confidence of correctness, which means maybe 80% correct, maybe 70% correct, but not 100% correct. So we give a reasonable basis for our opinion. Now, what is the opinion paragraph? This is the finding paragraph in which we write that the financial statements, whether they give a true and fair view or not. And there's a difference between true and fair view and true and correct view. Date of the report, the date is the auditor's report is to be signed by the auditors in which on the date when auditor finishes his audit work. So the date of audit report should be the date on which audit has been completed. So that should be the date of audit report. Date of audit report should not be earlier than date on which financial statements have been signed by the management. So management signs the financial statements first and then the auditor signs the audit report. It can be on the same date though. So this can be on the same date as well. Any event occurring after the balance sheet date, after the date of audit report, is not the responsibility of the auditors. So if anything happens after the auditor's report, auditor will not be held responsible for it because the auditor has already signed the report and he has already done away with the audit of that particular company. Then place of signature. So the report should mention the specific location on which the audit report has been signed. So guys, this particular thing has been specially inserted to avoid and to restrict the charter to the auditors from backdating their auditor's report. So what happens is that date of audit sometimes lapses. This used to happen in e-world. Now it's e-world. So in e-world you cannot do these things. But earlier what used to happen was that the auditor used to sign an auditor's report on a back date. So auditors used to sign it say on 2nd of October, auditor used to put the date of 25th of September. And if on 2nd of October auditor is flying to outside Delhi, then also the date of the auditor's report was Delhi. So sometimes as on the date of the auditor's report, which is 25th September, the auditor can be outside Delhi. But since he is signing a backdated audit report, he might forget that where was he at that point in time when he was signing his report. So it's mandatory for you to put the place of the signature. On the next page, I've given a auditor's report, a sample auditor's report, which you can go through. And yes, it contains all those paragraphs which we have just discussed. Now, what is the significance of opening paragraph? Opening paragraph which tells you what is the scope of the audit and what is the liability of the auditor. What is the importance of that particular paragraph? Guys, that particular paragraph, first of all, identifies the financial statements, means which company's financial statements are we auditing and what is the period of audit. So those opening paragraphs tell us about these two things, which is very, very important. Date and period covered by the financial statements. Then it clarifies that preparation of accounts is responsibility of the management, whereas the responsibility of auditor is to express an opinion on the said accounts. So it also enumerates the restriction on the scope of the auditors. Then it also makes significant, so it communicates that preparation of financial statements require management to make significant accounting estimates. So management has made accounting estimates which are difficult to audit. This is also written in the opening paragraph. Now comes the scope paragraph where the auditor restricts his scope. So it informs the user about practices and procedures followed in conduct of audit. Then it also states that audit is being done in accordance with auditing standards. Test check basis of audit is highlighted in that scope because you cannot expect an auditor to check 100% of your financial accounts. Then you need to see and you need to be sure that a reasonable assurance is provided in the scope paragraph itself, it's written that we will provide reasonable assurance only. Now, what is the importance of audit report? Guys, audit report is the end product. It gives the auditor's opinion. It reflects the work done by the auditor. So the work done by the auditor is seen by no one. But if you want to show to the shareholders what kind of work have you done, you've done well, you've not done well, then it is reflected in the auditor's report. Then auditor's report is the instrument by which measures the auditor's responsibility. Then it is actually the real position of financial status of the company, and it is used by different people as reliable document. So guys, even Government of India treats the auditor's report as the most reliable document out of any other document which is prevalent. Now, what are the categories of auditor's report? What kind of auditor's report can you issue? Guys, there are only two kinds of audit report which you can issue. One is the unqualified report, second is modified report. So either you can say that yes, true and fair view is there in financial statements, or you can say no, or true and fair view is not there in the financial statements. So unqualified report, let's see what is unqualified report. This is the best a company can get, and this is actually the KRA, key responsibility area of all the CFOs in the country, that you have to get the auditor's report from the auditors without any qualification. This is the major task of CFO of any company in the entire country. So it gives a true and fair view. If it is an unqualified report, it is a clean report which indicates that GSP gap have been followed by the company, disclosures have been made appropriately, proper presentation has been made in the financial statements, and any change in the accounting principles has been properly disclosed. Then a clean report cannot be given in the case where there is a limitation on scope. So if the company restricts the scope of the auditor, so if the company says, okay, you audit the entire financials but the fixed assets, then you cannot give an unqualified opinion, because you have only done half of the work. I agree, you have done it on the instruction of the management, but still you have done half of the work. So if there is a limitation on scope, you cannot give clean report, you have to give modified report, and you have to write therein that you have been restricted in your scope. Second, when there is a disagreement with management, if the management tells something else, and if you are of some other position, then you have to issue a modified report. Only you cannot issue a clean report. Obviously, guys, if auditor and management does not agree on certain point, there has to be something on this aspect written in the auditor's report. Then if there is any significant uncertainty in the financial statements regarding future, like going concern assumption is hit, then you have to give a qualified modified opinion. For issuing unqualified audit report, the auditor has to satisfy himself that number one, evidence are there for every transaction in the books of accounts. Standards of auditing and accounting have been followed. True and fair view has been given in the financial statements. Classification of all the financial statement heads is properly made in the financial statements. Format of the financial statement is perfect as per the prescribed law. In India, prescribed law is Companies Act 2013, which prescribes the format in which financials are to be prepared. Then the financials should be free from material misstatement, and all the disclosures are done properly. These are the things which you need to be confident about while giving an unqualified opinion. Then modified report, standard on auditing 750 tells us about report which is modified. Guys, a modified report can further be bifurcated into various parts. One, matters that do not affect the auditor's opinion with emphasis of matter. So modification can be done in a manner that modification can be light modification or heavy modification. So light modification means there are small things which are there in the financial statements, but they do not affect the auditor's opinion. Auditor's report opinion is true and fair. Then you give emphasis of matter. You do not qualify your report. Qualification means you are giving a negative opinion. Then matters that do affect the auditor's opinion. If the matters affect the auditor's opinion, then you have three options. You can give a qualified opinion, you can give a disclaimer of opinion, and you can give an adverse opinion. I'll tell you which situation demands giving which kind of audit report, that I'll tell you in a short while. Before that, I'll take you to a table, and that table will be able to assist you in telling which audit report is to be issued in which situation. So guys, this is the table which is there in your book as well. Summary chart on types of audit report. Now if there is an unqualified report is one, and these are all modified reports. These are also modified reports. Okay, so unqualified, you've already seen true and fair view is there in unqualified. Issues are there in current financial statements? No. Issues are there in future financial statements? No. Then you give a unqualified report. But what is emphasis of matter? True and fair view is there. Okay. Issues are there in current financials? No. Issues are there in future financials? Then you give emphasis of matter. So if you see this, the matter does not affect the current financials, but they affect the future financials. That is why you are giving a emphasis of matter, because you are telling the shareholders that this year is okay, but let me emphasize you on an event which is happening in the next year, which will hamper the business of the organization. Then a qualified report, which gives a true and fair view, but there are issues in the current financial statements which are not pervasive. Pervasive means which exist everywhere substantially. This is known as pervasive. So if the problems or the issues in the current financial statements are pervasive, pervasive means they exist in almost all the account heads, then you give a qualified opinion. And is there a issue with future also? There can be an issue with future. There cannot be an issue with future. That can happen in both the situation. Then the adverse report. In adverse report, guys, our opinion is hit. In first three, our opinion was not hit. In this part or in this type, our opinion is hit badly by a adverse finding which we have from the audit, and we are trying to disclose this audit problem with the shareholders. And issues are there in the current financial statement, yes, and they are pervasive. Pervasive means they are of very big size. And issues are there in future period, but they do not impact current financial. This can or cannot be there. Examples of future issues are going concern, significant uncertainty due to probable future event. Like guys, if we are sure that penalty is going to be imposed on the company in the next year pursuant to an order, then we are pretty sure that there is significant uncertainty in future, and these are types of future issues. Now reports without opinion. If I don't want to express any opinion, and for a reason that I have not been given the sufficient documentation, I have not been given sufficient paperwork by the management substantiating evidence, I have not been given any of these by the management, then I will give a disclaimer. Disclaimer means I have not expressed an opinion because I have not been given all the items of financial statements. So sir, what is a disclaimer? Disclaimer means that auditor is unable to express any opinion. And piecemeal opinion means the auditor is unable to express opinion on certain parts of the financial statements and not all the parts. So full disclaimer is given when all the parts of financial statements are faulty, are not given to the auditors, and piecemeal opinion, piecemeal disclaimer is given when only part of the financial statements are not up to the mark or are not given to the auditors. Audit reports specified in serial number 2 and 26 are known as modified opinion or modified report. So guys, this table will really help you in learning the different types of audit report in very short span of time. And yes, you can easily differentiate between two types of audit report using this particular table. Now let us come on to the types of audit report, and we've already studied emphasis of matter, qualified report. We've already studied features of qualified report. Now guys, first and foremost feature, it should be clear. The auditor's comment should be clear. Auditor's qualification should be very clear. All the explanations are to be received from the management for the audit report. Quantification of qualification. If the auditor is giving any qualification, then he has to quantify the qualification in money terms, which means that he has to tell what is the impact of this qualification on the profits of the company. So quantification is really important. Placement, the qualification should be there in the auditor's report always. Sometimes what management would do is management would ask you to put the qualification on the notes to accounts. Guys, that is not the place to put the qualification. The qualification has to come in the auditor's report because it is auditor's opinion about the qualification. Subject to words, so while giving any qualification always starts with subject to. Subject to means although the financial statements show a true and fair view, subject to the following things. Subject to means you are creating an exception to the common rule. So subject to qualifications are always started with subject to words. Then if there is any violation of law, then it should be brought to the notice of the shareholders by qualifying the report. Notes report relationship, where notes of qualificatory nature appear in the accounts, auditor should state all qualifications independently in their report so that users can assess significance of these qualifications. So guys, a simple thing which is described in this particular part is that even if you are giving some information in notes to accounts and not in auditor's report, then auditor's report can always direct or refer to that note if it is significant enough. So you have to see whether auditor's report gets a linkage with the notes to accounts, because it's really important that auditor's report should contain at least the linkage to all the qualifications mentioned in the notes to accounts. Then a final point, guys, before issuing the final report, you should always issue the report to the company, and the company should give a go ahead on the report, or at least he should be given an opportunity of being heard for the report, and then you should issue the report. It is a bad practice to issue an audit report without consulting the management of the company. Then what is adverse report? We have already studied. What is disclaimer of opinion? We have already studied. What is piecemeal opinion? We have already studied. And you can just read the details of these types of audit report, which are modified audit report. Okay. So the difference between qualified report, adverse report, clean report, qualified report, you will be able to appreciate it really simply because of the table which is made at the end of the chapter. Okay, now we always use one phrase, guys, in our audit report, which is to the best of our knowledge and belief. So this phrase means that the auditor is not a investigating authority, that he will dig out the files from the almirah of the CFO of the company. Auditor will rely on whatever management gives to the auditor and whatever information is given by the management to the auditor. So if certain transaction which has happened in the company is not disclosed to the auditor, then auditor does not have any liability over that particular transaction. It is management's responsibility to give all the information to the auditors, and therefore auditors insert this particular line in every audit report. Now some people say that auditor is actually shrugging away his responsibility by adding these words and this phrase. Guys, that is not the case. Auditor is not shrugging away from his responsibility, not shying away from his responsibility by using these words. You should interpret these words in a broad manner. So the narrow interpretation is that auditor is shying away with the responsibility of taking an onus. Auditors will not be held responsible if they act on information explanation supplied by the management which they believe to be true. To that extent, this phrase restricts the scope of inquiry to be made by the auditor. Guys, this is the wrong interpretation. This is a narrow interpretation that the auditor is just wanting to narrow down its scope, and it does not want to do its work completely. That is why he is inserting this line. Now let us read the broad interpretation, which is the correct interpretation. Auditor should obtain all information explanation which deems necessary for expression of an opinion. If he does not obtain all such information, he is entitled to issue disclaimer of opinion report. The auditor should apply professional judgment to obtain all the information and explanation which are necessary for performance of conducting the audit. Conclusion, hence the given phase is a double-edged sword which may be interpreted either to restrict scope of the inquiry or to stretch the responsibilities beyond a limit. So this phrase stretches the responsibility of the auditor to a very large extent. Now next is inquiry under section 143. Guys, obviously if we are not inquiring at the client's place about the various transactions which have happened during the year, about the documentation which has happened during the year, then we would not be able to draw any good conclusion for that particular audit. So the act has given us power of inquiry. We can inquire from the management about anything and everything which is related to the financial statements. So usually the auditor should inquire about the following aspects: whether loans and advances have been made on the basis of adequate security, whether transactions of the company which are merely represented by book entries are prejudicial to interest of the companies, whether there is any entry which is made by the company which is prejudicial. Prejudicial means bad. So if any transaction is bad for the company, if it is hitting the company in the wrong way, then you have to inquire about it. Whether assets and investment consist of share debentures have been sold at a price less than at which they were purchased by the company. So are there any losses which have been incurred by the company on other income perspective? Whether loans and advances made by the company have been shown as deposits, and whether personal expenses have been charged to revenue account. So you need to be sure, very, very sure, that your personal expenses means directors' home expenses should not be debited to the profit and loss account of the company. So any personal expense should not be charged to revenue account. These are the inquiries which the management has to make for a particular the auditor has to make from the management for a particular audit. Now, duties of statutory auditor with respect to branch audit report. Guys, now branch audit is a very typical scenario whereby a company has several branches all over India. Now, it is not practically possible for every statutory auditor to visit each and every branch. So what statutory auditors does is they choose the branches with respect to their materiality. If they are big branches, then they choose to visit them and audit them. If they are small branches, then they do not visit these branches. But guys, even if they do not visit the branch, then also the responsibility of the auditor is not restricted. Let me tell you, responsibility of the auditor is full even if he's decided not to visit any branch of the company. So where auditor of branch is carried out by a person other than statutory auditor, branch auditor shall prepare the report of the branch account examined by him and forward the same to the company's auditor. Now, if branch audit is being done by some other auditor, then that some other auditor should furnish the auditor's report to the main auditor or the main company's auditor. If branch auditor's report contains any qualification, then objections raised by the branch auditor have been met while preparing the main accounts. You have to ensure that the qualifications which are given in branch audit report should not be carried forward to the main company's report. The matter on which qualification is made is not material in context of company accounts as a whole. So if the qualification is not material, if it is a very small qualification, then it's okay. Then you need not give the qualification. Statutory auditor have received sufficient appropriate information. So if branch auditor was struggling with some information and he mentioned this fact in the auditor's report, but when the main auditor was auditing this particular branch, he got hold of all those documents which were required by the branch auditor. Then also, guys, the branch auditor's report can be ignored by the statutory auditors. Then what is CARO? So along with the auditor's report, so if I assume that this is the auditor's report which you have written, and you have written several things in this auditor's report, guys, there's an annexure to this report, and that annexure asks you 16 questions, and those 16 questions are to be answered by the auditor. Because auditor sometimes due to his work, he might miss on certain aspects of the audit. So to ensure that auditor at least covers all the aspects given in CARO checklist, auditor has to cover those points. So the CARO is applicable to, first of all, let's see who is eligible to be reported under CARO. Auditor is applicable, the order is applicable to every company except for, so these are the exceptions. So on these companies, CARO annexure is not to be made. Only auditor's report is more than sufficient. However, in other companies, Caro report should also be made. So what are these companies? A banking company, insurance company, Section 8 companies, which are typically NGOs and not-profit organizations, one-person company, small company, private company having paid up capital of 1 crore or less, and which has total borrowings of less than 1 crores from any bank or financial institution during the financial year, which does not has turnover of 10 crores or less during the previous financial year. So these are the limits. If private company is required to put Caro and Exure in its financials, then it has to satisfy these limits. Note 1. The order will be applicable to a private company which is a subsidiary of holding of a public company irrespective of above monetary threshold. So any subsidiary company of a public company, even if it is a private company, then it will prepare the Caro report, and the Caro report will be prepared in the same fashion as done for the other companies. Order shall not be applicable to auditor's report on consolidated financial statement. So if there is CFS, consolidated financial statement, then Caro is not applicable over there. Now, matters to be included in Caro, guys, you have to learn any 6-7 matters. So fixed assets details are to be vetted, and this fact is to be given in fixed asset schedule of the Caro. Inventory, loans and advances, loan investments, and all these things are to be specifically mentioned by the auditor in the Caro report. So you can read any or learn any 6 of them. That's more than enough. Okay, some miscellaneous points on Caro is really easy. Now let me come on to a very important point, and which has not been recurring in the examination, but yes, if the auditor wants to make the audit paper a little tricky, then he would be lured to give such kind of topics. Now guys, let's see, if we want to revise the auditor's report pursuant to revised accounts, then what will happen? So I'll tell you what happens. Audit report was prepared by the auditor and it was not circulated to the shareholders. It was with the auditors. Auditor came to the management and tells them that, okay, our auditor's report is ready. Now we have also signed it. Now we will issue these reports to the shareholders. Before that, the company's management might tell the auditor about some new development which has happened, which will affect the financial statements. In such a case, the auditor, can he revise his auditor's report? Because the financials are already revised. Can the auditor revise the auditor's report as well? Now the question is, yes, the statutory auditor can revise its report based on the amendment accounts, but the auditor has to take care of the following things. Number 1, return. Ensure that all copies of original accounts and reports are returned. Disclosure. The auditor should put a disclosure and a specific note in the amendment accounts disclosing why the accounts were amended. Reporting. Adequate disclosure is to be made. Inadequate disclosure. If the statutory auditor is satisfied that disclosure made by the company in notes to accounts is adequate, there is no further need for auditor to refer to revision of balance sheet. However, if there is an inadequate disclosure, which means that the auditor's notes to accounts does not contain any note on revision, then the auditor should refer to facts of revision of the accounts in his report. So these are the two kinds of disclosures which are to be made while reporting this kind of revision in the accounts. Now comes a complex situation whereby the revision of accounts happens after the AGM, after they have been adopted in the AGM. Now what will happen? So guys, as per the opinion of Institute of Chartered Accountants of India, audit report may only be revised till the accounts are adopted in the in the AGM. If the financials are already adopted in the AGM, then post that the accounts should not be revised. For entities where such adoption is not required, the auditor may consider revising audit report within a reasonable time. Okay, one important thing. If revision happens, then the auditor has to issue qualified opinion. There is no other alternative. Then auditor should revise the report and make it referenced to the earlier report. Then auditor should ensure that people are not relying on the earlier report and they are only reviewing or reading the new report. Then auditor has to take the following steps: notify the client, notify the regulatory authorities, make appropriate statement in AGM, and extreme situation auditor may conclude withdrawal from the audit also. Okay. So the next topic is audit of abridged financial statements. Now please first understand what you mean by abridged financial statements. So abridged financial statement means brief financial statements. Sir, how can financial statements be brief? Yes, they can be brief if you exclude all the notes to accounts, accounting policies, and the auditor's, the director's report. If you remove all those things from the financial statements, then the financial statements become abridged financial statements, which means that they are although showing the same picture but in a limited fashion, in a very concise fashion. So that is known as abridged financial statements. Now the auditor should ensure the following. He should tell the requirements which are related to abridged balance sheet so that management can provide them. If the audit report on abridged financial statement is issued on a date subsequent to issue of audit report on annual accounts, the auditor should check events occurring after balance sheet date. Of course, guys, if the financials were closed in, say, month of 10th of July and on 20th of July the accounts were also adopted in the financial statements of the AGM of the company. In such a situation, the audit report or the auditor should also check whether any event which has happened subsequent to his signing of the report to the time when the audit report will be reviewed by the board of directors or the AGM of the company. Till that time, if there is any development in the audit of that particular company, auditor has to disclose that development. Auditor should express qualified opinion as appropriate if there are reservations in the abridged financial statements. Okay, guys, after this there are some small topics like how do we audit proposed dividend, how do we audit liquidator's account. Liquidator is the person who is during a mergers and acquisition deal or a bankruptcy deal, a person who is responsible for diluting all the assets of the company and liquidating the company. He is known as the liquidator. So the liabilities with respect to liquidator, what is to be done in liquidator's accounts, what is to be done in political parties' accounts. It is very simple. So what steps are to be taken to audit political party? So I've told you a simple technique to revise this. Just think about the incomes and expenses of a political party. Sir, political party income will be contribution which is made, which is received by them, donation which is received by them, any government subsidy which is received by them. And what are the expenses of these political parties? Expenses are say welfare expenses which they are committed to do as per their job responsibility. Then these parties also have expenses with respect to their day-to-day work, remuneration of the employees, advertisement. Then during election times, these party need money to publicize their candidates. So that these are the various contribution to the political party. Now, conditions for contribution to political party: board should pass a resolution. Aggregate of amount cannot be more than 7.5% of average net profits. You cannot, donate n number of money to political parties. Disclosure: every company should disclose in its P&L account the amount contributed by it during financial year to any political party. So if any political party contribution happens, then a disclosure is required to be made in the P&L account. Now, what is the auditor's duty? Guys, auditor's duty is to ascertain whether the political contribution has been made in excess of the limit prescribed. Limit is 7.5% of average profit. The contribution should not be more than that. Then adequate disclosures are there. Applicability of section 182. A certificate from board should be obtained by the auditor and report any instances of miscompliances. So these are the auditor's duty which is with respect to the political parties. Now, consolidated financial statements. Guys, what is consolidated financial statements? So if X is a company and A, B, C, D are subsidiaries of X, then what will happen is individual balance sheets of ABCD Limited and X Limited will be made, and one consolidated balance sheet will be made of all the company, which means a consolidated balance sheet of the group. So this is known as consolidated financial statements. And guys, the audit of consolidated financial statements are also almost similar to any other audit. So there's nothing different in CFS accounts. Just one thing which I would like to highlight over here is we need to be sure that all the subsidiaries, associates, joint ventures have been included in the consolidation purposes. Because if a small branch which is located at a nearby, at a distant place is ignored, then your entire balance sheet will show a wrong picture of the company. So CFS audit are to be carried out with great detail and great precision. Okay, so the next topic is audit report and audit certificate. Guys, there's a difference between audit report and audit certificate. And the difference is that in audit report, you just give a reasonable assurance, which means you are not giving 100% assurance. But in audit certificate, you give an absolute assurance. Sir, where do we use this and where do we use this? Guys, this is used as a statutory document and as a statutory report which is prescribed by Companies Act 2013. However, audit certificate is a agreement between auditor and the company, and auditor does whatever company asks the company to do. So if the company is asking for an absolute assurance that 100% of the transaction should be audited, then auditor has to compulsorily do it because the client has asked him to do it. So certificate involves 100% checking and audit report involves sampling, because we need to give a reasonable view, which means we need to give a 70% to 80% correctness view. Absolute, we need to give 100% of the assurance. So depending upon what comfort is required to be given by the auditor, the percentage of comfort changes and thus the size of the samples changes. So you need to really be cautious about this particular topic, audit report and audit certificate, because it has been repeating in the exams quite often. And I have told you the broad difference between audit report and audit certificate. If you face any problem in any of these parts, please let me know. These are pretty straightforward parts and you will not face any problem in these parts. Alright, so that's all guys for chapter number 6. And chapter number 6, chapter number 5, chapter number 6 and 7, all three of them are important chapters because exam holds good weightage of these chapters. So yes, that's all for the audit marathon of this time, and all the very best and happy studying.
For latest updates and information on entire CMA profession, just subscribe to our channel and don't forget to press the bell icon to get notification on the latest videos which are being uploaded on the channel. For products related to paper number 19, paper number 20 for final students and paper number 12 for intermediate students, log on to www.agrawallawhouse.com. It contains the compilation of handwritten notes, books, reference materials and video lectures of these 3 subjects. If you have any further query or you want to speak to me personally for any kind of counseling, you can call me at the number given on the screen.
All right, so good evening everyone and welcome to this session of CMA Inter Audit. And this paper number 12B, which is there for 50 marks in your syllabus, this is an important element of your syllabus guys, because along with accounts, which is of 50 marks, you have 50 marks of audit as well. And consolidatedly, if you are going to score good marks in this particular subject, then of course your overall percentage will be higher. So am I audible to all of you? Can you confirm it to me? Because Vedant is saying that I'm not audible. Am I audible to everyone else?
Yes, sir. We are not facing any issues.
Okay. All right. So yes, this session is all about audit. This session is all about how to do audit. And guys, audit is a different subject. Why do I call audit a different subject? Because audit is nothing peculiar.
audit is nothing different like income tax. Income tax is based upon laws of the country, and which law is to be followed. How will the salary income be taxed in India? How will the capital gain be taxed in India, etc., etc. These things are related to the law of land, which are pertaining to the country in which you are in. However, audit is one such sphere, guys, which is not under any regulation, which cannot be confined to a particular regulation. Audit is usually beyond any regulations and beyond any law, because audit will more or less be same in all the countries of the world. The best part about audit is that it will be same in all the parts of the world. So, for example, if I am auditing, say, a hospital, then guys, hospital of India, hospital of US, hospital of UK, hospital of Europe, all the hospitals will be audited in absolutely the similar manner. There is no difference in the manner, the procedure of auditing which will be employed in India versus the manner which is employed outside. So audit is one such field, audit is one such area which is absolutely same, which is absolutely similar across the globe. And audit has got this peculiarity that it is not bound by any regulation, is not bound by any law. And I'll tell you, I'll describe which are the laws which bound some part of audit for us, but majorly audit is all about logic. Audit is all about your common sense. So I'll tell you something. Guys, your mom is an auditor. Sir? Our mom is not an auditor. Our mom is a housewife, and you know, she's never even studied audit subject, and she's never even studied any financial course, finance related course. She has never ever worked in an audit firm. She doesn't know how to do audit, so she's not an auditor. My mother is a housewife. No, guys, your mother is an auditor. Your mother is not a housewife. I'm telling you, she's an auditor. So, but how is she an auditor? Tell me something. Your mother, does she find out sometimes when you are doing some mischief? So suppose you've not, when we were in school, then sometimes we didn't used to eat our lunch properly, and we used to give away our lunch to someone else. So did our mother used to know about it, come to know about this fact that, oh, today you've not eaten your lunch properly, or today you've not finished your lunch properly? And why only during your childhood? Even now, guys, does your mom know something which you want to hide from her and she knows it already? Yes, it happens many a times. So whenever I tell my mom that, okay, I'll drink milk before sleeping, before going to sleep, I'll drink milk. I tell my mom like this. But when early in the morning, when I wake up, the first thing she tells me is, oh, you didn't had milk. How does she know? How did she know? I mean, there was no proof, there was no source. But guys, she's smart enough. What did she do? She saw the sink, the basin of our kitchen, and she didn't see an additional glass kept over there. If there is no used glass kept over there, that is a proof that I didn't had milk at night. So this is a very simple audit procedure. So that is why I tell you that audit is logic. Audit is not law. Audit is not regulation. Audit is not rule. It's logic. It's pure logic. So suppose you tell your friend, okay, take this 100 rupees, buy a chocolate for me. He goes to shop and buys a chocolate worth rupees 60 for you, and he returns 30 rupees back to you. Then obviously you'll ask him, hey, where is my 10 rupees? Where are my 10 rupees gone? Then he'll be zapped. He'll be like, how did you come to know that I didn't give you 10 rupees? It is obvious. It's logic. It's common sense. So guys, audit is more logic, is more common sense in a practical parlance, and it is more driven by your experience. So more experienced an auditor is, more well he's gonna be in his practical life and in his approach. So audit is about experience. Audit is about practicality, and audit is all about your logics. I'll give you a very, very simple example of how logics are applied in auditing. So guys, I have done audit in one of the big 4 companies for 5 years. And when I was the auditor of those companies, then guys, I went to an inventory audit. Sir, what is an inventory audit? Guys, inventory audit means that you have to audit the inventory, the stock, the closing stock of a particular entity. You will go there in their godown and just see how much stock is there in that particular organization. Guys, that organization was a chemical manufacturing organization. And I had to see that what is the quantum of chemical which is kept as an inventory as closing stock in their books of accounts, and what was there physically in their go down. I had to check this. So guys, chemicals are not stored in plastic or some containers. They are stored in big silos. What are silos? Silos are big metallic structures which are engraved into earth, and they are big cylinders which are of height of say 10 feet or 20 feet, 30 feet. They are that high, and these are known as silos. They are earthed properly. They are fixed into earth, and you just can tell how many kiloliters of chemical is there inside the silo. So I asked the management, sir, how many kiloliters of chemical is there in this particular silo? Management told me, sir, we have 10,000 kiloliters of chemical in this silo, and we have additional 10,000 kiloliters of chemical in our another silo. So we show you two silos. 10,000 kilometers in one silo, 10,000 kilometers in second silo. So this was the management's claim that, okay, sir, we'll show you 20,000 kiloliters of chemical which are stored in two different silos. I said, okay, if that is the case, then please show me both the silos. So we were standing in front of one silo, and I was made to climb up the silo through a staircase which is adjacent to the silo. And as soon as I went up, I was asked to peep inside the silo and see whether there is physical quantum of chemical inside there or not. There was chemical. Then I took the reading. There, beside the silo, there are reading meters. I took the reading. Okay, this is the reading. 10,000 kiloliters of chemical was there inside the silo at that particular point of time. I was satisfied. I said, okay, you have 10,000 kiloliters of silo of a chemical in silo number 1. Now please show me silo number 2. As soon as I told them that please show me silo number 2, the management asked me, okay, sir, it's too hot. Can we just wait for some time in the factory? Can we go back to the factory? Just wait for some time, have some cold drink and have some water, and then we can go to silo number 2. I said, what's the problem? Why can't we go right now? Let's finish it up, and then we will, have cold drink or tea or whatever we want to have. Why can't we do that? So management was like, sir, let's wait for some time. Let's do the silo number 2 in a short while. I said, okay, if you insist, we'll do silo number 2 in a short while. So guys, while we were moving from the silo towards the factory premises, and yes, there is quite a lot of distance between the silo where the yard is, where the stock yard is, and where the head office is. There's quite a distance. So while we were walking from the silo towards the factory premises, I saw or I heard some sound, some noise. What kind of noise? Guys, noise of water flowing. So when we pour water, then the kind of noise which is generally heard by us, that kind of noise I heard. Soon as I heard that noise, I just was unable to digest logically. There shouldn't be any water source over here. There's no river, there is no sea, there is no ocean, there is no lake or something like that. So why is there a water noise? Why is there a water sound? There should not be water sound in this particular area. There could be one condition, that the management has some water pumps which are drawing water from somewhere and they are pulling it to the office premises. But guys, office premises was at the ground floor. So this option was also ruled out. Now I was very inquisitive. I wanted to know why is this water sound coming, and while we were walking towards the office premises, I just told the management, no, we are not going to the office premises. We are going to the second silo immediately. Guys, the management was a little bewildered. Management was a little unconfident at that point in time, but I forced them, no, I want to go to the second silo immediately. Management refused to take me to the second silo immediately. I told management, okay, you don't come with me, I'll go to second silo myself. And guys, my thought was absolutely right. Management was trying to cheat with me. How? Management was transferring the 10,000 kiloliters of chemical from silo 1 to silo 2. It was transferring, it was removing the chemical from silo 1 to silo 2 just to demonstrate that they have 20,000 kiloliters of chemical. But actually, they did not have 20,000 kiloliters of chemical. They had only 10,000 kiloliters of chemical. So we reported this fraud which was done by management, this overstatement. This is known as window dressing. Window dressing means you have 20 rupees of assets and you are showing in your financial statements it has 40 rupees. This is known as window dressing of accounts. So in this entire incident, I got to know, guys, I need not be a legal expert. I need not be a professional regulator to understand what is happening. I just need to be logical. I just need to be vigilant. I just need to understand what's going on. And audit is all about logic. Audit is all about your presence of mind. Audit is all about your how you perceive things, as how diligent are you, how intelligent are you, how receptive. Your ears should be open, your eyes should be wide open, and everything should be under your control. That is audit. So audit is not a law, audit is not a regulation, but it's all about logic. It's all about practicalities. Okay, sir, we got the meaning of audit now, and let's start the subject. The subject is audit, and yes, ultimately we have to score good, and 50 marks is what this audit has to offer to us. And guys, obviously I'm your teacher, so the first thing which I would like to tell you honestly, so before telling that thing, I would like to ask you, I need some honest answers over here. I'm looking for some honest answers. Guys, how many of you are afraid of cramming, are afraid of mugging up things? They cannot rectify things as it is and yield it in the examination paper. How many of you fear or dread rectification, or you don't know how to rectify and mug up things, cram things, and you find it very difficult to cram things? How many of you find it difficult to cram things? You can write your answer in chat. People who find it difficult to cram things, who find it difficult to mug up things. Okay, Akshay, Prachi, Vedant cannot cram things, find it very difficult. Manisha Bhardwaj also finds it very difficult to cram things. Yes, I find it. This is an honest opinion, guys. So I'm not judging you. I'm not giving you any marks on the basis of this answer, but I'm just asking an honest opinion from all of you. I'm just asking an honest, because unless and until we accept our weaknesses, we'll not be able to work upon it. So unless and until you tell me your weaknesses, I will not be able to work upon it. I will not be able to suggest something for you. Chahat says very difficult. Sarvanan says I find it difficult, very difficult. I find it difficult. Please give suggestions. Okay, Akash Jain says please give. I find it difficult. So most of the students find it difficult. So who are those who are really good with mugging up things and good with cramming, and they are okay with cramming, and they are like, okay, so we can cram whatever, we can cram word to word, reproduce it in the examination as it is without even a single change in word. How many of you are comfortable with it? Not many, I guess. Please use English. No, Ujjwal, I cannot use English because there are a lot of students from South, so they don't understand Hindi, so I cannot use English. I have to use English only. That's the problem. Okay, so most of you are finding it difficult to cram, and I got the answer. I got the general consensus that you are really having a tough time mugging up those subjects like audit, subjects like strategic management, subjects like law, which require a lot of mental mugging power. You are finding it difficult and you are having a tough time with those subjects. I agree, guys, but unfortunately, guys, this is also a theory subject. This is also all about mugging, cramming. Unless and until you are able to reproduce the exact language of the study material in the examination hall on the examination answer sheet, unless and until you are able to reproduce it, doesn't matter whether you understand the topic or not, but the most important thing is cramming, most important thing is mugging up. Unless and until this skill of mugging up, this skill of cramming is polished, is to the best of its capabilities, guys, you will not be able to score well in this particular subject, because at the end of the day, howsoever good I am in making you understand this subject, but the reality is that it's a theory subject, and being a theory subject, you cannot help it but to cram it. The only alternative is to cram it, is to rectify it, is to as it is reproduce it, because the examiner is looking for the exact language which is given in the study material, the exact words which are given in the study material in the same manner as it is given in the study material. And if you deviate from that language, if you deviate from that particular grammatical sequence of things, then you are bound to not score well in audit. And if you do not score well in audit, then naturally your entire paper number 12 goes for a toss, because out of 50 of accounts, even if you score 35, then you at least have to score 20 marks or 25 marks in audit to get there. And if you are not good at cramming, it will be a difficult task. It will be a really a miserable situation for you, which you're going to deal in this particular subject. And whatever I spoke for last 2-3 minutes is absolutely crap. It's absolutely rubbish. It's absolutely baseless. Guys, before starting audit subject, let me clarify. Let me wave off this particular notion from your mind that audit is pure theory. So many students come to me and they tell me that, oh sir, audit is an easy stuff. We can cram it at the end. You give us 15 days, we'll cram it, we'll mug it, and we'll give the paper. That's okay. We'll not spend our time to understand audit and all that stuff. So we are not going to do that. So we are just going to cram it at the end day, and we'll just reproduce in the examination. This is the mindset with which students start studying audit, and this mindset is absolutely incorrect. So before I start my chapter number 7, miscellaneous audit, guys, I would like to change your mindset today. I would like to change your thought process with respect to audit today. Yes, audit is a theoretical subject, but it's not for mugging. It's not for cramming, because the entire paper of audit is based on case studies. And unless and until you are able to understand the topic well, you are able to get the genesis of the topic, you will not be able to perform well in case studies. Case studies are not direct, they are indirect. So out of 50, at least 20 or 25 marks of your paper will be case studies. If you mug up this subject blindly, if you try to cram this subject blindly without understanding, I am very sure you're not going to gain marks in this particular subject, because this subject doesn't need cramming, doesn't need mugging up. It needs basic understanding of concepts. So just like you grasp concepts in your practical subjects, just like you grasp concepts in your numerical based subjects, you have to grasp concepts of this particular subject as well. And concepts are all related to practical life. They are all related to practical experience. So unless and until those practical experience are imbibed by you in your concepts, you will not be able to perform well. So learning number 1, before even we start the chapter, learning number 1, audit is not only about mugging, cramming, etc. If you mug and cram, you are bound to fail in audit. You have to understand the concepts. You have to understand the basic principles of audit. Only then are you going to succeed in audit. So just leave this thought outside without starting this class, outside your mind, that audit is cramming, audit is mugging up. Leave this thought outside your mind. Just wave it off, just scrap it, because it's not the right thought. Okay, sir, we got it, and we are all ready to start our chapter number 7, chapter on audit, and we are definitely going to score marks along with. Okay, so please tell how to study practical point of view. Okay, surely Tejashri, leave it to me. I will tell you how to study it from a practical standpoint also. So let's start our chapter number 7, miscellaneous audit. And chapter number 7 is one of the most important topics of our syllabus, guys. And I chose it because most of you had opted for this particular chapter to be discussed in this particular webinar. And if you can see the chart, it shows an astonishing increase in the marks which this chapter holds in the examination. Guys, for past few attempts, this chapter has been coming in for even more than 10 marks. Earlier, the weightage of the chapter was quite less, but after the advent of syllabus 2016, this chapter has increased its weightage. So it ranges somewhere between 12 to 16 marks, depending upon what is the attempt. But yes, this chapter holds a very strong percentage in your examination. So needless to say, this is the most important chapter of your syllabus. Miscellaneous audit, chapter number 7. Okay, so before starting the contents of this particular chapter, let me ask you, what do you mean by miscellaneous? What is the meaning of word miscellaneous? So guys, miscellaneous means some residuary category, some audits which are not the main audit, but a subset of audit, a leg of audit, a branch of audit, or a section of audit. They are not full-fledged audit. They might be some minuscule part of audit. So part of something is known as miscellaneous audit. So of course, in the earlier chapters, we would have studied the main audit concepts, but in this chapter, we'll study miscellaneous audit concepts, which means that we'll study not the whole audit, but we'll study some small parts of audit, some small parts which are, of course, a part of audit, but not a wholesome audit. So in this chapter, we are going to study some small parts of audit. And the first topic which we are going to start in this particular session is the branch audit. So guys, branch audit is a subset of audit, is a subset of the broader spectrum of audit. And what do you mean by branch audit? Before discussing what do you mean by branch audit, let us discuss what do you mean by a branch. So what is a branch? So if you read the technical language of the law, Companies Act 2013, it says that branch office in relation to a company means any establishment described as such by the company. So we have shifted the onus. The Companies Act has shifted the onus to the company. Whatever company says that this is my branch is the branch office. That's it. So the onus is shifted from the Companies Act to the company. So if company tells you that this is the branch, that is the branch office. Now guys, let me tell you in a practical parlance, in a most practical way, what do you mean by a branch? Guys, branch means an extension of the company located a little far from the company, which has the capability of working like a full-fledged company. Let me repeat. It is an extension of the company located away from the company, which has the capability of running full-fledgedly like a company. I'll give you a simple example. So, I am into business of trading of rice. I buy rice from the farmers of MP and I sell it over various parts of India. Now, my head office is in Delhi. So, I bring or I purchase the rice paddy from Madhya Pradesh, bring it to Delhi and then disperse it to various parts of the country. Instead of doing this tedious task, I have another option. I had an idea. I thought that let's make some branch office in Uttar Pradesh. Let's make a branch office in West Bengal. Let's make a branch office in Tamil Nadu. And instead of bringing the paddy from Madhya Pradesh to Delhi, why can't we directly source the paddy from Madhya Pradesh to Tamil Nadu, our branch office, and then branch office can disperse it in Tamil Nadu, various retailers of Tamil Nadu. This can also happen. So we gave authority to our branch. Listen, our branch in Tamil Nadu, you please purchase paddy from so-and-so vendor of Madhya Pradesh. Vendor will be decided by me because I am quality conscious. I need to maintain my quality. My quality is my priority. So I tell my Tamil Nadu branch, listen branch, you please procure your rice from Madhya Pradesh, so-and-so vendor, so-and-so farmer, and you source it to Tamil Nadu, and then you sell it to the various vendors of Tamil Nadu, various wholesalers and retailers of Tamil Nadu. This is what I instruct to my branch. Guys, obviously, after my branch becomes an independent authority, an independent person, obviously, initially, they would need my guidance, but after 2, 3, 4, 5, 6, 7 transactions, they'll work on their own. They'll be independent. They'll say, okay, now we don't want your instructions. Now, I'll tell them, okay, you don't need my instructions. I agree. But at least I want to get your audit done because I want to know whether you are performing your duties diligently or not. I agree. You work independently. I have no problems in that. But at the year end, I want the profits to be transferred from branch office to head office. Condition number 2, condition number 1. Condition number 2, I head office wants an audit to be done for the branch so that I'm sure that no hanky-panky stuff, no window dressing, no siphoning of funds is happening in my branch. I want to make sure that everything is going smooth, everything is going fine. So guys, what is a branch? Branch is an extension of the head office located a little far from the head office, which is capable of, the branch is capable of working independently. It is capable of working independently with respect to operations. But yes, finance, profits, and all those stuff are definitely the responsibility of the head office only. Okay, sir, we got it. So this is known as branch. Now let me show you a diagram which will tell you what is a branch. So guys, this is a branch. So there's a corporate, there's a company. There are 3 branches, and those branches have independent employees. Those branches have people and they are working independently. Now guys, there is a situation, there can be a possibility that this head office, suppose it is located in Delhi, branch 1 is located in Mumbai, Maharashtra, branch 2 is located in Madhya Pradesh, and guys, branch 3 is located in Dubai. So there can be an Indian branch, there can also be a foreign branch. There can be 2 types of branches. There can be domestic branches, there can be foreign branches. So both branches are possible. Now again, my concern, what is my concern? I am the head office. I am sitting in Delhi. I am the head office. What is my concern? My concern is you work independently. I have no problems in that. I have given you my IP. IP means intellectual property. I have given you the technique of working. I have told you which vendors are best in Madhya Pradesh to obtain the paddy from. I have told you everything. Now you work independently. I don't have any problems with you. What are the 2 things I want to control? Thing number 1, sir, the entire profits at the year end should be transferred to the corporate, should be transferred to the main head office. And number 2, I want auditing to be done. Audit should be done for all these branches, because at the end of the day, my financials, what are financial statements of Delhi office? Financial statements of Delhi office are a consolidation of head office financials plus branch office financials. They are consolidation of these 2 things. So the financials of Mumbai branch will also get merged in Delhi branch. The financials of MP branch will also get in Delhi branch, Delhi head office. The financials of Dubai branch will also get merged in Delhi head office. So I want this audit to be done. So audit will be done in obviously segregated manner. The auditor which the head office has appointed. Now the question is, sir, whether the same auditor has to go to Mumbai. Auditor is located in Delhi. Whether the same auditor should go to Mumbai or we should have some other auditor. And so the more difficult question is whether the same auditor who's appointed in Delhi should go to Dubai also. Sir, if that is the case, I want to be auditor of this particular company because I want to travel. I want to go to Dubai to get this audit done. Obviously not in today's scenario, because today Corona is widespread in entire world. So not in today's scenario, but once Corona is curtailed, once Corona is contained, then I want to go to Dubai to audit this particular entity, sir. Please, sir. Now, the first question which would come to our minds would be, who should be the auditor of the branch? Obviously, the Delhi head office has appointed an auditor, and he has appointed a whosoever, chartered accountant, cost accountant. So chartered accountant are doing audit of financial accounts. Cost accountants are doing financial of cost accounts. Company secretaries are doing financial audit of secretarial accounts. So all these 3 things have 3 different connotations. Now the question is, the moot question is, sir, should the auditor of branch office and head office be the same person, or can there be a distinguishing factor, or can there be a distinction between these 2 auditors? Let's find out. Okay, so branches can be of 2 types, Indian branch and foreign branch. Guys, Indian branch, where a company has a branch office, the accounts of that office shall be audited. Either, guys, what do you mean by either? Either means an option is given to you. There's an option which is given to you, is to be audited either by the company's auditor. So the company's auditor can audit, okay, sir, so we are, sir, free to go to Mumbai. We are free to go to MP. Yes, we are free to go to Mumbai. If you want to go to Mumbai, please go ahead, go to Mumbai and audit the branch. And if you want to go to MP, please go to MP and audit that particular branch also, if you are the auditor of the Delhi head office. So where a company has a branch office, the accounts of that office shall be audited. Guys, that means branch office. Accounts of branch office shall be audited either by the company's auditor. So the company's auditor can go, which means if I am the company auditor, I am the auditor of Delhi head office, I can go myself to Mumbai. I'll book a plane ticket, air ticket, and I'll go to Mumbai. Obviously my plane ticket cost, my lodging cost, my boarding cost, everything will be borne by the client. I will charge him because I won't have this expenditure from my pocket. I will charge him. So either by the company's auditor, or what is the other option? Other option is by any other person qualified to be appointed as an auditor of the company under section 139 of 2013 Act. So guys, every company in today's world is cost conscious. Cost conscious means they don't want to spend a lot of money on the auditors, on their movement, on their air tickets, on their lavish stay in hotels. They don't want to spend. So the second alternative which the company can suggest the auditor is that, sir, why don't you appoint a local auditor in Mumbai? So there'll be a chartered accountant firm, cost accountant firm in Mumbai as well. Why don't you appoint some other audit firm in Mumbai and let the audit of branch be done by that particular person instead of you going? Because if you are going, then you will incur flight cost, you will incur hotel cost, you will incur boarding cost, lodging cost. And if you go over there, you would be lured to see the gateway of India. You would be lured to have cup of coffee in Taj. You would be lured to visit various monuments in Mumbai, etc., etc. Why are you increasing our cost? Why don't you hire a local CA or a CMA in Mumbai and ask him to do audit of branch and send you the report? So that option is also available. Now, who will decide whether the main auditor will go or whether the new branch auditor should be appointed in that particular city? Who will decide? That is the question. And I want you to write in chat box. I'll give you two options. Option A, sir, company will decide whether the main auditor should go to the branch. Option number 2, the auditor will decide whether the main auditor should go to the branch or a fresh auditor, a local auditor should be appointed. So tell me which one of the two options is true. Option number A, company will decide who will do this. Option number B, auditor will decide. So A or B, you just have to write A or B. Whether company would decide A, auditor would decide B. So answer A or B. I just want A or B from you. A, B, A, B, A, B, A, B. Everyone is mixed. I mean, A is company. Piyush, Tanmay Chatterjee. A is company. B is auditor. A, Tejashri, A. Okay, now suddenly A's have rush. Both of them can decide. Perfect, Chahat. You've given a middle way. Both of them will decide. Let me tell you guys who will decide. The primary decision-making authority in case of decision with respect to audit is the auditor himself. Auditor cannot be restricted in deciding whether he should go to the branch or whether someone else should do audit of that particular branch. Yes, company can suggest. Company can suggest, but it's ultimately auditor's decision whether to have himself, whether he should go to that particular location and do audit or whether there should be a local auditor who's doing this particular audit. Now, there's one exception to this rule. One exception to this rule. Guys, if the audit is a non-statutory audit, there's a difference between statutory audit and non-statutory audit. Statutory audit means the audit which is required by law. Non-statutory audit means the audit which is not required by law and the company itself is proposing that audit because it wants to have benefit of the audit. In case of non-statutory audit, it is the company who decides whether the main auditor should go to the branch or whether there should be a local auditor who should audit this branch. But in case of statutory audit, which is my example, chartered accountant doing a financial audit or a cost accountant doing a cost audit. In this case, the primary decision-making authority is the chartered accountant or the cost accountant himself. Company can suggest them, but cannot force them. So the chartered accountant or cost accountant should decide whether they should visit the branch personally. If they think that it's very important to visit the branch personally, then they will visit the branch personally, or they will give this authority to some other auditor. Okay, you do audit and you send us the report. So option is given in law. Option is given in law that both are possible. But yes, you have to maintain one thing, that the auditor who is locally appointed as the branch auditor should be a valid auditor under section 139 of the Companies Act. 139, the qualifications of the auditor should be met by that particular auditor. That is the prime condition. Now let us come on to foreign branch. And sir, we were waiting for this one because we want to go to Dubai for doing audit. We want to go out of India for doing audit. And guys, trust me, once you qualify your CMA and once you become a part of an MNC, you will get ample opportunities to go outside India and to venture out, because today MNCs are the only global firms where global exposure is given to you, and you will be definitely going outside. So don't worry, just qualify your CMA quickly. join an MNC and you will be auditing a foreign branch very, very soon. So foreign branch, in case of a foreign branch, what will happen? Where the branch is situated outside India, the accounts of the branch office shall be audited again either by the company's auditor. Again, sir, the option is given. It is either by the company's auditor or by the accountant or by any other person which is a local auditor, duly qualified to act as an auditor in accordance with the laws of that country. Now, this is very, very important. Guys, in this case, in India scenario, the auditor, the local auditor, should be the auditor as per section 139 of the Companies Act. In case of global scenario, in case of a foreign branch, the auditor should not meet the criteria of the local Companies Act. It should meet the criteria of the place where this particular branch is there. So, for example, Dubai. If you are trying to find a local chartered accountant of Dubai, then guys, the chartered accountancy or cost accountancy course which is there in Dubai, that should be the qualifying person, and he should have studied from their cost accountancy institute and not from cost accountancy institute of India. So that is a major difference between a foreign branch auditor and a domestic branch auditor. Domestic branch auditor has to be 139 approved auditor, and a foreign branch auditor should be the auditor who has been approved by foreign law wherever the branch is situated. So this is the difference between foreign audit and domestic audit. Now, guys, the major thing, if there are say two auditors, branch auditor and the main auditor, then branch auditor will say, okay, you take the responsibility. It's not my responsibility. Because if there are two, so you've heard a proverb, too many cooks spoil the broth. So if there are two cooks, then guys, both of them will try to shrug away their responsibility, because signing audit is a very, very risky task. So both branch auditor and the main auditor will be shrugging off their responsibilities from their shoulders. They would want to transfer responsibilities to each other. Okay, you do this. Okay, you do this. This will happen wherever there are two auditors. To avoid any confusion, to avoid any conflict, the law is very clear and the provisions are very clear. The provisions are, who will consolidate the audit report? Consolidation means there will be a branch audit report, there will be a head office audit report. Now we need one audit report, so consolidation is the major task. So question is, who will consolidate the audit report? Because we cannot have two audit reports for 1 year for one company. Company is one. Branch and head office, company is one. We cannot have two audit reports. Who will consolidate the cost audit report, the audit report? The branch auditor shall prepare a report on the accounts of the branch and send it to the company's auditor for incorporation in the main audit report. So who's responsible for consolidation of the audit report? The main auditor, guys. The head office auditor has the primary responsibility of consolidation of the audit report. So naturally, if the consolidation is the responsibility of the main auditor, who is ultimately responsible for everything? The company's main auditor is responsible for overall financials, even if branch auditor is appointed. So guys, a very important point over here is, suppose branch audit report is clean. There is no problem in branch audit report. And suppose tomorrow we find out that there was a fraud going on in that branch. The branch auditor failed to report the fraud which was going in that branch. Undoubtedly, branch auditor will be taken into remand, but the main auditor will also be held responsible, because the ultimate responsibility is of the main auditor. And that is why I told you that the decision of whether the branch should be audited by the main auditor or by a local auditor, this decision is with the main auditor and not the company, because company will try to mislead the auditor, can try to mislead the auditor. So it's all entirely auditor's decision, the main auditor's decision, because guys, ultimately the responsibility of the entire audit, if anything goes wrong, whether in the main head office or in the branch office, if anything goes wrong, it will be the main auditor's responsibility. So who will have the ultimate responsibility? It is the main auditor who has the ultimate responsibility. Next, what is the branch auditor's responsibility? To report fraud. So if some fraud comes into a light of branch auditor, and branch auditor, what steps should branch auditor take at that point in time? Guys, the same steps which company's auditor has to take, the same steps are required to be taken by the branch auditor also. So yes, there's a monetary threshold, 1 crore rupees. If the amount involved in fraud is above 1 crore rupees, then the reporting is to be done to the ministry. And if it is below 1 crore rupees, then the reporting is done to the board of directors. This we had studied in our chapter number 4, which is company audit. So yes, same responsibility which the company's main auditor has, branch auditor also has same responsibility. He should report the fraud to the relevant authority as soon as he discovers the fraud. He cannot shy off from his responsibility of disclosing fraud. Fraud is a serious offense, and fraud is not to be taken lightly. Fraud is to be taken very, very seriously, and therefore the branch auditor. So what can be the other option? Other option can be that, okay, branch auditor waits for his final report to be sent to the main auditor, and main auditor consolidates that report and releases it. Branch auditor can also do this, but no, branch auditor doesn't have to wait for the consolidation part. Branch auditor doesn't have to tell to the main auditor, oh, fraud is happening, you please take care of it. No, branch auditor has to immediately inform that happening of that fraud, not only to the company, but also to the ministry if the monetary threshold is met. So responsibility to report fraud as applicable to the company's auditor applies to the branch auditor as well. So you need to really understand these 2 points in light of the responsibility, in light of the burden, the work burden which has been shared by the branch auditor. Now, the moot point is, the primary point is, everything said and done, main auditor is the ultimate guy who's responsible for the entire audit. And main auditor will be held responsible in every case, in any and every case. Main auditor cannot say that, oh, I didn't audit this branch was audited by a local auditor, please ask him. Main auditor cannot say this. It's main auditor's neck which is on the block. So main auditor has to be careful in deciding whether he has to go himself to the branch or whether he has to appoint some local boy, some local chartered accountant, some local professional to audit the branch. Therefore, really important to understand the roles and responsibilities of the main auditor and the subsidiary auditor. Okay, so the next topic which we are going to start is the joint audit. What do you mean by joint audit and what is the meaning of joint audit? So appointing more than one auditor for conducting audit of an entity, especially big organizations, is known as joint audit. So what is the difference? Even sir, branch audit was the same. In branch audit also we had appointed more than one auditor. Guys, no, there's a big difference. So the relationship between the branch auditor and the main auditor was like that of a holding and a subsidiary. Primary responsibility was of branch auditor. Secondary responsibility was of the primary responsibility was of the company auditor. Secondary responsibility was of the branch auditor. So branch auditor was always one notch below the company auditor in terms of responsibilities, in terms of liabilities. The branch auditor was always below. This was the relationship between branch auditor and the company auditor. Guys, but in case of joint audit, both the auditors have same responsibility. It is not that one auditor will audit a branch and second auditor will be the head office auditor. All the auditors in this case will be the head office auditor. All the auditors will audit the head office. All auditors will have access to the financials of the head office. In case of branch audit, the branch auditor had the access of only branch financials. Branch auditor could not see the head office financials. Head office financials were to be taken care of by the company auditor, the main auditor. In case of joint audit, there is no main, there is no subsidiary, there is no secondary. Both are main. Joint audit, both are main. So, what's the use? What's the fun of having two auditors in the same organization? Auditing same set of financials. What's the fun? What's the use of having two different auditors? So guys, the use is big organizations having huge financials, having complex books of accounts, having plethora, lakhs and lakhs and lakhs of transactions in their financial statements, find it difficult to hire only one auditor because every auditor has limitations with respect to its resources, with respect to time, with respect to the statutory time limit which is given to complete the audit. Everyone has his own restrictions. So amidst these restrictions, there is sometimes a requirement for two auditors who can work simultaneously to finish the audit on time, to finish the audit quickly. That is why joint auditors are appointed. One more reason which you don't have to write in your examination, guys. This reason is a practical reason which I'm telling you. You don't have to mention it in the examination. It's just for your knowledge. So what happens is, in domestic companies who are looking forward for foreign funding which is done by foreign people, which is known as private equity, PE funding. It's known as PE funding. So if there's a domestic entity who's getting audited by a domestic chartered accountancy or cost accountancy firm, if that entity is seeking for funding from a private equity from outside India, say United States, so there is a fund in United States, say fund's name is Bessemer's. Bessemer's wants to invest in Indian firm which is audited by Indian chartered accountant or Indian cost accountant. Now that US guy doesn't know about the Indian chartered accountant, about the Indian cost accountant. So the US guy requests the Indian businessman to get its financial audited also by a big four, because they have more trust on big fours. US companies have more trust on big fours because they are aware about big fours. So they tell the domestic businessman to, okay, get your accounts done by a big four as well. Businessman, the Indian businessman, has no choice but to appoint two auditors. One, his hierarchical auditor, the auditor which was going on for so many years, the Indian auditor. Second would be one of the big fours. This is also one of the reasons why joint auditors come into picture. And usually, guys, joint auditors is a mix of a big four and a domestic chartered accountancy firm. Generally, they are a mix. If you see a balance sheet of Reliance also has two auditors signing its audit report. One is an Indian firm, second is an international firm. Again, this combination is really required from a practical standpoint in many of the cases. But as I've told you, you don't have to write this in your examination. This is just for your practical consumption. In examination, you have to write that because of big companies, complexity in accounts, multiplicity of transactions. The transactions are huge. 5 lakh, 10 lakh, 12 lakh transactions per year. And to audit such a wide variety of transactions, it's difficult for any single Indian firm or a multinational firm to audit. So that is the reason why joint auditors are hired. So this is the picture which demonstrates joint auditors. So guys, if we consider this round as the financial statements of a particular entity, this entire pie is the financial statements of an entity. So the joint auditors will distribute certain sections amongst themselves. So Mr. Red will say that, okay, I will audit the fixed assets. So this is the portion of fixed assets. Mr. Yellow will say, okay, I will audit the current liabilities and the long-term liabilities. So this portion, which is blue, is given to Mr. Yellow. Mr. Yellow will audit the current liabilities and the long-term liabilities. Mr. Green will audit the current assets. So the red portion represents the current assets. So the current assets will be audited by Mr. Green. Mr. Blue will take care of the contingent liabilities in the entire organization, and it will audit the contingent liabilities of the organization. So their work will be distributed amongst themselves. So the entire financial statements will be divided into various parts, and we will equally divide the work among ourselves if this is the case of joint auditor. Guys, in case of branch audit, the work was divided on the basis of entity. Entity means head office being audited by the company auditor. Branch office, all the heads being audited by the branch auditor. So this was the bifurcation in case of branch audit. But in case of joint audit, bifurcation is with respect to the work which is to be done. The work is fixed assets are to be audited, liabilities are to be audited, current assets are to be audited, long-term liabilities are to be audited, contingent liabilities are to be audited, related party transactions are to be audited. So they will divide their work according to the work which they think they can do best, and this is how division of work will happen amongst all the 4 joint auditors. In this case, I have shown you 4 joint auditors, but 4 is quite a large number. Usually you find 2 joint auditors, maximum 3 joint auditors. Although there's no restriction in law, you can have as many joint auditors as you want, but mostly companies have maximum 2. minimum 2 and maximum 3 joint auditors. So this is a diagram which is portraying the actual split of a joint audit amongst various auditors. Now, of course, there has to be some advantages of this particular scenario, some disadvantages. Guys, trust me, wherever there is a branch audit kind of a thing where the responsibilities of one of the auditor, then that auditor will be very due diligent. He will be very, very careful in doing everything properly. Wherever the responsibility is split amongst various people, they will be bound to become negligent. Even if they see something wrong happening in someone else's portion, they will close their eyes. They will say, oh, this was not my area. My area is fixed assets. I will audit fixed asset. So if they will see any error coming in current assets, they will ignore it. This is bound to happen. So we need to have a strong mechanism to control the responsibilities of these auditors. So before coming on to responsibilities, let us see what are the advantages and disadvantages. So it lowers the workload naturally. Timely completion of audit. Time taken is less because the work is divided and everyone is doing their own business. Improved quality of audit because sharing of knowledge and experiences, because 4 people definitely would have more knowledge than 1 people. So they share their knowledge, they share their experience. And healthy competition, which means everyone would want to find out some qualification with respect to their area, and they will have a healthy competition. Disadvantages are ego clashes. So guys, obviously they are bound to fight amongst each other. They might fight amongst each other on silly things. So ego clashes will be there, because ego clashes is not there where there is someone junior and there's someone senior. Where all are seniors, their ego clash will happen. If there is one junior, one senior, which is the branch auditor is junior, company auditor is senior, their ego clash will not happen, because branch auditor knows that he has to follow whatever company auditor is saying. But guys, where all of them are seniors, like in case of joint audit, their ego clashes are bound to happen. Obviously costly, because all of them will charge their separate fees. Lack of coordination between auditors can be detrimental. So if they do not work properly in coordination, in sync, so if they are not clear about what responsibility is to be done by whom, then there is bound to be detriment quality will be compromised. Dispute in distribution of work. Someone will say, I am not doing fixed asset. Other will say, okay, I am also not doing fixed asset. So everyone will fight for what kind of work should be done by whom. Shrugging of responsibility. Shrugging means shying away or throwing your responsibility to someone else. So as I gave you the example that, okay, if fixed assets is my responsibility, then guys, even if I'm seeing that something wrong is happening in current assets, I will not point it out. It's not my responsibility. I will say, oh, it was not my responsibility. To hell with it. So this is the disadvantage of a joint audit. Now comes a very, very important portion, the responsibility. Guys, we need to really distribute the responsibility well. And if we don't distribute the responsibility well, then the audit will be ineffective. The audit will lose its charm, will lose its essence, and we don't want the audit to lose its essence. So responsibility sharing in case of joint audit, and there is a standard on auditing for this particular concept, standard on auditing 299. Guys, one thing very, very carefully you have to fit in your mind, that standard on auditing text is not there in your syllabus. You just have to know the names of important standards, that's it. So if you are studying from some module or some study material where standard of auditing text is also given, it's not relevant for CMA students. Yes, it's relevant for other professional courses students, but not for CMA student. Standard on auditing is not there in your syllabus. It's just that its reference is there in your syllabus. Its text is not there in your syllabus. So I will reference it somewhere. I will use its references, but I will not teach you the text of standard of auditing. So text of standard of auditing is not relevant to you. Okay, sir, we got it. So individual responsibility, joint responsibility. Now I would want to fix responsibility of the joint auditors and the separate auditors amongst themselves, because if the responsibility is not fixed, then they are going to fight amongst each other, and there will be a detriment, which will be detrimental to the quality of the audit. Now, individual responsibility, where auditor's responsibility is only limited to his own self. Individual responsibility is there for the respective work allocated to each auditor. So whatever work is allocated to each auditor, it is their own responsibility. So the work which is allocated to Mr. A should not be, the responsibility should not be given to Mr. B. So Mr. A will be responsible for the work which is given to Mr. A. Now, for some areas, there will be joint responsibility, which means if error happens in that area, all the joint auditors will be reprimanded. In case of the work allocated, which is this section, in case of specific work allocated, if there is an error in that particular work, only that auditor will be reprimanded. But in some areas, in some of the fields, all the auditors will be reprimanded, all the auditors will be scolded if error is in that particular area. So this is known as joint responsibility and individual responsibility. Let's see which are the areas where all the auditors are equally responsible. Number one, work which is not divided. So if there is work which is not divided, all the auditors cannot say, okay, it was not us, not us, not us, not us. They cannot say that. If the work was not divided, then all the auditors had the responsibility to do that work, and the ministry will say, okay, you decide who is to be held responsible. I will hold all of you responsible because you didn't choose your sections well. So work which is not divided, all the auditors will be held responsible. Next, decision taken by all the joint auditors. So if in some of the account heads, the decision was taken by all the joint auditors. So for example, if inventory count was to happen and inventory count had to happen on 31st of March, and all the auditors agreed that yes, inventory count should happen on 31st of March, then guys, inventory count related observations are a responsibility of all the auditors. So whosoever will take the decision, if all of them will take the decision consolidatedly, then that area will be responsibility of all of them. Tomorrow, you cannot say that, oh, I suggested them that they should do audit on 31st March, but they didn't do. I am not bothered. You have to be bothered. When you took a decision and you told them that this should be done, then you have to be bothered. Then you have to tell them, oh, please do it on 31st March. Inventory count should happen on 31st March. So the decisions taken by all the joint auditors is the joint liability. In respect of matters which are brought to notice of joint auditors, so I told you that if my responsibility is fixed assets and I'm seeing some problem happening in current assets and it comes to my notice, then I cannot waive off my responsibility, guys. I have to be responsible and I have to, find out that why is that particular thing not happening in the correct manner. And I have to inform the person who is doing current assets. I have to inform that person. So in respect of matters which are brought to the notice of joint auditor by any one of them and on which there is an agreement among the joint auditors. So if any matter has been discussed between two auditors, then that matters becomes a joint liability and no longer a singular liability. Then the disclosure requirements. What are the disclosure requirements? Guys, in the financial statements, one thing is the numbers which come. So fixed assets, so and so lakhs, current assets, so and so lakhs, investment, so and so lakhs. This is the number. Apart from this, there are certain disclosures which are required to be made. For example, fixed assets amount is 2 crore rupees. But on fixed assets, there is a star and the star is defined as these 2 crore rupees have been hypotheticated, which means I have given this as a security to bank for obtaining a loan. This is known as a disclosure. So to obtain the loan of 2 crore rupees, we have given security of fixed assets. So guys, the disclosures are all the auditor's responsibility, whether they are doing that area or not. So the numbers means fixed asset is equal to 2 crores is the responsibility of the auditor who is auditing fixed asset. But this footnote, which is coming as an asterisk, that the fixed assets are hypotheticated for the loan which is taken, this is the responsibility of all the auditors. All the auditors should be vigilant, should be diligent that, okay, the financial statement should have adequate disclosures. Disclosures is not an individual responsibility. Disclosures is a consolidated responsibility of all the auditors who are involved. Then for ensuring that audit report complies with the requirement of the relevant statute. So the audit report should be perfect. This is the responsibility of all the auditors. Guys, in branch audit report was the responsibility of the company auditor. But over here, audit report is the responsibility of all the auditors. So that is why joint audit means that all the auditors are main. Branch audit means that one auditor is main, one auditor is secondary. That is the difference between joint audit and branch audit. Yes, sir, we got it. Okay, last principle. The last principle of joint audit is that who will prepare the report? How will the report be prepared? So in case of branch audit, the report was prepared by the main auditor, and it was main auditor's wish, whatever he wanted to give in the report, he would give. So if the main auditor feels that the qualification given by the branch auditor is useless, the main auditor can thatch that qualification and not give it in the main report. The main auditor had this power in branch audit. But in joint audit, of course, all the auditors are common. So there is no main, there is no subsidiary, there's no secondary. So all the joint auditors' opinions matter a lot. So the principles of joint audit is that audit firm A, audit firm B, both should give one audit opinion. So there should be consolidated audit report, and the joint auditor should be able to arrive at an agreed report. So there has to be agreement between the joint auditors for all the elements of audit report. Guys, in case of branch audit, the branch auditor could have, the main auditor could have disagreed with one of the opinions of the branch auditor. But over here, one auditor cannot disagree with the opinion of another auditor. One auditor has to convince the other auditor about the opinion, because all of them are main. Sir, what if some auditor is not agreeing to the observations of other auditor? What will happen? Guys, first tell me what will happen in case of branch audit. If company auditor is not agreeing to the opinion of a branch auditor, what will company auditor do? Sir, he will ignore the branch audit report's opinion. Yes, he will ignore, because the ultimate responsibility is of the main auditor. But over here, in joint audit, he cannot ignore. Let's read the next bullet. Where the joint auditor are in disagreement, if there is some disagreement between the joint auditors on any matter, each one should express his opinion through a separate report. So this is the major difference, guys. Over here, we give powers to all the joint auditors to have separate reports if they are not agreeing on a particular issue, if they are not agreeing on a particular point. But in case of branch audit, the branch auditor was not having any authority to have a different audit report. Audit report was one which was prepared by main auditor. Now it was main auditor's discretion whether he wanted to incorporate the suggestions given by branch auditor or not. If main auditor feels that, okay, this suggestion or this qualification is not relevant, it is not material, he can ignore it. But in case of joint auditor, cannot be ignored. They have to be either agreed on one report, and if they do not agree, then they can have separate reports for the matters on which they do not agree. So these were the main differences, or so to say main principles of two important elements of your chapter, which is the branch audit and the joint audit. So yes, that's all for this particular session, and I'm open to questions. If you want to ask me any questions, then I'm opening the floor now. So I'm opening my chat box now. I can see a lot of chats and messages over there. Will they help each other? Yes, Tejashri, they will help each other. Joint auditors will help each other, but they will maintain the Chinese wall, because there'll be segregation in their duties, in their fields. So yes, that is happening. So why ignorance is in disadvantage? They can, but they must have some ego clashes. So why ignorance is in disadvantages? So ignorance is in disadvantages because we are guys, disadvantage ignorance is because one will not bother what other one is doing. That is the disadvantage with joint auditor will have. Okay, so hello and welcome, guys, and welcome to yet another session of the audit. And yes, audit is 50 marks syllabus in your subject paper number 12B, and we have discussed an important element of paper number 12B yesterday. Yesterday we had started with our topic chapter number 7, which is miscellaneous audit, guys, and today we are at the part 2 of this miscellaneous audit. Guys, just to reiterate, just to tell you why did I take this chapter first of all, why is this chapter so relevant and so important. If you see this chart, then this chapter actually holds a good weightage of marks in your examination, and for past few attempts specifically, this chapter has been commanding a weightage of 12 to 16 marks, which is huge. Out of 50 marks, approximately 25% is dedicated to this particular chapter. And yes,
this trend, according to me, should continue, and this chapter will definitely remain one of the most important chapters after chapter number 4, which is company audit. Definitely the second most important chapter is chapter number 4, but the first most important chapter is miscellaneous audit and its constituents, which are appearing in the examination again and again. And guys, you really need to keenly and very precisely complete this chapter, and from the notes or study material wherever you are studying, you have to do this very, very precisely. So yes, let's start part 2 of the chapter miscellaneous audit. Before starting the part 2, my question to all of you would be, what do you mean by miscellaneous audit? Why are we studying this chapter called miscellaneous audit? What is the relevance of this word miscellaneous? I told you yesterday itself that audit is a big procedure, and it's a detailed process. And miscellaneous means that any small part of audit, we'll be discussing some subsets of audit, some subparts of audit, and those parts of audit will be known as miscellaneous audit. So we won't be studying any law, we'll more be focusing on logics at this point in time. And I've already told you that audit is definitely not law driven. Its procedures are law driven, but the entire audit is not law driven. The audit is driven by logics. So yes, in this chapter, the institute has made sure that they introduce you to various small aspects of audit, various bits of audit, so that you are well versed with the specific technicalities of each kind of audit. So for example, if you are auditing a hospital, what important points do you keep in mind while auditing a hospital? So suppose you are auditing an educational institution, you are auditing a college or a school, then which points should be kept in your mind to audit that particular school or college? So this chapter includes all those various small elements of audit, which are not the main audit. They are not the entire gamut of what audit does, but they represent the subsets or small parts of audit. So this chapter is miscellaneous audit. So yesterday we had done 2 types of miscellaneous audits, guys: branch audit and joint audit. I hope you have understood those 2 sections which we did yesterday. Today we are going to start audit of certain specific sections. So guys, you must have studied in your financial statements. Your financial statements contain an element called stock or inventory. So my question to you would be, where do you find the element of stock or the element of inventory in your financial statements? And I'm talking about the balance sheet. Where do you find the inventory or the stock in your balance sheet? Asset side or the liability side? Where do you find it? I'm waiting for the answers in your chat box. You should write where asset side or liability side contains inventory or stock. Perfect. The asset side contains a very important asset. That asset is known as inventory or the closing stock. And guys, if the closing stock is more or if it is less, then would it impact our profits also? I want answer in yes or no. So if the closing stock is more or closing stock is less, would it impact our profit also? I want answer in yes or no in the chat box. Perfect. That means stock is one such thing which not only impacts our assets but also impacts our profits. So in the profit and loss account, in the credit side, we find this particular ingredient called the closing stock. So I'll ask you a simple question. If the businessman wants to increase its profit, if it wants to window dress its accounts, and it wants to show that, oh, I have got a huge profit, then can he increase the closing stock to increase the profit? Can he increase the closing stock? Yes, sir. If he is able to increase the closing stock, then his profit will increase. So this is a very critical element of our financial statements, which is inventory, which is closing stock, because increase of inventory will have dual effect. What is the dual effect? Number 1, our assets will be inflated. Number 2, our profits will be inflated. So we have to very categorically audit this particular section of the financial statement, which is inventory. So we are today going to start the audit of inventory or audit of stock. So guys, if you can see the picture on the screen, the picture represents inventory of a particular organization. And yes, this is how the warehouse of a particular organization looks like. So that's you in the middle of the warehouse. This is a warehouse of a multinational company. That's you in the middle of the warehouse. And all these elements are the inventory of that organization. All these boxes, the boxes which you can see, all these boxes contains the inventory or contains the finished goods, raw material and work in progress of this particular organization. So these inventories are stacked in racks. Now this is you. This is the auditor of the company. That's you. That's the auditor. And guys, the paper which is in hands of the auditor, this contains the list of inventory or the value of inventory which the books of accounts has. So the first starting point of inventory is that let's check what is the inventory value in the books of accounts. So books of accounts will tell you, okay, we have 50 pieces of our finished goods. So 50 multiplied by the value of finished good is the closing stock. So 50 pieces of finished goods. So this round, this particular thing which is there in your hand, which you can see, which I am circling right now, is the list of inventory that has been given to you by the management of the company, by the client, that okay, this is the amount of stock which we have. Now with this list, you have come to the warehouse. And you've come to the warehouse to check whether the amount, the quantity of inventory is there or not in the warehouse. So this is how this is placed. Yes, absolutely, physical verification. Devi, you are absolutely right. This is known as physical verification of inventory. So this is the background with which I will start this topic called valuation of inventories, audit of valuation of inventories. So let's see. So first thing that you will do. So guys, again, keep law aside, keep regulations aside, keep rules aside, just apply logic. This is pure logic. First thing that you are going to see is the records of inventory. And where are you going to see the records of inventory? You are going to see the records of inventory in the books of accounts. The books which are there, the financial books, you are going to see inventory over there. Okay, so please don't think that my handwriting is really bad, but this pad is not allowing me to write properly. So that's why the handwriting is bad. Okay, so first of all, you will check the records of inventory that in the books of accounts, what kind of inventory is there, whether 50 units of finished goods are there, or 40 units of finished goods are there, or 30 units of finished goods are there. So first point of auditing the inventory is check what is given in your books of accounts. Now guys, what happens is, sometimes your books are disclosing 50 units of inventory, finished 50 units of finished goods. But when you actually go to the go down and check, there are lying only 40 units of finished goods, which means that 10 units of finished goods have been leaked, has been someone has stolen them. There are situations of theft. There are situations of people, employees stealing the inventory. So in that case, you have to be particularly vigilant that first of all, you need to see what are the status of inventory in the books of accounts, that is the record. Then you need to go to the warehouse to see whether this quantity is available in the warehouse or not. Then ensure management has done physical verification of inventory. So management has to do physical verification of inventory. And yes, you also have to be present over there. So auditor is required to be present when physical verification of inventory is taking place. Otherwise, how would the auditor know whether the godown has 50 units of finished goods or whether it has 5 units of finished goods? How would the auditor know? So auditor should be present personally, physically at the godown to check whether the inventory which is stated by the management is complete or not. Then take confirmation from suppliers about deliveries. Now, one very important element of auditing inventory is that, guys, on a sample basis means 2 or 3 items. You can check from the suppliers that have they given delivery to the company or not. So specifically in case of raw material, guys, raw material are supplied by the third parties, by the vendors. So you need to call the vendors or you need to have a confirmation, written confirmation to the vendors. You can send it to them and you can ask them whether you have actually sent this quantity of raw material to the company. So sometimes if you are unable to attend the physical verification, then this is the way to ensure that yes, this much quantity of goods has come inside the factory premises. So take confirmation from the suppliers about delivery. You can take confirmation from the suppliers of raw material about the inventory. Then ensure these proper controls. These are proper controls for movement and issue of inventory. Now guys, if the books of account have 50 units of finished goods, and if you go to the warehouse, there only 40 units of finished goods were found by you. That means 10 units of finished goods have been stolen from the warehouse. If 10 units have been stolen from the warehouse, then guys, it is a sure shot proof that the guard who is standing at the factory gate doesn't make inward and outward note of whatever is going out or whatever is coming in. Because guys, if that guard makes the note of inward and outward movement of inventory, then no one can steal your inventory. Because if the guard makes a note that yes, this person has taken these many goods outside, then everyone will be afraid, because if their name is written in the register, then someone will catch hold of them. So there has to be proper control for movement of inventory. If there is no proper control for movement of inventory, then there is a possibility that the inventory is stolen, or inventory is leaked, or inventory is not properly moved. Yes, proper inspection of outward movement is definitely required. Please sir, verification result के बारे में भी video बनाइए. Okay, Vandana, that is beyond topic. Let us focus on topic first. Okay, next is check the method of valuation and disclosure in compliance with accounting standards. Now, first of all, you tell me which accounting standard deals with the inventory valuation. Which accounting standard deals with the inventory valuation? I want your answers in the chat box. Which AS deals with the method of valuation? Yes, you are absolutely right. AS2 deals with method of valuation of inventory. Now, my one more question to all of you is, please tell me what are the three methods which are prescribed in AS2? What are the three methods which are prescribed in AS2 for valuation of inventory? Next, FIFO, LIFO, weighted average. Perfect. And guys, one more information for your benefit. LIFO is a prohibited method. LIFO is no longer used in any of the industries. FIFO and weighted average are the two methods which are used in industries these days. LIFO method is prohibited by law, by accounting standards. So no industry uses the LIFO method. Okay, now I'll tell you a very interesting stuff. I'll tell you a practical example of how businessman plays with these methods of inventory. So guys, I went to an audit and I went to a big company, which was an Indian company, domestic company, and I went to their audit and I asked the management, okay, give me the financial statements. Guys, management gave me the financial statements, balance sheet, P&L account, everything was given to me. In the balance sheet, the figure of closing stock was blank. There was nothing in the closing stock. I asked the management, sir, where is the closing stock figure? So management replied to me that sir, closing stock figure is not finalized as yet. I said, means what? Why didn't you finalize the closing stock figure? The management told me that sir, the closing stock figure not only hits the balance sheet but also hits the profit and loss account. And sir, if we use FIFO method versus weighted average method, there is a difference in value. So if there is a difference in value, then if we use weighted average, then the value will be something different. And if we use the FIFO method, then value will be something different, which means that if we use weighted average, then profit will be something different. If we use FIFO method, then the profit will be something different. So profits are different if we use the FIFO method versus the weighted average method. I said, perfect, you are right. That's true. This is bound to happen. But why didn't you use the methods and put the figure? Management told me, sir, we have computed the figures using both the methods. Now, the board of directors will decide which method will give them a better result. Whichever method will give them a better result, they will use that method, because AS is not saying that use only this method or that method. AS is saying use any of the two methods, FIFO or weighted average. You can use any of the two methods. So AS is giving us a liberty. Sir, it's our wish. So if we want a higher profit, then we will use the method which is disclosing a higher profit. When we want the lower profit, then we will use the method which has a lower profit. So guys, this was the reply given to me by the management. Now my question to all of you is management correct in its approach, or is there some problem with the management's approach? What is the problem in management's approach? So I just want you to tell me whether the management approach is correct or incorrect. So you have to just write one word, correct or incorrect. So management is saying that perfect. Chahat's answer is perfect. So management is telling me it's my wish. Whenever I want, I will use FIFO method. Whenever I want, I will use weighted average method. So is management's approach correct, or is management's approach incorrect? That is my question. They are finding loopholes. Yes, Harish, they are finding loopholes. But if there are loopholes, there is no problem in exploiting those loopholes. If they are, they can be exploited. What is the problem? So yes, they are finding loopholes, but that's okay. If loophole is there in law, then what's the problem in exploiting that loophole? I will exploit that loophole. So is the management correct or incorrect? Yes, most of you have told that management is incorrect. Absolutely true, guys. Management is incorrect because the fundamental principle of auditing and accounting is that there has to be consistency. Consistency means we have to follow one principle over a period of time, again and again and again, and the method cannot be changed frequently. So what should have management done? Management should have picked up the last year's report. They should have picked up the last year financial statements, and whatever method was chosen for valuing the inventory last year, the same method should have been used this year as well. There cannot be any change in the method of inventory unless and until there is a change in law. So suppose if tomorrow the accounting standard is amended to say that, okay, I don't want FIFO method to be used, companies can only use weighted average method. If tomorrow there is a change in regulation and this change comes by, then guys, the companies, the management is free to change their method. But right now, management should see what is the method being used in the last year, and the same method should be used in the current year as well. So you need to check, as an auditor, you need to check the method of valuation. What is the method of valuation and disclosure that should be in compliance with the accounting standards or the Ind AS. Next, work in progress. Now, work in progress valuation should be checked. Now, what is work in progress? Guys, work in progress are semi-finished goods, goods which are not finished completely. So if I talk about mobile phone, so mobile phone is semi-finished when it is prepared in a semi-finished manner. It is not completely prepared, and that mobile phone, some processing in that mobile phone is still left. Guys, in this case, it becomes very critical for the auditor to understand how should we value this work in progress. Because finished goods, full value is given to us. Raw material, the purchase value is given to us. But what about work in progress? How should we value work in progress? So guys, to value work in progress, we go into principles of costing, and costing tells us that you should accumulate all the expenditure which has been incurred for producing this particular product, and you should multiply the percentage of completion on this particular cost. Soon as you apply a percentage of completion on this cost, you will get the value of work in progress. Now, the biggest question that I have is, guys, can auditor verify the percentage of completion? So if I give you a half prepared mobile phone, so I tell you that, okay, the mobile phone is half prepared, it's half not prepared. Can you tell me how much percentage is prepared and how much percentage is not prepared? Can you tell me about that? Can auditor know how much percentage of a particular work in progress is completed, how much percentage is incomplete? Can an auditor tell me, can auditor tell this particular fact? Yes or no is the answer. There should be only two options, yes or no. Chahat says yes, Devi says no, Sushmita says no, Amrit says no, Arul says no. Okay, yes, Amrit says yes. Anyone for yes? Rishiraj says yes, Nikita says no, Harish says no, Nidhi says yes. Okay. So the house is mixed. Let me disclose the answer. Guys, auditor cannot tell what is the percentage of completion of any product because auditor is not qualified enough to comment on this particular aspect. Auditor doesn't know the engineering behind producing mobile phone. I don't know how our mobile phones produced. I don't know how our mobile phones constructed and how much percentage is complete. I don't know. Management is the sole authority who can know this. Auditor cannot know this. Now the question is, Then auditor. How can auditor audit that particular percentage? Because the key point in valuing work in progress will be that percentage completion. How much percentage of that good is completed? So how would auditor audit that work in progress? That is the question. If he doesn't know the percentage of completion, is there any way by which auditor can verify the percentage completion? Different person appointed who is a specialist. So guys, simple. I will go to the engineering department of mobile company. I will ask the engineering head to give me in writing that how much percentage is completed. I will rely on that. If I am apprehensive about the comment which the in-house engineer will give me, I will call for an expert. I will call for an external engineer and I will ask him to tell me how much of the percentage of mobile is completed. But I myself cannot determine it. I need a certificate from a specialist. I need a certificate from an external party to verify what is the percentage of completion. So similarly, in case of food products, in case of say the gestation period of this particular product is quite high. Preparation of alcohol, guys, alcohol preparation is a long process. The wine, whiskey, beer, all these things takes a lot of time to get prepared. So auditor cannot know what is the percentage completion till 31st March. Auditor cannot know. So auditor needs a certificate from a specialist to ensure that the percentage completion is perfect, and then only can an auditor check the work in progress. So work in progress valuation should be checked by the auditor properly. Then classification of inventory should be checked by the auditor, whether raw material are kept in raw material section, finished goods are kept in finished goods section, work in progress are kept in work in progress section. So each of these elements should be properly kept, should be properly stored, and classification should be given properly to the auditor. That is an important thing. Classification of inventory should be checked properly by the auditor, and their records are to be checked. The records which are there in the classification also are to be checked. Okay, management confirmation about stock held on behalf of others and the stock lying at other people. Okay, perfect. So this is a very important point to be checked, guys. Sometimes your stock is not kept at your premises. Sir, how can it happen? Our stock is kept at our premises only. No, guys, sometimes like in case of FMCG products, our stock is lying in our distributor's premises. So whosoever is our distributor, we have our products lying in their premises, or we can have our products lying in our branch. We can have our products lying in our warehouse or some other third party location. Third party location is the distributor. So distributor is telling me that, okay, I will not buy the product from you. I will just call the product from you. If the product is sold, only then I will make the payment. This is the arrangement between distributor and the company. In this case, the inventory belongs to the company. The owner of inventory is the company. But who is the custodian of inventory? Who is the holder of inventory? It is the distributor. So in this case, sometimes what happens is some stock is lying at third party location of the company, and sometimes the company is holding someone else's stock. Guys, if your stock, if your company's stock is being held in some other place, you as an auditor are authorized to go at that some other place, the third party location, and get your product audited. You are authorized. Yes, that location is not your client. That location is not the company of which you are auditing, but still you can go over there and physically verify the stock. Similarly, when the stock is lying in your factory and it pertains to someone else, then you need to call up that person and ask whether that product is belonging to him or not, or is that product belonging to the company, because you need to be sure. Company can lie to you about anything. Company can enter into a fraudulent transaction about anything and everything. You as an auditor has to be vigile. Logic, guys, or simple logic. There is no rocket science in it. There is no law in it. It's simple logic. If someone else has its products inside my factory, then I should call that someone else and confirm whether the product is his or not. Again, I would also check the documents. I will call documents from him and I will check whether that inventory is his or not through documents also. I will call for the documents also. So any kind of inventory which is lying at some other place or someone else's inventory lying at our place is to be audited by us properly. Okay, sir. So this was audit of inventory. Now comes a very, very important element of our audit, and this element is audit of fixed assets and property. Chahat, auditor has to check all these things in a single financial year, that too with the accuracy, and there are ways. So auditor has multiple people working with him. It's not one auditor, it's 10 people working at a time. So when 10 people are working at a time, they can allocate their own respective areas and they have to do this. There's no alternative. Okay, sir. So audit of fixed assets, property, plant and equipment. And guys, this is one of the most important areas in terms of quantum, because manufacturing concerns, think about manufacturing concerns, think about Tata Industries Limited, think about Reliance Industries Limited, think about any big Jaguar company manufacturing cars, think about any big manufacturing concern. Their major money is stuck with fixed assets. Their major money is invested in their plant and machinery. And again, fixed assets has two implications in our financial statements. One is that fixed assets are debited to our balance sheet. It impacts our asset side. Second, fixed assets depreciation hits our profit and loss account. So if fixed asset is erroneous, then the depreciation will be erroneous. If the depreciation is erroneous, our profits will go for a toss. So two impacts of fixed assets. One in the balance sheet. Balance sheet asset side will go up or down if you are erroneously recording your assets. Second is the depreciation, which is disclosed in the profit and loss account. Your depreciation will go for a toss. So what are the procedures for assets audit? And guys, there are two words used over here. Can you guys tell me the origin of the second word which is used over here? This word, property, plant and equipment. What is the origin of this word? Property, plant and equipment. I want to know the origin of this word. Where does this word come from? Fixed asset is a word which we have studied. No, AS10 talks about fixed asset. AS10 doesn't talk about property, plant and equipment. Where does this word come from? Property, plant and equipment. PPE is the short form of this word. And probably you are in Inter as of now. Soon as you'll reach the finals, then you'll probably know the answer precisely. But if you can just guess, if anyone can guess, where does this word come from? Property, plant and equipment. Okay, so this word comes from Ind AS, IFRS. Earlier, the traditional word which is used by the Indians, by the Indian accounting standards, was fixed assets, which is AS10. It was fixed assets. But soon as Ind AS came to picture, soon as IFRS came to picture, they changed the name to property, plant and equipment. No logic behind it. No rationale behind it, but it's just a terminology change which has happened. Earlier, the terminology was fixed assets. Now the terminology is property, plant and equipment. That is the only change in terminology. Okay, let's see. How would you audit fixed assets? Because fixed assets are the most important elements of, say, a manufacturing concern. Number one, check the supporting documents of acquisition and disposal. Guys, pretty logical. Pretty logical. The first thing which we need to see is that, please, if this asset belongs to you, please show me the supporting documents, because the invoice, the bill should be in the name of the company. Guys, it may so happen that the company, while the audit is being done, they might physically get the assets from the neighboring company. The neighboring company has big plant. So the company might say that, okay, this is our plant. They might befool the auditors. So auditors need supporting documents. The invoice should be in the name of the company. The company should be the legal owner of the fixed assets. That is the first check. So supporting documents of acquisition and disposal, for example, title deeds of ownership of fixed assets is to be seen by the auditor first of all. So for I'll give you an example, guys. When I was a child in our 6th, 7th standard, then guys, we had a friend. And that friend used to come to school, and he used to show us some jazzy stuff. Jazzy stuff means a very expensive watch, a very fancy pencil box, rubber or pencil, or some fancy stuff. And he used to flaunt it in class. And the peculiar feature about him was that he used to bring it for one day, and next day he didn't used to bring it. He used to leave it at home and say that, oh, I use it rarely. I don't bring it daily. So we used to be astonished. Okay, so we used to ask him, is this watch yours? He used to say, yes, this watch is mine. This pencil box is mine. And later on, we realized that he had an elder brother, and he used to bring his elder brother's watch, his elder brother's pencil box, his elder brother's stuff to flaunt in class, and we used to believe that it's his assets. However, these assets were his elder brother's assets. So to avoid such situation in the practical life, in the practical business, we need to see the supporting documents. We need to see the invoice where name of the company is given and where the custody of the fixed asset is given to the company. So ownership, title deed, ownership is to be there in the name of the company. Then of course, guys, physical verification of fixed asset is very, very important. You need not just see it on the papers, but the assets should also be physically present in the company. So physical verification of an asset is an exercise that, apart from supporting documents. So you've seen the invoice. You are sitting in the nice AC office of the company and you are seeing the invoice and you are saying, okay, this is 2 crores of machine which has been bought by the company. Yes, 2 crores of machinery. After doing this, you should tell the finance manager, okay, take me to this machine and show me this machine. That is very, very important. Because guys, documents can be made up. Forged documents can be made up very, very easily. So to avoid this situation where you are not being shown a forged document, you should take that document with you, go to the factory and actually see the machinery worth rupees 2 crores. Their name will be written, name, you should tally the name, you should tally the make, you should tally the date on which it is installed, etc., etc., etc. So you should physically verify the assets also. Just seeing the invoice is not enough. Just seeing the bill and just seeing the company's name in the bill is not enough at all. You need to go over there and physically check the fixed assets also. So first step, check the supporting documents, check the bills, check the invoices. Second step, physically verify the assets in the factory premises. Third, whether proper records are maintained or not. Now, proper record means whether the company has stated that this asset is being capitalized on which date of capitalization is there properly or not, date in which the company has purchased this particular asset and installed it. The supporting documents like invoices, like bills, all those things should be there. Then cash is flown outwards, so there should be a cash credit entry in the books of account also. Then the fixed asset should appear in the fixed asset register. So that fixed asset register should be made, in which fixed asset should be displayed. So proper records are required to be made, required to be maintained with respect to the fixed assets. That is also an important part. So check whether proper records are maintained or not. Now I would ask you a simple question before jumping on to my next point, because my next point is depreciation. And to appreciate this point, I need to ask you one question. When should an asset be capitalized? Which is the date on which an asset should be capitalized? And I'm looking for answers and I'll open the chat box. When should an asset be capitalized? I'm asking about the date of capitalization of fixed asset. When should the asset be capitalized? When it is finally put to use. Okay. Any other answer? Anamika has said put to use. Installation date. Ujjwal, are you trying to say the date of installation, which means date of ready to use? There are two dates, guys. Put to use or ready to use. Which one should be used? Put to use or ready to use? Put to use, ready to use. Put to use, ready to use. Okay, again a mixed lot. When it is ready to use. Okay, so first of all, let me tell you the difference between ready to use and put to use. Ready to use is a situation where the asset is absolutely in a working condition and you just have to press the on button and the asset will work. So I'll give you an example. Guys, AC. I bought an AC and that AC has been bought and has been kept at my home. Is the AC ready to use? Answer is no, it's not, because unless and until AC is fitted with its installation, with its pipe, with its electrical condition, with its pipe of water, everything is to be installed in a proper manner. The date is installed, that time it is ready to use. That time it is known as ready to use. And guys, the accounting standard tells you that the asset should be capitalized on an earlier date of ready to use or put to use. And obviously the earlier date is mostly ready to use. So whenever the asset is ready to use, even if you have not started using it, you will apply the depreciation, because depreciation is applied under two conditions. One, when the asset is used because of wear and tear, depreciation is allowed. Second is efflux of time. What is efflux of time? Passage of time. So if time is passing by, then also your asset will be depreciated, and depreciation can be applied on that particular asset. So guys, proper depreciation, if you want to check the proper depreciation of an asset, if you check whether depreciation is applied properly or not, then the dates which you need to use is date on which the asset is ready to use versus the date on which the asset is put to use. So you have to verify whether the asset is ready or whether the asset is put to use or not. That is the main concern. Now I'll tell you a practical example, and my practical example where I found this silly mistake. This is not a fraud. Again repeating, this is not a fraud by the company. This is a silly mistake. Okay. So a company, a very famous MNC, had its head office in Delhi, Hoskas. There's an area in Delhi which is known as Hoskas. It had a office in Delhi, which is outskirts of Delhi. Factory head office was in Hoskas, which is the central location of Delhi, and the factory was in Manesar. So guys, in this situation where the head office was in Hoskas and the factory was in Manesar, under this situation, the fixed assets were brought inside the factory and they were kept inside the factory, and the accounting used to happen at Hoskas, the head office. Now, the company finance manager told me that, oh sir, this year we have bought 10 ACs, and those 10 ACs value is 10 multiplied by 50,000, 5 lakh rupees, and we are going to capitalize these 10 ACs, and these 10 ACs are to be capitalized. Their depreciation is to be levied in the books of accounts. We want the depreciation to be levied in profit and loss account. I said, okay sir. Sir, you just have to prove me that whether by 31st March, whether these assets were installed or not. And the CFO with full confidence told me, oh yes, they are installed. I told the CFO, sir, please give me a proof. CFO couldn't give me any proof. Why? Because the installation certificate, which was to be taken from an engineer, from a computer engineer, guys, that installation software was dated 1st of May. So naturally, 1st of May was the installation date when the ACs were installed, but CFO was not made aware of this fact that the ACs have been installed later on, 2 months later. So due to work in the factory, the production in charge could not get time to install those ACs, but in the books of accounts, by mistake, the management, the financial manager had installed and capitalized this AC. So this was a mistake which I could find in these books, and because of this mistake, the depreciation was absolutely wrong, which was calculated in the books of accounts. So guys, as an auditor also, you have to not rely on the assertions which are made by the management. You ask them, okay, give me proof of installation. If somebody has installed AC in your factory, then obviously there would be some expense of pipe, there would be some expense of electrical fittings, there would be some expense, some related expense which are so you need proof for everything. So unless and until these proofs are given to you, proper depreciation cannot be computed, proper amount of depreciation cannot be audited by you. Then check whether scrapping, retirement of fixed assets are properly authorized. Now, this is one very important thing, guys. Authorization of even the purchase of assets and the sale of asset is to be given by the board of directors. Guys, in any company, the person who is responsible to purchase or sell the assets is the board of directors, and board of directors are the sole authority to allow purchase of assets as well as sell the assets. So you as an auditor should see that no one in the lower hierarchy of the management are not authorized to sell assets. Assets are to be sold only and only by board of directors. Because guys, if assets were allowed to be sold by the lower level managements also, then lower level management would very easily sell off the assets and keep the money in their own pockets. So authorization is very, very important. The selling and purchase both should be authorized by the proper person in the hierarchy in the management. check whether the sales proceed of fixed assets are properly accounted. So guys, can you tell me from an income tax perspective, if any fixed assets is being sold, then which head of income is invoked? If any fixed asset is sold, then which head of income is invoked? I just want the head of income from you. Absolutely. Capital gains. Capital gains is invoked if any fixed asset is sold in any organization. And therefore, guys, since income tax has a separate section for it, there are multiple sections. Since income tax has separate sections for accounting for the receipt of the fixed assets, therefore, the sales proceeds of fixed assets should be properly accounted, should be properly disclosed, so that when the income tax officer is preparing your return, then he should know that, okay, this much lakh of rupees is being earned by selling off the fixed assets. Sales proceed of fixed assets should be properly accounted for. That is the main objective or the main thing which you need to do. Now, let us come on to some other aspects of auditing, guys. And these are some specific institutions, some critical institutions which merit some different type of auditing, which merit some peculiar type of things to be looked at because of their peculiar nature. So in the exam, the examiner will ask you, how will you audit an educational institution? So guys, I'll give you a standard fundamental principle of how to answer the questions, whether the question is for auditing an educational institution, whether the question is for auditing a cooperative society, whether it is for auditing a hospital, whether it is for auditing a trust. I'll give you a standard format, I'll give you a standard method to follow, and that way you'll be able to learn all these points very, very easily. I know you face a lot of difficulty in learning all these areas and all these points for each of them. So I'll give you a standard format. So let's start with audit of educational institute. I have a picture of some random educational institute in front of you. And guys, the first and foremost thing while starting off the audit is that, guys, I will check who has given permission for this educational institution to be activated or to be started. Because guys, educational institute cannot be started randomly. I mean, if today I want to start an educational institute, guys, I need permission. I need proper authority. If I'm starting a school, I need an affiliation from CBSE. If I'm starting a college, then I want an affiliation from Universities Grant Commission. So educational institution is not like a normal business. Is not like any service provider which is providing services. It is not like a normal institution. It is a specialized institution. Therefore, the first thing that I will see for this particular audit is that whether they have taken proper permissions, whether there is a charter, whether there is a trust deed which is required to be fulfilled. So the first element of seeing this special kind of entity is the constitution. Guys, first thing that I will see in an education institution is what is its constitution? Under which act is it constituted? Under which section is it permitted to work in the business? So this thing is the first thing that I'll see in audit of an educational institution, that its constitution should be proper. The way it has been made should be proper. The various sections under which it is operating is proper. And for this, I will examine the trust deed. So guys, usually the educational institutions are formed under a trust deed, and I will read through the trust deed to know what are the important elements of the trust deed. Regulations made under the trust deed, because I want to know that whether the educational institution has fulfilled all the legal requirements or not. So regulations which are governed in the educational institution. Then guys, I will also read the minutes of meeting of the managing committee to know what are the decisions which are being taken for the benefit of the business. So I will check the minutes of meetings which are there with the committee, with the managing committee. I will check the governing body's minute of meeting so that I know what are the principal key regulations, the key decisions which are being taken by this particular authority. Then guys, after checking the constitution, the next two things which I want to check is incomes and expenditures. So these are the standard two things which every auditor checks: incomes and the expenditures. So let's see. So first of all, you tell me, before even starting the incomes, you tell me what kind of income can you expect from an educational institute? Of course, I've given you the first one, so don't repeat the first one. I've already given you the first one, so don't repeat the first one. Don't repeat student fees. Tell me some other income which an educational institute can earn apart from student fees. Yes, donation. Yes, transport fees. Tuition fees is included in students' fees. Donation. And guys, hostel fees. Hostel fees can be earned by the institution. Examination fees. Canteen fees. Absolutely. Study material fees. Absolutely. So guys, you just need to apply logic to these questions, and logically you have to tell me that what are the income streams of this particular organization and what are the expenditure schemes of this particular organization. Grants, absolutely, Debian. Grant is also, sports fees can be a part of it. Now, tell me something. I want to audit the students' fees. Let's talk about students' fees first. I want to audit the students' fees. Suppose the management is telling me that, okay, we have received a student fees of 5 crore rupees in the current year. 5 crore rupees is the student's fees. How will I audit 5 crore rupees? Guys, simple. Number of students multiplied by fees paid by each student. Number of students multiplied by fees paid by each students. So I need to check how many students were studying in the organization in that year, and I need to check how much fees has been recovered from a particular student. I will multiply these two numbers and I will audit the student's fees. Simple as that. So let's see. Check the names entered in the student fee register for each month or term with the amount of fees charged. So first thing is that students fee register would have certain names. Just check that name and just see what is the fee or what is the amount which has been charged from this particular student. So student fee register would have the fee amount. Just see what is the fee amount per person and just see how many students are appearing in this term. Then check fees by comparing the counter file or of receipts. So naturally, guys, we need to see while the fees is being received from the students, there is a fee register, the fee receipt, which is given to the students. The smaller part of the fee receipt is kept with the accountant. The larger part of the receipt is given to the students. So guys, I will tally that fee is counterfoils of receipts. So guys, I'll tell you a very simple example. I'll give an example to you. There is something called ghost students. What are ghost students? Ghost students are the students who are not existent, not in existence. They are not there in the school, but still the fees is being received from them. Sir, how does this happen? I'll tell you how does this happen. Okay. So simple as that. Suppose the institute has got some fees in black from some malicious party, from some for doing some fraudulent activity. The school has received some fees from a third party and they want to make this income of black as white. What they'll show it as in their books of accounts is that they will show that they have 10, suppose they had 10,000 students in there. Okay, so 10,000 is too exaggerated a number. 1,000 students were there in the school for the entire year. Guys, the school will tell the authorities that we had 2,000 students and they will account for that black money as the fee for the balance 1,000 students. This is how a fraud can happen in an educational institution. So guys, to curb this policy of ghost students, we check the register of students and we tally it with the receipts which are given by the students, because receipt contains the address, name, mobile number of the student. Guys, as an auditor, you can also do one more thing. On a random basis, you can pick up that mobile number of one of the students and call him and ask him whether he was a student of this particular school or not. Ghost students can be figured out from this particular technique. Similarly, there's a concept of ghost employees. Sometimes to claim extra expenditure of salary, some companies say that, oh, we have 100 employees. But guys, in reality, they have only 80 employees. They don't have 20 employees. These are known as ghost employees. To curb the probability of having ghost employees, what do auditors do? Auditors send an email on the email account of that particular employee and ask for a revert from that particular employee. This is how we prove that ghost employee is not there. Similarly, you have to prove that ghost students are not there. So you need to see the counterfoils of the receipts, which will contain the name, address, mobile number of the particular students. Those counterfoil should be cross-checked with the cash register, should be cross-checked with the books of accounts, should be cross-checked with the fee register which is given to you. That is how you will curb this probability of having ghost students. Next, ascertain that fees paid in advance have been carried forward. So there can be situation where the fee is paid in advance. Someone has paid the fees for the entire year. However, he was only required to pay the fees for a month, but he is required to pay the fees for the entire year. So if someone has paid the fees in advance, the same should be carried forward in the subsequent period, and the arrears that are irrecoverable. So if there are any arrears, which means someone has not been able to pay his fees, then those arrears should be written off. But again, the arrears should be written off after obtaining a sanction. After obtaining a sanction. Sir, why is a sanction required for writing off the arrears? A very, very critical point from an auditor's standpoint. Guys, sometimes what accountants do is accountants keep the student's fees which is received from a student in their own pocket. They take it away in their home and they tell the management that, oh management, this student was unable to pay. Please write off the balance. This student will not pay. To curb this situation, so that there is no fraud in the educational institution, a sanction is required to be taken from the appropriate authority. The management should be made aware about the write-off. Only then a write-off can happen. A write-off should not, the accountant should not be authorized to do the write-off of fees. So that proper check, proper balance can be put whether the accountant or the AFN of the money. They take the money. This is how the areas are to be accounted for. Then check admission fees with admission slip. Whatever admission has taken place, we should check the admission slips that if the management is saying that 20 students have taken admission this year, then admission slips should have amount of the admission fees which the students have given. They should have amount of they should have the names, addresses, signature, mobile phones of the students who have taken the admission and all these things. So admission slips should be checked for the admission fees to ascertain whether admission fees has been correctly recognized in the books or not. Then see the free studentship or scholarship or concessions. If any scholarship has been received by the student, if any concessions have been given to the student, then guys, those concessions should be granted by the person authorized to do so. So it should not so happen that every person is giving concessions to the students. Every accountant cannot give concession to the students. Concession is to be given by any authorized person, which can be a vice principal level of a person or HOD level of a person. So you should see if the accountant is telling you that, okay, we had waived off 50% of the fees of the student, then there should be an authority. There should be a signature of vice principal or the principal that yes, really this student's fees was waived off. So authority should be given to the auditor. Other receipts, there can be some other receipts. As I told you, there can be hostel fees. There can be caution money which is received, which is the security deposit which is received by every student. Rental income, maybe the school has given its premises after school hours is given to some coaching institute to take coaching over there. So there can be some rental income. There can be fine for late payment. So many students pay the fees late. So there can be some fines. There can be donations which are given to the school. So all these other incomes can also be there. So naturally, guys, first of all, we'll check the deposit receipt, because for every income, we will issue a receipt to the person who is giving us the income. So first we will check the donation receipt. Then we will check that the amount has been properly recorded. So recording of the amount should be an important element, that it is recorded in the books of accounts properly, because it should not so happen that donation has been received and in the books of accounts it is written that student fee is received. This should not happen. It should not happen that hostel fees is received, but the entry which is made in income statement is that student fees is received. This should not happen. So recording has to be proper, which means classification of this income should be proper in the books of accounts, along with the P&L account and the balance sheet, etc. Then vouch that donations have been used for the purpose for which they have been received. So guys, donation have a very peculiar feature that guys, donation, if it is received for a particular use, then they have to be expended for that use only, which means if the donation is received for, say, student fees, then the donation should actually be used for student benefit only, to waive off some economically backward students. If the donation is received for building fund, then that donation should be utilized in building, making building only. So you need to check whether the purpose for which the donation is received, the money is employed in that purpose only. So this is an important point of verifying the donations. Then guys, expenditure. Of course, expenditure is the most critical part of any P&L account, because by waiving the expenditure, we can waiver the profit and loss account of a particular organization. So expenditure is the most important element of any organization. So expenditure, we can vouch the expenses. Vouch means verify. Guys, vouch word is not a very technical word. Vouch means verify. Verify means you have to see the documents. You have to see the bill. You have to see the invoice. So that is vouching. So you can vouch the expense, inquire into unduly heavy expenditure under any head. If there is unreasonably high expenditure under any head, then you have to check why is that particular expenditure so high. So vouching is the first phase of any audit of expenditure. Vouching means you have to check the documents, whether bill is there or not, because bill is the main consideration for doing an expenditure. So bill should be there. Ascertain that system of ordering, inspection on receipt, issue of provision, food stuff, clothing or other equipment is efficient and all bills are duly authorized. So guys, whatever provisions are bought in the school, like food, like clothing is bought in the school, books are bought in the school, all those books, all those provisions, all those food stuff should have proper authority first of all. Then they should have proper supporting bills. Someone should have authorized purchase of those inventories, and then there should be some proper invoice of that particular expenditure. So you need to see for all these things that there are two things. One is authorization, second is proper supporting documents, proper bills and vouchers should be there for all the expenditure. And see that increase in salaries of the staff have been sanctioned by the committee. So if there is any increase in salary, that increase in salary should be sanctioned by the committee members, by the members of the educational institute. Verify that provident fund money of the staff has been invested in appropriate security. Provident fund should be, what is provident fund? First of all, what do you mean by provident fund? If you can just tell me through the chat box, what is provident fund? Okay, sanction. Shivangi, I will explain sanction in detail surely. Provident fund, retirement benefit. Okay. Employer-employee contribution. Perfect. So provident fund is the employer contribution and employee contribution into a fund which is used for the benefit of the employees. So guys, you again need to check that provident fund expenditure is being properly recorded by the management of the institution and the educational institution, and that is appropriately being invested in the security wherever it should be invested. So that is a consideration. Then last, capital expenditure. Guys, capital expenditure, if a building is being purchased or a big equipment is being purchased, then three things need to be checked. First is a sanction. Senior person, some managing director should be able to sanction the purchase of fixed assets. Second is voucher, the bill which is related to purchase of this fixed asset, that voucher should be there. And third is that you have to physically verify the asset. You don't just have to see the vouchers, you have to go over there and physically verify the asset also. And all these assets are assets for any organization are to be verified in three forms. First is sanction, which means authority. Second is voucher, and third is physical verification of that particular fixed asset. So guys, these are the basic points which you need to remember for all the organizations and for all auditing all the elements of these particular type of values.